This is the Asia Trade. I'm Sherian in Tokyo.
I'm Hadi Stradwatts in Sydney. The top stories this hour. Asian stocks are set to extend a rally as hopes grow that the Iran war may be closer to a conclusion. Brent crude declining to close just over $100 a barrel. President Trump set to hail his campaign in Iran as a success during a primetime address today and repeat his 2 to 3 week time frame for an end to US military action. And NASA's most powerful rocket ever blasts off, carrying 4 astronauts on the first moon mission in more than 50 years. Meanwhile, Bloomberg learns that SpaceX has filed for what's set to be the biggest listing in corporate history.
Take a look at how we're setting up for the Asian market session. Of course, we saw some gains in the overnight session in the U.S. 2 sessions of gains on hopes of that de-escalation in the Iran war. So we had some of that negative positioning unwinding a little bit, and U.S. futures at the moment pointing to some upside as well. Take a look at how Nikkei futures are trading at the moment. Some gains you can see right there after we saw the best day for Japanese stocks in about a year, and we are now following Kospi futures that closed to the upside of 1.6% as well. We're getting the latest inflation numbers. Consumer prices year on year accelerating 2.2% in South Korea, coming in slightly below economists' expectations, but this is still an acceleration from the previous month. Of course, the Bank of Korea continuing to contend with growth concerns, but also prices continuing to rise, especially given the fluctuations around oil. South Korea and Japan really big importers of Middle Eastern oil. So some of the themes that we'll be watching today, of course, AI is another one, Heidi, because we saw Samsung also seeing its best day since 2001.
Yeah, we are continuing to watch the AI and the tech story, even as, of course, geopolitics. The situation when it comes to what happens with the war in Iran continues from here. But take a look at commodities. Of course, oil continuing to be the one to watch, particularly as we have to and fro as to what a potential conclusion to the war means for the reopening or not reopening of the Strait of Hormuz. Not a great deal of certainty there, but we're seeing oil at the moment, Brent, as well as WTI at the last trade, really extending the drop as we see potentially the end to the conflict. We're also seeing not much of a move when it comes to gold at the moment. Aussie stocks just coming online about 0.3% higher. We did hear from the Prime Minister in a recorded message last night talking about really trying to strike the balance between concerns for the economy going forward in the coming months, but also not wanting to stoke panic over energy shortages. Well, President Trump has set the stage for an off-ramp in the Iran war as he prepares for a primetime broadcast address in the coming hours. Meanwhile, Iranian President Masoud Pezeshkian has posted an open letter to Americans, urging them to look beyond the U.S. political rhetoric. Let's bring in Bloomberg Politics editor Laura Davidson and our Washington and White House correspondent Jeff Mason for more. So, Jeff, give us an indication. What have we heard from the president so far today, and what do we expect in this address to the nation?
Well, we expect a few different things tonight. Number one, I think the president will go over some of the things that he has been saying in the last few days about what he views as success so far in the war in Iran, and probably emphasizing the timeline that he laid out yesterday in terms of a 2 to 3 week end or off-ramp period for the war. I wouldn't be surprised if he also used the address tonight to be critical again of some allies for not stepping up, in his view, to help the United States in terms of making it easier for ships to get through the Strait of Hormuz. So probably a little bit of criticism, as well as perhaps an early victory lap as the president eyes an end to this war.
Jeff, will the American public accept his speech? Because we have seen now gas pump prices, $4 a gallon, already being topped. They're not very happy with the Iran war. So what will the president need to tell them in order to assuage the public?
Well, it's not for me to say whether the public will accept the speech, but I will say that I do think to your question, I do think he's trying to make a sales pitch. And in many ways, it's coming very late. The president did not do an address to the United States or to the nation when he launched this war more than 4 weeks ago. He instead did a video that was posted on his Truth Social account, his social media account. So this is the first time, despite multiple times, of course, where he's spoken to reporters, where he is really sitting down and laying out the case for what he has done and what he has left to do, or at least chooses to have left to do in the war. But to your broad question, how will it be received by the American public? TBD. And some of that won't be clear, I think, until the midterm elections coming in November, to the extent that public unhappiness with this war will manifest at the polls.
And Laura, not surprising, the Iranian president has actually tried to address the American public. What did he say in his letter?
Yeah, so this letter called on Americans to look past the rhetoric and pointed out a lot of the inconsistencies that have been coming from the White House, and acknowledging that the U.S. has kind of been kept shape-shifting here on what exactly it wants and the demands it has of Iran, and says essentially that the history between the U.S. and Iran is misunderstood. This also comes around the same time that a report hit from the New York Times that says that U.S. intelligence is signaling that Iran doesn't believe that Trump is serious about these peace talks that he keeps talking about. This is a dynamic that Trump has actually acknowledged himself publicly, saying that a couple days ago that we always negotiate with Iran, we being the U.S., and then we end up blowing them away. That's a direct quote there. So this is something that it has continued to play out both last summer as well as just recently, in the past several weeks. Right ahead of the war, there have been talks going on, and then the U.S. has moved towards military action. That is what at least U.S. intelligence is pointing to as a key holdup here, as Trump is trying to get Iran to engage more in talks, and Iranians just aren't sure that this is for real this time.
Equity indices built on opinions? That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
Yeah, so much of the uncertainty has been in exactly what kind of communications have been between the two sides, right? How much of it is gamesmanship on both sides? Do we know who the U.S. is negotiating with at this point?
We don't. Trump has suggested that the U.S. is talking with the new president of Iran. That individual is actually someone who has been in that role since 2004. Of course, there's a new supreme leader, the son of Khamenei, the supreme leader who died in strikes several weeks ago. But the government itself really is unchanged. There are some new names in some of those top jobs, but in terms of the theology, the politics, the sort of hardline stance of this regime is essentially the same as it once was before the war, despite having some new officials who have stepped up as those above them have died in the attacks.
And Jeff, while this conflict continues, we are seeing President Trump really blaming allies and even making the suggestion in a media interview to withdraw from NATO altogether.
He is certainly casting his ire on allies, and in so doing, raising questions about future alliances. The president has called into question the United States' role in NATO multiple times, both during his first term and now during his second. I remember asking him a question in one of his first press conferences last year about whether he remained committed to Article 5 of the NATO treaty, which is the part of the treaty that lays out a defense and that each country will come and defend the other in times of need. He's certainly putting that into, or calling that into question again now, because he's frustrated. He feels as though the United Kingdom, for example, and other European nations should have stepped up to help with the Strait of Hormuz. It's hard for me to say how this is different from previous times, if he's more serious now about potentially withdrawing the United States from NATO, or if that is just his frustration speaking. But we'll no doubt learn about that in the days and weeks and perhaps months to come.
Laura, in the meantime, here in the Asia Pacific, where we know we've seen really outsized negative impact from the energy crisis, we've seen governments and central banks having to grapple with this crisis. We heard from the Prime Minister here, Anthony Albanese, talking about the domestic energy crisis and how people need to be kind of bracing for the economic toil to come. But I do wonder, from the perspective, and you've been in Asia for a few weeks now while this conflict has been ongoing, does this change the assumptions of a US alliance for a number of these countries?
it does at least call into question, exactly, what the U.S. is going to ask of them and what the U.S. will be able to provide to them in response. Both, a couple things are in question. One of just how long are these oil prices going to stay elevated? There's been lots of analysis that even if this war were to end in the coming days or weeks, that prices would, continue to rise. There's a lot of uncertainty about what happens with the Strait of Hormuz. And so this is one issue. The second is military help for these countries, both in terms of direct help if there were some sort of attack or aggression from China, for example, and also the ability to get weapons. We've seen, just with roughly the 4 weeks of fighting or so here, that the U.S. has had to divert a lot of weaponry that it would have sold to foreign governments to focus on the conflict in the Middle East. So there's a lot of uncertainty there about what both the rhetoric of these relationships look like, as well as the practical support the U.S. can provide.
Bloomberg Politics editor Laura Davidson and our Washington and White House correspondent Jeff Mason there. And of course, you can catch the president's address to the nation in the coming hours at the times that are on your screen now. Asia equities, though, in the meantime, prime for early gains. We're seeing early gains here in Australia already. Investors are waiting that address on Iran. Let's bring Garfield Reynolds, who leads our Markets Live Asia coverage. You look tired, Garth. I mean, it's been a roller coaster.
Yeah, it's going to go on being a roller coaster as long as this war continues, and the concern is that it will continue for quite some time. Even President Trump is talking about 2 to 3 weeks being what he'll need. We know he has a very flexible relationship with deadlines, so that could mean he wants to pull out next week. Problem is that Iran has been talking publicly less often, but has been perhaps a bit more consistent about how it wants particular things before it wants peace, but it wants particular things in order to reach that peace. So it's very, very unclear what the path forward is for peace. But in the meantime, just the fact that peace is being talked about is enough for equity investors in particular to start pricing in the potential for a rather rapid rebound from what's gone on. There's a caveat there in that there are signs that overnight, the last 2 days in the US, a lot of what was going on was short squeezes more than necessarily a shift in the fundamentals of what's being priced.
10 years ago, Illuma Capital set out with one goal: to help people like you build a legacy for tomorrow. Through personalized strategies and unwavering dedication, we've been instrumental in helping our clients achieve their financial dreams. Whether it's securing retirement, growing wealth, or planning for the unexpected. For a decade, we've been trusted to guide your financial journey, expertise and care. Visit illuma.co.za today. Illuma Capital is a licensed FSP. T's and C's apply.
That unwinding of negative positioning, right? But Garf, when it comes to the state of the U.S. economy, there just keeps being more positive data out of agencies. What are we seeing in terms of how treasuries are reacting as well? Because they have to really take into account the growth concerns coming from the Iran war, but at the same time, when it comes to the domestic U.S. economy, it seems to be doing pretty well.
Yeah, that's long been the difficulty for it was a little bit ironic that it took the huge surge in oil prices for traders to seriously take rate cuts off the table this year, because when you were looking remember there was a time before the war before the war, the US economy was showing so much resilience that you had to seriously doubt the capacity for the Fed to cut rates by the end of the year. We had our own central bank here turning around and hiking rates in Australia because the Australian economy was doing much better than expected. And the Australian economy is very sensitive to international trends, including US trends, and other central banks were making the same sort of shift. So before the war, the US economy was definitely traveling too well to seriously consider rate cuts, is what a lot of economists were saying. So it's not all that big a surprise that we would continue to get data showing resilience in the US economy. And there have been huge shocks on the energy front and on the pricing front for crude and for gasoline, but that's the sort of thing that's going to take a while to play out. We don't know as yet if that is going to seriously hurt the US economy. And in the meantime, yeah, the data is likely to go and show the sort of resilience that reinforces the bets that we're not going to get rate cuts anytime soon.
Garfield Reynolds, who leads our Markets Live Asia coverage there. And coming up on the Asia Trade, we'll be discussing the meeting between the French and Japanese leaders here in Tokyo with a former lawmaker. Plus, more on the potential Iran war off-ramp with the Hoover Institution. Also, former U.S. ambassador to Iraq joins us. Much more ahead. This is Bloomberg.
Booster ignition. 2, now bound for the moon. Humanity's next.
Good roll pitch. Roger, roll pitch.
NASA astronauts have blasted off on a 10-day mission that will send them around the moon, marking humanity's return to the lunar neighborhood for the first time in more than 50 years. Bloomberg Technology co-anchor Ed Ludlow joins us live from the Kennedy Space Center in Florida. Ed, tell us about the significance of this event today, given that we're not necessarily landing on the moon, but we're just getting very close to it.
Yeah, you summarized it well, that this is humans going back towards the moon for the first time in more than 50 years, deep into space, 250,000 miles, 250,000 miles from Earth, on what is a 685,000 mile round trip. You know, this is significant human space exploration. But you framed it perfectly in the sense that it is a dress rehearsal for the bigger, nearer term goal of NASA and the United States of landing on the moon, which could be as early as 2028. You have to test that the SLS space launch system rocket works and that the Orion spacecraft or capsule works. And that is what the course of this 10 days will show.
Ed, in another big piece of space news, we're hearing that SpaceX has filed confidentially for a massive, perhaps the most massive IPO.
Yeah, I'm told by sources that the confidential filing went in overnight. You know, it's somewhat mechanical because the SEC reviews the draft and SpaceX will have opportunities to make changes to it. But the chronology is important, and it's something that sources stressed to us that it would put SpaceX on track for a June IPO. And given that they are seeking to raise around $75 billion, we understand, at a valuation that is around 1.75 trillion to maybe 2 trillion, depending on the offering, that is a large undertaking, pardon the expression, literally the undertaking that the line of banks involved will have to pull off. But it's happening. That's the big takeaway.
Equity indices built on opinions? That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets. Powered by 450 billion daily data points and backed by research from hundreds of global experts. Delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
In a world of seismic change, will your business shape the future or be shaped by it? How will we capture the imagination of tomorrow's consumers? Overcome operational constraints to focus on future growth. And unlock economic and social prosperity through environmental responsibility. With EY Parthenon and EY's full spectrum of services, we're reimagining the enterprise to shape the future with confidence.
What's interesting, Ed, is that we're talking about the SpaceX IPO. We're talking about the NASA's launch Artemis today. This convergence of private capital, also government-led projects, just how does this really reflect the significance of space, especially in this global race to get there?
Yeah, I mean, it's difficult to, but there are many different ways that the Artemis project is linked to what we've just discussed about SpaceX's IPO. In Artemis's case, SLS is made by Boeing. The service module is made by a number of European companies in conjunction with the European Space Agency, and Lockheed Martin is responsible for the Orion capsule. As we reported 2 weeks ago, and NASA has since confirmed, as has Lockheed today on site, by the way, SpaceX is in the running for a part of later Artemis missions that it wasn't before, which is to dock with Orion and push it, literally push it, towards the moon in later missions. But investors have an insatiable appetite to back these companies. The one discrepancy or difference with SpaceX is that it wants to raise the money in this IPO to fund a new business model, which is space-based data center, or data centers in the form of satellites. And that's its focus, where once Elon Musk and SpaceX focus was making humankind a multi-planetary species. They've been less focused on the moon, but as I said, they're in the running. So there's a lot of threads there, but the footprint, not of NASA necessarily, but the private sector here out on the Space Coast, could not have been more evident than today. And there are a number of investors here on the ground too.
Yeah. Bloomberg Tech co-anchor Ed Ludlow there, reporting live from the Kennedy Space Center in Florida. And Ed just mentioned those space data centers. Well, we'll have to build them here on Earth first. And Bloomberg's been told the financing is near completion for a massive new Oracle data center in Michigan. The total size of the debt package is expected to be $16 billion. For more, let's bring in our Asia tech correspondent Annabelle Jewelers in Hong Kong. Belle, this is going to be used to power applications for OpenAI. What do we know?
Yeah, that's right, Sherry. I think you put it there really well. It's quite a tough act to follow when we had Ed just talking about data centers going to space. But this one, as you mentioned, is going to be very much in Michigan, it seems, and the focus for it is, of course, powering applications for OpenAI. It's an Oracle project. They have a long-standing partnership. They're working very closely on Project Stargate, for instance. But the financing has actually come from Related Digital. So Related Digital is a venture of the real estate giant Related Companies, and it actually conducts financing for Oracle data centers because it acts as a developer and a landlord for massive specialized AI infrastructure. So that's the relationship here. But essentially, Related Digital has been rounding up the cash to build this campus, and it's been really quite a series of massive debt packages that we've seen, of course, for Oracle that's got very ambitious efforts or plans to build out a lot of AI infrastructure. This one, though, seems to have been a very protracted process. That's what we're hearing from sources. And so we're not seeing quite the same size of investment from Blackstone, for instance. They're only committing $2 billion, and that was a revision downward. But yes, that is supposed to be finishing up this month.
Equity indices built on opinions? That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the market, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
Meanwhile, Anthropic has shared details about which of its products are proving to be most popular.
Yeah, that's right. We actually had a very wide-ranging interview with one of the top executives at Anthropic, and he shared essentially where they're seeing the biggest demand. So this is the chief commercial officer, Paul Smith, and he weighed up really co-work versus Claude Code. Co-work is the agentic tool that's been really capturing a lot of interest for its ability to disrupt different industries, from legal services, for instance, financial services. I mean, lots of different sectors have been in focus. He's actually saying that it is Claude Co-work that will, or Co-work rather, than Claude Code that will continue to drive a lot of interest. And that's because it just has a lot more appeal. He says that companies, typically large companies, would have somewhere between 2 and 5% of its staff working in engineering. They're the ones that would be using Claude Code. But for the remainder, co-work seems to be a bigger interest.
Is this sort of taking interest away from OpenAI?
That certainly seems to be the case. Yeah, we had this is another Bloomberg scoop actually, but talking with an investor or founder of this company called Next Round Capital that provides or specializes in providing liquidity in the private secondary market. And what he said or told us is that shares of OpenAI essentially have fallen out of favor on his exchange, and investors are really pivoting toward Anthropic. Now, I don't think there's any real surprises for why that is. Again, going back to that demand that we've seen, Anthropic has been the big disruptor this year, and also at the same time, its valuation is less than half of what we see for OpenAI right now when you look at their financing rounds, or their latest financing rounds. Yesterday we had OpenAI going north of $850 billion. You've got Anthropic that is, again, below that $400 billion mark. And so it's that anticipation that Anthropic's valuation may catch up, and that's why you're seeing that shift away already, and hearing about institutional investors that are looking to actually sell their shares of OpenAI but not finding any buyers.
Annabelle Drillers there in Hong Kong. More ahead on the Asia trade. This is Bloomberg.
Take a look at how U.S. futures are setting up after 2 sessions of gains. We're seeing a little bit more upside on that hope of de-escalation of the Iran war. We are headed towards President Trump's primetime address in a few hours, and you can see the dollar also holding steady. More ahead on the Asia trade. This is Bloomberg. The top headlines that we're following: the Trump administration is reportedly preparing to overhaul its steel and aluminum tariff policy. The Wall Street Journal says officials are considering a 25% tariff rate on finished products made with imported steel and aluminum. This would replace the current system, which imposes a 50% duty only on the value of the steel or aluminum used in the product. The Trump administration is said to be planning tariffs also on drug makers that have not struck deals guaranteeing low prices in the U.S. Sources say companies that don't have agreements with the administration will be subject to 100% tariffs. President Trump has been threatening tariffs on the pharmaceutical industry to cut drug prices for American patients. The U.S. Treasury has removed Venezuela's acting president, Delcy Rodriguez, from its sanctions list. The move comes as the Trump administration seeks to rebuild ties following the capture of Nicolás Maduro earlier this year. Officials say the step is part of a broader effort to revive Venezuela's economy and encourage a political transition, allowing U.S. entities to do business with Rodriguez.
Sherry, let's take a look at how we're tracking as Asian stocks remain optimistic that we could be seeing the beginnings of the end when it comes to the Iran war. Of course, hopefully we'll be learning more in just about an hour or so when we hear from President Trump in his address to the nation, I should say. But if you take a look at how we're tracking at the moment, about 0.4% high when it comes to Aussie stocks rising on these hopes of an end to the war. Broadly, we're expecting equities to extend that rebound. We're seeing really that rotation for investors investors back into risk assets, back into stocks on the optimism that we may be seeing some sort of conclusion soon. Futures also when it comes to Japan, Hong Kong, South Korea, all looking a little bit higher. We had upside of about 0.7% for S&P 500 stocks and the Nasdaq 100 over 1% higher there as well. Still, there's plenty of consternation as to what this war to date and the disruptions to the global energy market will mean for economies around the world. An Australian Prime Minister, Anthony Albanese, has given a rare address to the nation, warning of tough times ahead due to the war.
The months ahead may not be easy. I want to be upfront about that. No government can promise to eliminate the pressures that this war is causing. I can promise we will do everything we can to protect Australia from the worst of it. These are uncertain times, but I'm absolutely certain of this. We will deal with these global challenges the Australian way, working together and looking after each other.
Paul Allen joins us now with more. So obviously the Prime Minister didn't want to stoke panic, but there was this feeling of planting the seeds for, I kept wondering what data that they're seeing that we haven't been privy to yet.
Yeah, exactly. And the overwhelming public reaction to that, certainly from opposition parties, commentators as well, was why did we get that message? Because it's very rare to have a Prime Minister address the public in prime time like that. There was a lot of build-up ahead of it. What could this possibly be? But it turned out to be a lot of reassurance. Don't panic by, catch public transport, etc. So you could say that the Prime Minister is really getting in front of the issue here. As for what we don't know, the Deputy Prime Minister, Richard Marles, was questioned if there would be fuel rationing after Easter. He said, look, it's not inevitable, but it's unclear how this is going to play out, which is a fair comment, really. But 2 hours before Anthony Albanese spoke, the Western Australian government announced that it's going to use emergency powers to force oil companies to provide information about supply chains, also to be able to make sure it can direct fuel to where it's needed. And the Resources Minister, Madeleine King, as well, said the government is considering the use of the gas trigger. At the moment, LNG exporters can export as much as they want. The gas trigger would ensure that enough fuel is held in Australia for domestic supply.
We are also expecting to hear from the Prime Minister at the National Press Club today. Could we glean any more?
Yeah, there are likely to be more announcements. We've already had reporting that there will be more support for businesses, $1 billion Australian dollars in interest-free loans. That's about 700 million US. The funding would be provided through banks and be available in about 2 weeks. And we'll expect to hear a repeat of those calls for citizens to conserve fuel. Already this week, we've had a halving of the fuel excise by about 26 cents. That'll be a $2.5 billion hit to the budget. The heavy road vehicle user charge has also been removed. That said, we're expecting a sneak preview of the budget as well. The Treasurer's already said that, look, it's going to be ambitious. There's a traditional sort of slow reveal drip feed in the weeks leading up to the budget in early May. But on the upside, there could be some additional revenue here from elevated commodity prices, which might soften the blow.
Paul Allen there joining us from Sydney. Now, France and Japan have agreed on the need for a ceasefire in Iran and safe passage for shipping in the region. The announcement following President Emmanuel Macron's visit to Tokyo. Defense ministers from both nations also committed to a roadmap for future cooperation, though details have not yet been shared. Joining us now is Mieko Nakabayashi, professor at Waseda University. She's also a former lawmaker in Japan's House of Representatives. Mieko, it's really good to see you. Give us your take of what was achieved in this meeting between Macron and Prime Minister Takaichi, especially when it comes to any concrete joint action on the war.
Right. Of course, the main subject should be the war in Iran and our economic difficulties in providing petroleum, all sorts of inflation based on high gasoline price, and so on. In the midst of that war, somehow there was a chemistry between Japan and France, and of course other European countries, focusing on having closer relationship with Japan. Because of the changing international order, caused by Mr. Trump's administration. And we are wondering how the Strait of Hormuz can be resolved. And Mr. Trump is giving a speech pretty soon, and we'll discover that. But at the same time, European countries are wondering how to maintain the world order after Mr. Trump's attack on Iran. And what Japan and France agreed was rule of law, how we should maintain that. Also, rare earth, minerals, and so on and so forth.
To your point, it's really interesting when I speak to high-level officials here in Japan, how concerned they are about the changing world order coming from the Trump administration. Realistically speaking, though, for Japanese officials, how much can they count on European allies to fill that security gap that the U.S. has provided since World War II?
That's a good question, but we have no choice. That's the problem. Therefore, we have to do our best. As Prime Minister Carney of Canada stated at the Davos, we just started to think about it. Therefore, those leaders from European countries are visiting Japan, and they are also becoming cautious about China. Therefore, they kind of discovered Japan might be one of the important friend or allies. Therefore, space and AI, all sorts of important subjects are discussed between France and Japan.
What do you see as being, I guess, the low-hanging fruit in terms of deliverables from these conversations?
Yeah, that is a good, another good question. But I hear that lots of bureaucratic levels and even ambassadors are saying here in Tokyo that we have to change our mind and we shouldn't just rely on solely on the United States. Therefore, there are some dialogues already started, but it is also very difficult because each country's interest is very different. Therefore, projects, as stated during this summit meeting between France and Japan, will be important because those can become very concrete projects, including rare earthing. It is desperate for us to somehow develop something new supply chains. Also, national defense is also important, and Japan is trying to increase more productions of military equipments. Therefore, maybe Japan can supply something to allies. And that kind of things is extremely important, even in order to keep the international order not to be changed too much.
Equity indices built on opinions? That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
Miyako, when you speak and hear from political stakeholders in your world, how much concern is there over not just what's going on with the Iran war, but the implications for the Asia Pacific, the implications for Beijing, for maritime security, for the fact that something will need to be done about the depletion of weaponry after this war? Does it have meaningful implications for this region?
I think the implications are very big. First of all, if Iran does not give up nuclear weapon development, it can become a huge North Korea. As you know, North Korea hasn't really given up nuclear weapons, and they are developing missiles too. Japan is surrounded by North Korea, China, and Russia, as well as other conflicts in this Indo-Pacific regions. And Japan is not currently able to defend itself solely without the United States. Therefore, of course, Japan needs the United States and will maintain a good relationship with the United States. But at the same time, we have to think about good relationship with China, some kind of dialogue, as well as other nations. Otherwise, we don't know what others are thinking in this region.
So, how much progress do you think there's been on the Japan-China relationship? Because that's soured pretty badly since Prime Minister Takaichi came into office.
Exactly. That is a huge issue in Japan, and particularly business community is worried about it. Of course, China has its own intention. As long as Mr. Xi Jinping is doing well with Mr. Trump, maybe they are very confident about their future somehow. However, it may not go well. And then maybe China can look at Japan to have a little better relationship. Somehow, the relationship between China and Japan are relative to relationship with the United States. Currently, China is in the mode of bashing Japan because of Ms. Takaichi, the Prime Minister, who said Taiwan Straits issue is Japan's issue. Therefore, Ms. Takaichi needs to explain that to the world in a better way. However, Mr. Xi Jinping actually developed his own narrative that Japan is becoming an aggressor, and Ms. Takaichi is not doing very well to change that narrative.
Miyako, really great to have you with us. Miyako Nakabayashi, professor at Waseda University. More ahead on the Asia Trade, this is Bloomberg.
Take a look at how we're setting up for the market opens. In less than 15 minutes here in Japan, we're seeing Nikkei futures pointing to some upside after the biggest gain, the best day in a year for Japanese stocks. Of course, there's a lot of hopes of de-escalation in the Iran war. The Japanese yen has stabilized a little bit, and crude prices are down. We have heard from President Trump about really an exit to the Iran war within 2 to 3 weeks, and we are expecting that prime time address just in a couple of hours from now. Let's discuss all of this. Joining us now is Lan-Hee Chen. His fellow in American Public Policy Studies at Stanford University's Hoover Institution, but he joins me today in the Tokyo studio. Welcome.
Great to see you. Great to be here.
Yeah, it's been a while, hasn't it? And so much has happened since I last saw you. Give us your takeaway of everything that's happening with the Iran war, because we're getting just some conflicting signals, and we're not sure if President Trump will today signal an end to the war, or does it continue because strikes are ongoing?
Yeah, well, look, I think the politics of this have become very difficult for President Trump. And I think as a result, there is a tremendous amount of pressure on him domestically to end the war. I think the question is, how will he articulate what the gains have been? The United States has been involved in this conflict now for over a month. We've seen some progress with respect to deterioration of the Iranian military. There's no question about that. But where is the nuclear capability? What is going to happen with the Strait of Hormuz? These are still open questions. And so the president's going to have pressure to talk about what's been accomplished, but more importantly, Sherry, what's next? I think that will be the big question. The American people want assurances. There won't be troops on the ground going forward. The conflict will draw to an end. Oil prices, gas prices have to come down. The economy continues to be the top issue.
$4 a gallon right now, and we're headed towards midterms. That's not going to bode well for Republicans.
Well, this is the big problem, is that Republicans in Congress have been urging the president, we got to focus on the economy. We have to figure out how to make the domestic economy stronger as voters go to the ballot box, because ultimately that is what American voters are worried about. They're worried about their pocketbooks. And that is a fundamental concern that this war has made more challenging.
And I'm still really wondering what the idea was getting into this war. I mean, we're all talking about the U.S. economy. You have midterm elections. Why go into a war with Iran right now?
Well, if you look at this president's foreign policy exercises so far, that has been a big question, right? He had the Venezuela operation. He's engaged in a number of drone strikes and military operations to take out terrorist leaders. And then you have Iran. This was a president, remember, who campaigned on a restrained foreign policy, who campaigned on making sure America would come first. And part of that was by restraining some of the military dalliances of previous administrations. This has been an incredibly robust foreign policy in the exercise of American kinetic power. And I think that is really something a lot of people look at, and they're a little puzzled by how President Trump has addressed this. So fundamentally now, with a few months left before the election, Republicans facing potentially huge losses in the Congress, it is incumbent upon President Trump now to focus again on domestic politics and the domestic economy.
10 years ago, Illuma Capital set out with one goal: to help people like you build a legacy for tomorrow. Through personalized strategies and unwavering dedication, we've been instrumental in helping our clients achieve their financial dreams, whether it's securing retirement, growing wealth, or planning for the unexpected. For a decade, we've been trusted to guide your financial journey, expertise and care. Visit illuma.co.za today. Illuma Capital is a licensed FSP. T's and C's apply.
What does that mean for the Israel-US relationship? Because Israel has been wanting this conflict for a long time. Many presidents have said no until we got to President Trump. So are they going to be as happy to cease operations? Has it changed the dynamic between the two nations?
Well, I think it remains a very strong relationship. I think the reality, though, is that the relationships that will really define, I think, in some ways, the future of the American economy are the relationships the U.S. has with other countries in the region. And I think there is a question. I mean, certainly I think Iran miscalculated by going after a number of Arab states who could potentially have been at least neutral with respect to this conflict. But what they've done is essentially to take them offside. And I think the question going forward is, how will the U.S. respond in the region? Will it continue to cultivate and develop these relationships with Saudi Arabia, with Qatar, with countries that are strategically very important to the United States in a number of different ways? I think that will be the big enduring question now as we look ahead. But I think the U.S.-Israel relationship remains very strong. I think it will be a question of how much of that relationship endures even after the current leaders, whether it's President Trump or Prime Minister Netanyahu, after both of them leave office in a few years.
He's got to focus on the economy. He's got to focus, as Sherry mentioned, going into midterms. He's also got to turn his focus to the strategic and competitive relationship with China, right? Beijing's kind of been sitting pretty through the course of this whole conflict. Do you think that's given them more leverage?
Well, I think the discussions between President Trump and President Xi when they meet in Beijing here in just a matter of weeks will be the most important geopolitical dialogue of certainly this year, if not the next several years, and obviously it may be the first of many meetings. But I do certainly think that China is looking at what the U.S. has done and realizes that they do have some opportunities, whether they're economic opportunities or strategic opportunities. And I think it is going to be very important for the president to refocus ahead of that meeting. I mean, that's why I think one of the reasons that he's been so focused on ending this conflict, or at least signaling an end to the conflict, before he gets to Beijing and has those conversations with President Xi.
You're actually just coming from Taiwan, and you met with the President Lai Ching-te there. What were his thoughts about the summit?
Well, look, I think there's no question that strategically Taiwan is in a really challenging spot right now. And there is a big question on the island, I think, about what the discussion will be around Taiwan, whether President Trump and President Xi will talk about Taiwan. I mean, almost certainly President Xi will raise the issue. I think the U.S. needs to continue to recognize the strategic importance of Taiwan as a partner, and I think that's a message that certainly the Lai administration, as well as other leaders in Taiwan, are eager to reflect. They want to ensure that people understand that this first island chain arrangement that begins in Japan and extends all the way down into the South China Sea, that this is a strategically important barrier to ensure that China does not threaten the rest of the region, as well as fundamentally the United States. So I think that's the message that the Lai administration probably most wants to convey.
The perception across Asia has been that the Trump administration has not necessarily valued those partnerships and alliances so far. Post-Trump, how difficult will it be for the U.S. to rebuild that credibility with all of the different alliances here in Asia?
Well, in Asia, I think there is more of an opportunity. Europe is a different story. The president tonight may, in fact, talk about how he's frustrated with NATO. Those European relationships, I think, are deeply frayed, and I think that will be a challenge. In Asia, there continues to be an opportunity, whether it's engaging via existing fora like ASEAN or APEC, but certainly the bilateral relationships are incredibly strong. If you look at the Japan-U.S. relationship, there's a potential to strengthen relationships throughout the region. I think the U.S., this president's focus is going to be on continuing to keep those bilateral relationships strong and growing.
Lanny Chen, really good to have you with us here in the Tokyo studio. He's, of course, fellow in American Public Policy Studies at Stanford University's Hoover Institution. And you can also catch President Trump's address to the nation on Bloomberg TV and the terminal in the coming hours. You can see those times on your screen. This is Bloomberg.
Latest from the corporate front now, and the Australian market regulator has released its final report into ASX, concluding that the exchange operators' risk management and compliance practices need improvement. It also found that the ASX's monitoring, supervision and enforcement of operating and listing rules require more attention. ASX Chair David Clark says the ASIC report makes tough reading, but the operator accepts there is more to do and is taking action. Hyundai is stepping up its US push, unveiling a rugged SUV concept and confirming plans for a US-built mid-size pickup. The South Korean automaker says body-on-frame vehicles will be central to its American strategy, with the pickup aimed for launch by 2030. Hyundai is betting big on the US market, pledging $26 billion in investments through 2028.
And these are some of the stocks that we'll be watching at the open, including Samsung and SK Hynix. Samsung just saw its best day since 2001, and we're keeping getting some news on SK Hynix and its potential listing in the U.S., so do watch out for those headlines. The market opens in Seoul and Tokyo are next. This is Bloomberg.
Weekend Enkulu is here. Stand a chance to win 15,000 Rand. Enter online and rent a smartphone with PhoneYam and make a long weekend happen. 10 weekly winners. Apply online at phoneyam.co.za. Everything good becomes AM with PhoneYam.
PhoneYam.
This is the Asia Trade. We're counting down to Asia's major market opens after some gains in the overnight session on Wall Street. Of course, Heidi, it's all about those hopes of de-escalation in the Iran war, especially as we're headed towards that primetime address from President Trump in just a couple of hours.
Yeah, what could we expect to hear from the president, right, given some of the to and fro when it comes to the messaging? Is it just going to be a reiteration of that 2 to 3 week timeline that he spoke about yesterday? What are his thoughts on, whether sort of any kind of end to the war comes with meaningful changes to the Strait of Hormuz? These are what investors will be wanting to hear about.
Yeah, and we'll bring you those comments live in about an hour, but take a look at how we're setting up for the market opens in Japan and South Korea, because we have seen just the best day in about a year for Japanese stocks. This followed 4 sessions of losses as we had a lot of anxiety over the Iran war, and of course crude prices continue to rise. We are seeing volatility in the energy sector, and you can see right there with the de-escalation hopes just rising, the Japanese yen stabilizing at around that 148 level, and Japanese stocks continuing to extend those gains. We're following the 10-year yield at 233 at the moment, but we have seen JGBs really track treasuries as well. And of course, we had solid economic data in the overnight session there as well. Take a look at how South Korea is opening, because the AI narrative, those AI themes, has been another big one to watch. And we just had Samsung having the best day since 2001, and really investors buying back a lot of these stocks that were sold off during the tensions in Iran. And you can see the Kospi now extending gains to more than 1.5% at the moment, and the Korean won a little bit of weakness again past that 1500 level, Heidi.
Take a look at what we're watching. As you mentioned, oil, energy prices, LNG remains front and center depending on what the outcome of this war is sort of calculated to be. 2 to 3 weeks. Does that mean reopening when it comes to the Strait of Hormuz? We've seen that sort of about face from President Trump on how that would be potentially tied to any U.S. withdrawal from this conflict, right? So at the moment, we are seeing oil prices, look, Brent is about 1% lower at this point. But if you take a look at options markets, it really kind of paints the picture of whipsaw trading, and traders not really knowing what the eventuality is going to be. You've got contracts betting everything from a complete structural collapse of the U.S. oil market to $450 a barrel of oil there. So still a great deal of uncertainty. Also watching the dollar, given how much of it's been that sort of haven demand play and that continued alleviation of pressure on Asian currencies, Sherry.
Let's get a preview then of President Trump's upcoming speech and the latest developments in the Iran war. We do have politics editor Laura Davison, also Bloomberg Balance of Power co-anchor Joe Matthew. Joe, let me start with you. What will the president say to the American public now week 5 in the Iran war?
Well, I think the fact that we don't really know is what the news is here this evening. It's a president who's had a lot of mixed messages when it comes to Iran, when it comes to outcomes and strategy. But this is a very important moment for him in a war that has been underway for over a month. He has not delivered a formal address to the American people yet. We're not sure exactly what the venue is going to be here, if he's sitting behind the desk in the Oval Office or in the cross hall near the East Room, which he likes to do sometimes. But I would expect some pretty dramatic rhetoric coming from the president, if not when it comes to actual changes in our approach to Iran, but castigating our NATO allies. This is what we're likely to hear from the president, with the White House telling Bloomberg News earlier through an official that the president will reiterate that 2 to 3 week timeline, but will also castigate our NATO allies for not taking part in reopening the Strait of Hormuz. The big question this evening is whether this president is willing to withdraw without the strait being reopened, or without our actual ability to get our arms around the highly enriched uranium that is, as far as we know, still missing in Iran. These would both help to spell out an endgame to this conflict, and we're not sure what approach the president will take when he speaks to the American people.
Laura, from Tehran's side, we've heard reports that they're kind of skeptical about U.S. diplomacy at the moment. To be fair, in the past weeks, the degree to which these conversations have been real or on foot have been very much in question.
Yes, we've seen almost daily sort of a flip-flopping from Trump about whether he wants to end the war, whether he wants to pursue peace talks, or whether he, is ramping up threats of attack on Iran's oil or energy sites, or looking to escalate this militarily. So this has been sort of a very confusing time per U.S. military intelligence for the Iranians, who just don't know what to think if Trump is serious about some of these talks. We've seen in the past, both last summer and as recently, just as a month ago, as these nuclear talks were ongoing, there were active negotiations. The U.S. then went ahead and pursued a military campaign. So this is going to be a struggle for the president as they try to figure out what their path forward is. We've heard Trump as recently as earlier today say that he wants to pursue this 2 to 3 week timeline, but also that there may be sort of ad hoc strikes going forward if he doesn't like what he sees from Iran. So that really doesn't give the Iranian regime any sort of clarity to come to the negotiating table that they know what they're going to get. This also is a time where allies are also distrustful of the U.S. We've seen very harsh rhetoric towards NATO countries. They're not sure that Trump is going to pull out of NATO entirely, but he can do a lot unilaterally to make the NATO alliance very uneasy and make NATO ally countries make life for them very difficult.
Equity indices built on opinions? That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
In a world of seismic change, will your business shape the future or be shaped by it? How will we capture the imagination of tomorrow's consumers? Overcome operational constraints to focus on future growth? And unlock economic and social prosperity through environmental responsibility? With EY Parthenon and EY's full spectrum of services, we're reimagining the enterprise to shape the future with confidence.
Laura, exactly. What have we heard from U.S. allies around the world?
So U.S. allies have been very, very skeptical to jump into the fray on this war. We saw them largely rebuff Trump's request to send ships and other assets to the Strait of Hormuz to help open that up. But Trump, recently has been more vocal about that he's will strongly consider pulling out of this NATO alliance. That, I'll note, is something that he will need Congress's approval to do formally, but he can informally, just unilaterally as president, do a lot of things. At front and center is concern about NATO's Article 5, which is essentially that mutual defense pact that if one ally is attacked, then all the other allies will come to their defense. Trump has used this in what some say is a willful misreading, saying, look, if you didn't come to help us in Iran, we're not going to then come help you in the future. Allies have pointed out that is for when someone is attacked versus when an ally launches an attack on another country. But this is sort of a rapid deterioration of what we've already seen, high tensions between Europe and the U.S. Just really on full blast here just in the past 24, 48 hours.
Joe, we're seeing some reporting from Fox News that in the address to the nation this evening, President Trump will inform the American public that the deployment of ground troops may be necessary to end this war and round up highly enriched uranium in Iran. I don't think this is the scenario that markets are currently pricing for. Some of these scenarios President Trump has indicated in the past are going to be too hard or certainly not within the appetite. Is this something that is a possibility, do you think?
I think it certainly is. It's something the president has spoken openly about, getting our arms around that highly enriched uranium. The question is how. The Washington Post had some pretty remarkable reporting today to suggest this could take thousands of troops, an enormous amount of excavating hardware, and in fact the ability to build a runway that once we dig this uranium out of the ground wherever it's hidden, we would have to fly it out in a very sensitive Mission Impossible type of operation here that could put a lot of troops in harm's way. Whether that's something the market is prepared for is a question. We've heard about this before. We've heard about the president's options when it comes to occupying Karg Island and some of the other areas that would require actual troops on the ground. But I'll remind everybody of what the president said late yesterday in the Oval Office. Goal, he said, that's a direct quote. They will have no nuclear weapon, and that goal has been attained. He has been striking this tone recently that the war is already won. So the question is, will he take a victory lap this evening or prepare the American public for a more prolonged conflict?
What is the American public, Joe, ready for at the moment, given, of course, that we're headed towards midterm elections with $4 a gallon at the pump?
Well, you introduce an important part of this story, and I'm not sure the American public is ready for a lot more of that. We had analysts on the air just as recently as today suggest the prospect of $5 a gallon gas if crude oil were to approach $130 to $150 a gallon, which a prolonged closure of the Strait of Hormuz might bring about. But let's remember the president on Truth Social yesterday also allowing for that. He sent a note to our NATO allies saying, one, you can buy the oil from the U.S., we have plenty, or two, build up some delayed courage, go to the Strait and just take it, suggesting that he might withdraw U.S. forces before it's reopened. These are the very messages that are confusing the energy markets today.
Joe, really great to have you with us, and Laura Davison too, who is our Bloomberg Politics editor, our Balance of Power co-anchor there, Joe Matthew with us. Let's bring you Jackie Tang, who's the Emerging Markets CEO at Deutsche Private Bank. So, Jackie, there is a wide range of scenarios there for investors to grapple with, and we were just talking earlier about the oil options markets, where you've got essentially every scenario from $450 oil to a complete breakdown of the crude market being betted on at the moment. There's a lot of risk still, despite the sanguine way that markets are trading today.
Sure. Obviously the past 2 days we have seen a relief rally. And obviously after Trump's announcement regarding the war will be ended in 2 to 3 weeks' time. But of course, to be very honest, there are still a lot of uncertainties in the market whether the war can be really ended in 2 to 3 weeks' time. Of course, everybody is actually expecting, some clarification from President Trump later today. But obviously, at this point, we think that the market volatility will continue to be heightened. And very importantly is that, from our analysis, we actually look at this scenario into 3 different scenarios. So the first scenario we think there's a higher chance of happening is our base case, where we think that there are some potential gradual coming back of energy supply from the Middle East, which will happen in the second quarter of this year. And also with the full normalization, it will take longer. That's our base case. For bear case, which we think that the closure of Hormuz will be much a prolonged period of time, whether it will potentially going into the second half of the year. And if that's the case, oil price will stay elevated with a more than 100, 120 for a prolonged period of time. And if that's the case, we think that inflation will come back much faster, and also potential recession and also stagflation risk over there. And of course, we have a bull case where we think that some gradual coming back of energy supply in the next few weeks. Everything resume normal in the next couple of weeks. That is a bull case. We think a high chance that our base case will happen. And if that's the case, we think oil price will stay elevated at around the current level, at around $90 to $100 for the next couple of weeks and months. And we think that given this particular oil price volatility, we think the geopolitical premium that people are expecting from oil prices will stay there, and the markets are not giving up that geopolitical premium easily, if without any formal deal or formal agreement between the U.S. and the Iranian government. So we think that at this point, in the near term, equity market, financial market will continue to stay elevated. The volatility will stay elevated, and we think that at this point, equity, we maintain a neutral stance. We don't think it is a time to overweight U.S. equity as yet. We stay our neutral stance at this point.
We know there's a lot of losers in Asia, especially in the EM space, but are there opportunities? We know that China is an obvious one where there's quite a bit of protection.
Yes, that's right. So when we actually look at the Asian markets, China obviously is the winner of that, because if you look at the energy consumption mix, more than half of it basically come from coal, and China is the largest producer of coal, so they have a self-sufficiency in terms of energy. The second goes to the alternative energies, including green energy, wind energy, solar energy, etc. And in the latest 15-5-year plan, they are planning to increase that ratio from 21.7% to 25% in the next 5 years. Then they also are going to reduce the carbon emission by almost 20% in the energy consumption. So, which means that they are very emphasized on the alternative energy. At the same time, you can see that the oil part is around 18 to 20% in their energy consumption mix, which means that their reliance on oil, especially on the Middle Eastern oil, is actually not very high. So in terms of that, China, we think that it should do better in terms of the reliance of external energy compared to other Asian countries such as Japan and South Korea. Yes.
Can we expect those economies then also to veer more towards green energy sources? And if that's the case, what would be the investor case for this sector?
Yeah, so obviously, as I mentioned, because right now, after all these Middle East incidents, a lot of Asian countries, they realize that they have a heavy dependence on external energy, especially from the Middle East. So they are thinking about how to diversify further from that energy mix. Of course, China has put an example about diversifying from the oil and coal to those alternative energies and green energies, and we think that the other Asian economies are thinking about the same after this Middle Eastern experience, and they are going to do that in the next probably 5 to 10 years.
How closely are you following the AI theme in the middle of all of this right now? And do you expect still potentially long-term value, given, of course, the sell-off that we've seen with the fragility of the markets recently?
Yeah, so we still think that after this Middle East incident, we think that when the market go back to normal, they are thinking back about the long-term investment theme and the fundamentals. AI will still be the major driver of the economy and also the financial markets. So, so we think that AI is still a structural boom in the next couple of years and will continue to drive earnings and also economic growth. And of course, with this, there are different stages of AI. And we think that the AI is still, looking at valuation, looking at earnings growth. We are still in the kind of beginning and mid cycle, not the end of the cycle yet. So we think that, after all these incidents from the Middle East side, when the markets normalize, AI will still be the major investment themes for investors in the next 1 or 2 years.
Jackie Tang, good to have you with us, Emerging Market CIO at Deutsche Private Bank. Coming up, NASA has launched 4 astronauts on historic mission, sending humans closer to the moon than at any time in more than 50 years. The details next. This is Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
Right now, the headline, bad news is bad news.
This is a stagflationary mix.
It's a double squeeze for the rest of the world.
Today, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
The market is tightening financial conditions.
It's not just what's happening present day. It's 5, 6, 7 months out.
The longest first quarter ever continues.
The March Jobs Report, today on Bloomberg.
Booster ignition. 2, now bound for the moon. Humanity's next.
Good roll pitch. Roger, roll pitch.
Seeing astronauts reaching safe orbit in what is a historic moon mission. They're blasting off on a 10-day mission that will send them around the moon, marking humanity's return to the lunar neighborhood for the first time in more than 50 years. Bloomberg Tech co-anchor Ed Ludlow joins us now live from the Kennedy Space Center in Florida. And so this is a significant moment, particularly when it comes to the broader kind of context of the US's ambitions to retake space.
Equity indices built on opinions, That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
Yeah, Artemis 2 is the dress rehearsal. The bigger plan and goal is for the technology that has put that crew of 4 astronauts currently in a safe orbit above Earth, on a path to the moon. The ultimate goal is to land on the moon as early as 2027. So in this mission, it's a 10-day mission. The crew of 4, 3 Americans and 1 Canadian, initially spend 2 days in sort of an elliptical orbit of Earth before doing what's called a translunar injection, a burn that puts them on a slingshot to the far side of the moon. That's 250,000 miles away. It's a 685,000 mile round trip. And the context is that this is something that humankind, but America and NASA hasn't attempted to do since the Apollo era, more than 50 years ago. And the geopolitical context is that China wants to do the same thing, right? China has a stated goal of getting to the moon's surface by 2030. So NASA's been accelerating. And this mission over the course of the next 10 days, proving out their existing plan as a step, is critical in that international race.
This a dress rehearsal for an eventual moon landing. So what will the astronauts be doing this time?
Yeah, initially in that low Earth orbit that the crew are in now, and there are stages of it, the crew's pilot will take control of the Orion spacecraft. To prove that it can be manually maneuvered and piloted, but also that the ultimate plan over a series of Artemis missions is to have Orion be able to get to the moon in a combination of technologies, right? One of the things we've reported is there's a proposal on the table from SpaceX that Orion docks with Starship, SpaceX's next generation rocket, in low Earth orbit, and Starship basically pushes it to the moon, which like literally pushes it, which is kind of crazy. It's like driving a Ferrari backwards. But they need to prove that the space capsule part of it works. And then on the far side of the moon, that crew and that capsule is going to lose contact with NASA because the moon's in the way. And so they need to plan and prepare and execute tests of what that would be like, you know, if the crew is on their own and they lose contact. That's all a part of the plan.
We also had some big news when it comes to this highly anticipated SpaceX IPO.
Yep, S1, filed confidentially. Sources told me that it went in last night, so about 24 hours ago. You know, it's procedural. You know, when a confidential filing takes place, the SEC has time to examine it, talk with the company. They can propose changes before they go back and file the S1 more fully. But what we keep hearing, and what's most important, is that this is a clear signal of chronology and timeline, and it would put SpaceX on a path to IPO in June. Right, and they've put all of the work in place for that. The banks have been working on it very hard, but the target's to raise $75 billion at a 1.75, maybe up to $2 trillion valuation. So there's a lot to pull off in the markets here.
More tech co-anchor Ed Ludlow there, reporting from the Kennedy Space Center in Florida, where also we are now getting that news conference on that launch. More ahead on the Asia trade. This is Bloomberg. Take a look at how Samsung and SK Hynix are trading early in the Asia session after we saw Samsung seeing its best day since 2001, not surprising firm memory prices in March, really showing that the AI cycle is still intact, which led to a jump in SK Hynix shares as well. Local media now reporting that they're mulling a buyback and a cancellation of shares worth 15 trillion won with the proceeds after they raise it from their U.S. listing. Of course, we had seen a confidential regulatory filing on that, Heidi.
Take a look at some of the corporate headlines that we're tracking, Sherry. And the Australian market regulator has released its final report into ASX, concluding that the exchange operator's risk management and compliance practices need improvement. It also found that the ASX's monitoring, supervision and enforcement of operating and listing rules require more attention. ASX Chair David Clark says the ASX report makes for tough reading, but the operator accepts there is more to do and is taking action. Hyundai is stepping up its US push, unveiling a rugged SUV concept and confirming plans for a US-built mid-size pickup. The South Korean automaker says body-on-frame vehicles will be central to its American strategy, with the pickup aimed to launch by 2030. Hyundai is betting big on the US market, pledging $26 billion in investments through 2028. Stellantis is said to be discussing options for building electric vehicles in Canada with its Chinese partner Zhejiang Leapmotor. Bloomberg has learned that those talks are still at an early stage. If the companies proceed, it would be the first major Chinese auto investment in Canada since the countries agreed in January to reduce tariffs on Chinese-made EVs. More ahead.
10 years ago, Illuma Capital set out with one goal: to help people like you build a legacy for tomorrow. Through personalized strategies and unwavering dedication, we've been instrumental in helping our clients achieve their financial dreams, whether it's securing retirement, growing wealth, or planning for the unexpected. For a decade, we've been trusted to guide your financial journey. Expertise and care. Visit illuma.co.za today. Illuma Capital is a licensed FSP. T's and C's apply.
More ahead here on the Asia Trade. This is Bloomberg. We do have Australian trade numbers just crossing the Bloomberg here. When it comes to the exports number on a month-on-month basis, we're seeing upside of 4.9%. Imports are contracting by 3.2%. All of this, of course, in a deeply uncertain environment, given that we don't really know the outcome when it comes to the Iran war and the outsized impact, particularly when it comes to the Australian economy. The trade surplus, though, coming through for February at $5.686 billion, wider than the expected $2.85 billion. That was the estimate. We do know that for a number of key export commodities, including agricultural items, the likes of beef, it is set to be a bumper year. We know that given the elevated LNG and gas oil prices, that energy exports have been looking at a record quarter as well. All of this, though, not removing the economic uncertainty for Australia. The Prime Minister, Anthony Albanese, giving a rare address to the nation, warning of tough times ahead due to the war.
The months ahead may not be easy. I want to be upfront about that. No government can promise to eliminate the pressures that this war is causing. I can promise we will do everything we can to protect Australia from the worst of it. These are uncertain times, but I'm absolutely certain of this. We will deal with these global challenges the Australian way, working together and looking after each other.
Bloomberg's Paul Allen joins us now with more. The fact that there was a national address, I think, created a lot of anxiety, more than the messaging itself.
Yeah, very much so. There was a meta aspect to this because we knew that address was going to happen about 8 hours before it did. So a lot of hand-wringing about whatever could this be. Turned out to be a lot of reassurance, really. Don't panic, buy fuel, take public transport, remain calm, have a good Easter. Yeah, pretty much. So it did leave the opposition parties, a lot of commentators sort of scratching their heads, but in many respects it did allow the Prime Minister to get out in front of this crisis and say, look, we've got this. There was a number of other things that happened around the same time as well. The Deputy Prime Minister, Richard Marles, was asked if there was going to be fuel rationing after Easter. He said, look, it isn't inevitable, but the situation is unclear, and the situation is unclear. 2 hours before Anthony Albanese made that speech, Western Australia announced it was going to announce emergency powers to force oil companies to disclose supply movements so it can better direct fuel to where it needs to go. And the Resources Minister, Madeleine King, also said the government's going to consider the use of the gas trigger, which would make sure that enough gas is held in Australia for domestic supply over the coming winter.
We're also expecting to hear from the PM again today.
We are. Any minute now, he will be making a speech to the National Press Club in Canberra. That's about a 90-minute long event. It includes lunch, so we'll wait and see when he starts talking. But he is expected to announce $1 billion worth of interest-free loans to businesses. That's about $700 million US. That'll be supplied through the banks, should be available in a couple of weeks, and he's likely to repeat his call that citizens should save fuel. But we've had a few measures already. There was the halving of the fuel excise to 26 cents. That's going to mean a $2.5 billion hit to the budget. The Treasurer, though, says, look, the budget is still going to be ambitious. We'll sort of get this slow traditional reveal that we usually get ahead of budgets in the next few weeks, ahead of that May delivery. But it's not all doom and gloom. The budget is likely to be supported by some of those higher commodity prices we've seen.
Paul Allen there joining us from Sydney. And of course, we're following also the war in Iran and the fallout on other economies, perhaps also creating an opening for Beijing to present itself diplomatically as the defender of the rules-based international order. At the same time, the shock to energy markets could also offer significant economic opportunities for China. That's according to Bloomberg's senior geoeconomics analyst, Adam Farrar, who joins us live now from Washington. Adam, good to have you with us. So we have been talking about how China could be a little bit more insulated when it comes to the Iran war because their economy is more domestically veered, also when it comes to their energy landscape. How are you seeing Beijing potentially taking advantage of this situation?
So I think the first thing we have to take into account is the fact that Beijing is not excited about the situation they're facing right now, right? I mean, there's real risks to in the long run for the economy if this war drags on. But in the meantime, there are these tangible opportunities that are emerging. And in addition to energy, which we can discuss in a bit, I think diplomatically, there is a real opening here that Beijing has been seeking to take advantage of, building on the narrative they've been pushing the entire time the Trump administration has been in office, articulating this narrative that it is Beijing, not the United States, that is here to bring stability to the world and as you said, defend the rules-based international order. Obviously, many would take issue with that assertion, but with the United States taking actions on trade, more militaristic actions, obviously against Iran, but also against Venezuela, there are questions, particularly in countries getting hit really hard, about whether it is the United States that stands for stability and is willing to defend and work with its allies.
Beijing would love to bring an end to what it calls US hegemony, right? Can it do that? Because as you say, we've seen President Xi, we've seen the leadership really posturing for that diplomatic leadership role with the likes of Ukraine, for example. But is it actually able to play a role as an intermediary at this point?
So there's a real question mark here. Beijing, as you've stated, has constantly raised that narrative as a possibility that it could be a key peacemaker in the world, but has so far not really taken up that mantle. But here, when we're looking at the Iran situation, there is a rare moment where a confluence of factors raise the potential for them to step up. The most obvious being the fact that they maintain good relations with not only Iran, but the Gulf states. And simultaneously, that the future of the Strait of Hormuz in particular has a direct impact on China's core interests through the flow of oil and natural gas. And so with the United States indicating and the president seemingly saying that he's willing to end the war at some point without reopening the strait potentially, there is this opportunity that Beijing could step in as an intermediary to try and formulate a new plan for how the strait will operate moving forward and get gas moving again.
Does this also put President Xi Jinping at a stronger position vis-a-vis President Trump when they actually meet next month?
So I think a lot of that will depend on how the war progresses and how it ends. But overall, I would say it is a factor, but not a determining factor in how that conversation will go. The driving elements of the discussion remain the trade relationship between the United States and China, particularly when it comes to U.S. tariffs and whether or not the U.S. will increase those tariffs back to the rate they were before the Supreme Court knocked down some of Trump's authorities. And the question of export controls, particularly on the U.S. side, the sale of semiconductors and other advanced technology, and on the Chinese side, critical minerals, which are essential to a variety of technology around the world, and had a big impact in the United States when China chose to implement its original export controls last year.
Adam Farvar, good to catch up with you. Bloomberg Economics Senior Geoeconomics Analyst for Asia Pacific there. And here are some of the other top global headlines that we're following. The Trump administration reportedly preparing to overhaul its steel and aluminum tariff policy. The Wall Street Journal says officials are considering a 25% tariff rate on finished products made with imported steel and aluminum. This would replace the current system, which imposes a 50% duty only on the value of the steel or aluminum used in a product. The Trump administration is also said to be planning tariffs on drug makers that have not struck deals guaranteeing low prices in the U.S. Sources say companies that don't have agreements with the administration will be subject to 100% tariffs. President Trump has been threatening tariffs on the pharmaceutical industry to cut drug prices for American patients. The U.S. Treasury has removed Venezuela's acting president, Delcy Rodriguez, from its sanctions list. The move comes as the Trump administration seeks to rebuild ties following the capture of Nicolás Maduro earlier this year. Officials say the step is part of a broader effort to revive Venezuela's economy and encourage a political transition, allowing U.S. entities to do business with Rodriguez.
Coming up on the Asia Trade, with President Trump set to address the nation on the war with Iran in just about 20 minutes' time. We'll get a preview with the former U.S. ambassador to Iraq and Kuwait, Douglas Silliman. This is Bloomberg.
What President Trump has signaled in the last day or so is that it's not our problem. The Strait of Hormuz is Europe's problem or Asia's problem because they're the ones who buy oil that passes through the Strait of Hormuz. But he seems to neglect the fact that oil is priced globally, and just because we produce it in the United States doesn't mean the impact of a continued closure is going to have an impact on the global economy and oil prices, even for Americans.
The former U.S. ambassador to Saudi Arabia, Michael Ratney, with his take on what happens if the U.S. military pulls back without reopening the Strait of Hormuz. Well, as we await President Trump's speech on Iran as he addresses the nation in just about 20 minutes' time, let's bring in Douglas Silliman, who's a president of the Arab Gulf States Institute. He previously served as the U.S. ambassador to Iraq and Kuwait. Really great to have you with us. And I know that, we obviously can't see into the future, and it's always difficult at the best of times to work out what the strategy is in this war. But I do wonder, given that some are saying this will be a victory lap, he's given that 2 to 3 week timeline already, but now we're hearing reporting that he could be talking about troops on the ground and some sort of strategy to remove the highly enriched uranium. So what do you think we're going to get from this address?
I'm very happy to be back on Bloomberg. Thank you for having me this morning. What I imagine that President Trump will lay out, although I have no idea what the specifics will be, is a pathway for an end to the war, at least from the standpoint of the United States. And I'll note that this week, Secretary of State and National Security Advisor Marco Rubio produced a video on social media that laid out 4 very specific military criteria that the United States was seeking in the conflict with Iran, which were destroy the Iranian Air Force, destroy the Iranian Navy, significantly damage the ability to launch missiles and drones, and destroy the factories that produce these weapons. Missing from that list was regime change, popular uprising, an end to support for proxies, or opening the Strait of Hormuz. So I think that President Trump will be experimenting with how he can politically sell an earlier end to the war to the American public and how they can define this as being successful for the United States.
Doesn't sound like there's a great deal of good faith, if there can be, in this sort of situation. You've said that the key lies with negotiating with Tehran. There's reports that the leadership or the replaced leadership there is not taking US diplomacy very seriously at this point.
Well, again, I think that the leadership there is new. They are untested. They have not been intimately involved in the previous sets of negotiations with the United States. And the previous set of negotiations in June of last year ended with Israeli and American attacks on Iranian facilities, including the big American attacks on Iranian nuclear facilities. Mojtaba Khamenei, the supreme leader, really hasn't appeared, and we're not entirely sure what role he plays. It is more likely that Iran is being run by a group of senior members of the Revolutionary Guard and the military and the Speaker of the Parliament. So I think that right now the Iranians want to feel out President Trump, and frankly, they are feeling in a strong position despite the destruction that Israel and the United States have brought to Iran. Iran has been able to essentially increase its leverage in negotiations by shutting down the Strait of Hormuz. And even though that may be not on the president's list, this is something that does not appear to have been seriously considered in Washington or in Jerusalem when the war was launched a month ago.
Right. We heard from an earlier guest this week that Iran, being a weaker power, using such insurgency tactics and just outlasting and surviving in the war and dragging it out could actually be a victory in itself. So to that point, how much of a true off-ramp can we expect coming only from the U.S. side?
Well, I'm not sure that there's going to be a true off-ramp that President Trump is going to deliver tonight. His remarks will be directed at the American public, his political supporters, and the doubters in the American public who have opposed his launching this war. Where I think you can look for off-ramps will be in discussions between the group of foreign ministers from Egypt, Turkey, Pakistan, potentially with some Chinese engagement, possibly also at the UN Security Council, where there is a draft resolution being worked on that would call for the reopening of the Strait of Hormuz, along with an end to attacks. Thus far, it sounds like both China and Russia would like to veto that resolution if it goes forward as an obligatory Chapter 7 resolution, but I'm sure there is more negotiation to be had. So the international community and the community in the fringes of the Middle East seem to be working to construct a more concrete way out that hopefully the United States and Iran and Israel will all be able to take.
And really, when it comes to Gulf states, Ambassador, it's just from the UAE that we're hearing any explicit signaling when it comes to coming to the aid in maritime security operations, for example. How much of a conundrum is this for these Gulf countries, and not just with the conflict ongoing, but what happens after the war ends, together with the relationship with the U.S. and its neighbor Iran?
Well, I think that the Gulf states have slightly different relations with Iran and different ways that they would like to approach this going forward. Frankly, Iran has gotten a great deal of benefit out of illicit trade through the port of Jebel Ali and other ports in Dubai in the UAE. And I think the Emiratis have been absolutely dismayed that the UAE has taken more missiles and rockets and drones than any other country, including Israel. They feel somewhat betrayed by Iran, with which they have tried to work for a number of years. For the Saudis want to make sure that they can continue their own domestic development programs, and they do not want a conflict with Iran. But they are also concerned that whatever is left in Tehran as a government not be more radical, not be more militaristic than the one that they have had such trouble with for the past 47 years. So there is real concern in the Gulf that this war may end and leave Iran strengthened and with the blockage of the Strait of Hormuz with new and different leverage than Iran has ever had before. So there is real concern, and I think you will see support in the Gulf for a diplomatic off-ramp, But you will also see a support for a quicker opening of the strait and more restrictions on Iranian missiles and really restrictions on Iran's support for militant proxy groups in the region. And that's what the Gulf is really going to press for.
We started out this war talking about regime change, right? And I know that you were US ambassador in some of the years following the Iraq war. What do you think the groundswell of sentiment would be like right now? And if there were to be ground troops deployed in this conflict, what are the risks that you could see?
Well, given the number of American forces that are in the region and available for some sort of ground operation, it would not be a major ground operation on the scale of the Iraq War in 2003. It would more likely be special operations, the sort of thing that you saw in Venezuela, relatively quick in and out operations that would take down particular targets and try to reduce Iran's capabilities to exercise specific military ends. There has been some press discussion of a possible much longer, more detailed, and more massive operation to try to remove the highly enriched uranium from Isfahan and other potential places in Iran. I think that the United States is not ready, does not have the forces in place for that yet. But if the discussions with Tehran do not end with some sort of a discussion or ending of the nuclear program, new IAE inspections, or the removal of the nearly 500 kilograms of enriched uranium, this may become a more viable option in the future for the United States, even though it would be difficult, expensive, and probably full of casualties.
Ambassador, thank you so much for your time. Douglas Elliman, president of the Arab Gulf States Institute, of course, as we head towards President Trump's speech in less than 10 minutes, addressing the public on the Iran war. And we're also keeping our eyes firmly on the AI trade. We're seeing some downside and a little bit of a mixed picture across semiconductors. Bloomberg has learned that OpenAI shares have fallen out of favor on the secondary market, with investors pivoting to Anthropic, its biggest competitor. So do watch out for that AI narrative playing out still in the markets. This is Bloomberg. We're now minutes away from President Trump's primetime broadcast address on the Iran war. According to a White House official, Trump is set to repeat his timeline of 2 to 3 weeks for an end to U.S. military attacks. Let's bring in Bloomberg Balance of Power co-anchor Joe Matthew. And Joe, the stakes pretty high for this speech, given that we continue to get conflicting signals on where the war is headed.
Well, that's for sure. As we understand, the president will provide an update on the war so far and take a bit of a victory lap in some of the progress that's been made, at least militarily speaking. Politically speaking, it's a very different set of challenges for the president this evening. It's not very often that he invades people's living rooms in the United States in prime time. This is going to be 9 p.m. local time here on the East Coast, with people who might have their minds on other things, including $4 a gallon gas, which is now our reality on an average nationwide here in the United States, having seen enormous increases in oil and gas prices since this all began. So it's likely the president will try to balance the strategy, the objectives here in Iran with an acknowledgement of the affordability issues here at home. But I'll remind everybody that just yesterday, the president said the U.S. has already achieved its primary objective, and that's eliminating the nuclear threat from Iran. He said, we'll be leaving very soon. I had one goal. They will have no nuclear weapon, and that goal has been attained. Some of the optimism on Wall Street, some of the hopes to see an off-ramp here are based on that type of rhetoric, and we'll find out if he follows through this evening.
Yeah, and whether that means, what it means for the highly enriched uranium, right? Because there's reporting suggesting that that is still the goal, that potentially we could hear about ground troops being deployed as well, who are already in region.
Well, we'll see if that is the case, because it would take hundreds, if not thousands, of troops to secure that highly enriched uranium. According to a report in the Washington Post, it would involve excavation equipment and the building of a runway. Once that very sensitive material was lifted from underground, would have to be flown out of Iran. So force protection would be the real story there as we put men and women in harm's way It's unclear that the president will speak to ground troops this evening, but he has certainly kept these options on the table, whether it's for finding that uranium, seizing Karg Island, or actually lining the coastline to reopen the Strait of Hormuz. And that's going to be one of the big questions tonight. Is the president ready to withdraw or accept a ceasefire in lieu of the strait being open? The energy markets are listening very closely.
Joe Matthew, our Balance of Power co-anchor there as we head into, in the next few minutes or so, we will be hearing from President Trump. That's it for the Asia trade, but do stay with us. A special live coverage of the president's address to the nation is coming up. The China Show is next. This is Bloomberg.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Now, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. President Trump has once again extended the deadline for Iran to make a deal or face more attacks on its energy sites. Now, the Wall Street Journal reports that Tehran had not sought a pause in strikes. The president spoke to Fox News earlier.
I gave them a 10-day period. They asked for 7. You're going to say, oh, Trump's a terrible negotiator. They asked for 7. And I said, I'm going to give you 10 because they gave me ships. We talked about the 8 ships, the president that I talked about the other day. But they asked for 7 and I gave them 10. You got 10 days. And they were very thankful about that.
Well, let's bring in Laura Davison, Bloomberg's Deputy Washington Bureau Chief. Laura, the extension allows more time for talks, but do we even know who's talking to who?
We don't. This is still continuing to be a very nebulous process. There are mediators involved, both in Pakistan and in Egypt, who have been sort of talking with both sides, but it's unclear that there's any direct talks happening with Iran and with the U.S. Trump now has given 3 different deadlines, a 2-day deadline, a 5-day deadline, and now a 10-day deadline to extend these talks, which indicate that he is not super keen on following through on the initial threat that started all of this, which is striking energy infrastructure sites within Iran. Those would have long-lasting problems for the region that would extend long beyond this conflict. So that appears to be a bridge too far. But whether there is a peace deal or at least a ceasefire deal imminent does not at all seem clear. And Trump's continuance to extend those deadlines suggests that that the U.S. is not confident that something's going to come together imminently.
So, Laura, the delayed timeline also gives the president extra time to amass extra forces in the region.
Yes, this is, the U.S. has announced several successive waves of additional troops. Earlier in the week, there were about 5,000 Marines that were deployed, another 2,000 special troopers from the 82nd Airborne Division. The Wall Street Journal is now also reporting that the White House is considering an additional 10,000 ground troops. So all told, that would be about 17,000 additional forces in the region. It'll take some weeks for all of those folks to get there, and particularly if the U.S. decides to move forward with that last batch of 10,000. But this, suggests that the military options are not foreclosed at all if the U.S. is going to all of these lengths to bring new people in. This, of course, Trump has been talking about some sort of peace plan, a deal, but the military seems to be preparing for more expansive ground strikes.
Laura, turning to what's happening at home, the Senate has cleared a path towards ending this partial government shutdown, which has caused, and we were looking at the images, really lengthy airport delays.
Yes, this is a deal that passed in the middle of the night in the Senate. It will then have to go to the House and to President Trump for his signature. This would essentially open up the airport security and make sure that those folks get paid, which have led to historically long delays at airports. People waiting 4, 5, 6 hours to pass through airport security. It could still take some days, if not weeks, for this deal to get passed. But it would mean that the U.S. government would be operating largely with a budget intact. I'll note this deal does not fund ICE and Border Patrol. The Republicans and Democrats decided to separate that out and fund that at a later date. However, most of those agencies are still continuing to operate at a certain level because they have extra funds that are outside of what Congress needs to appropriate.
Laura, thanks so much. Laura Davis, and there, Bloomberg's Deputy Washington Bureau Chief. Now let's discuss the Iran war and the impact it's having on global markets. With us now, Henrietta Packman, Fixed Income's Chief Operating Officer at Allspring Global Investments, and Phoenix Callan, Global Head of Emerging Market Research at SocGen CIB. So thank you both for joining us. I mean, I think that the general theme is how do you navigate all of this volatility? Phoenix, maybe let's start with you. Yesterday, we had a good panel on emerging markets. I mean, it's a bit of a nightmare, actually, especially in the emerging market FX space. I think it was only this week that we spoke to the Philippine president, who said, look, there's not worth spending too much money in propping up the peso, because actually what we're seeing will drive investors to the dollar, so it's futile. I mean, is that across the board?
It's not across the board, but there are certainly many vulnerable economies, especially out of Asia, who are so sensitive to high oil prices and to shortages as well. They have very limited days cover in terms of the reserves that they have to kind of supply their industries. So they are in severe stress, and we think that will be focused on a number of names in the region versus other parts of EM.
But you agree with his general assessment that actually it's not worth propping up right now, and what other countries would you worry about?
Yeah, so outside of the Philippines, we would worry about Thailand as well, India as well, South Korea and Japan. Those are also huge importers of oil, especially from the Straits, and they do have more reserves, but they are going to meet those kind of limits relatively soon. Lots of countries have less than 30 days of reserves left.
Henrietta, I mean, and again, how do you know, in fixed income space, it's kind of the same. It's like there's just a lot of volatility out there. So how do you navigate that?
Correct. I mean, we're seeing incredible volatility day to day. And I think one of the striking things is just the velocity of the market moves as soon as we hear elements of news and how fast it changes. That being said, if you look over a sort of slightly longer period, there are some trends that are starting to appear. Obviously, we're sort of seeing higher rates. We are seeing sort of spreads ratchet up in a normalized fashion, but we are seeing those widenings.
Where do you see the best value in fixed income?
So if you look at what we've been doing, we actually started the year reasonably under-risked because of where spread levels were, and that set us in good stead. So we have been squaring off our portfolios, focusing on diversification, focusing on income, and also nibbling at certain areas of the market where we've seen spread widening.
I mean, to both of you, and maybe we start with Phoenix, how do you actually, attach probabilities to outcome? Because we don't know if there's a ceasefire. We don't know how long is the ceasefire. We don't know about negotiations. So is it scenario planning without attaching real probabilities that guide you to what to do next?
Yeah, so it's a lot of scenario planning. Our commodities research team has put out lots of notes, very detailed notes on this. And their baseline scenario, which had been previously, de-escalation by the end of this month, as we move into April, they will have to shift that base case into not just kind of the mild alternative scenario, but the most bearish alternative scenario, where we are expecting for that paradigm shift in energy markets to occur. Brent prices go not from like the 100 type levels per barrel to 150 per barrel in April. So that's what we're expecting as kind of the next phase, and the market is going to drastically react to that, because that's a whole new paradigm, and that's a world we haven't actually been in.
Yeah, and this again, are you expecting a repricing, which the market hasn't quite latched on? I don't know whether there's an optimism in the market, actually, that's quite, difficult to get rid of.
I mean, it's a question of time, right? And we said that at the beginning, if it's a short event, then it's okay. But the longer it lasts, the more difficult it becomes. We're now pretty much a month in. We're starting to sort of hit some of the longer scenarios at this stage.
We also have, Phoenix, this headline in the last 20 minutes or so, China starting retaliatory trade probes against the U.S. I mean, the timing of this, given President Trump is actually, going over to meet President Xi, what does that indicate?
Well, I mean, the timing in terms of like the May 14-15 kind of summit seems to signal that Trump wants some kind of ceasefire, de-escalation, some kind of deal reached before he has to meet with Xi and negotiate all of these trade and tariff things. So I think the market is latching on to that, as thinking, okay, there is kind of something on the horizon to alleviate some of these pressures. But at the same time, we are seeing such massive amounts of U.S. troops gathering in the region, and that opens up the possibility for much further escalation.
Phoenix, I get asked actually almost on a, maybe not daily, but, twice weekly basis, whether this is all a play against China, so that, the Trump administration went to Venezuela to make China mad, whether they're doing Iran because they buy their oil and that would put them in trouble. I don't know how, if there's any truth in that, but also how you see these two countries getting along in 2026 overall.
Well, yeah, and this year and for the years to come, there's been this huge theme around reindustrialization in the U.S., which means then that it's so much about the commodities play, securing resources, whether that's in LATAM, whether that's in the Gulf. The U.S. is going after it and wanting to get those commodities, those resources necessary for the revival of manufacturing. So I think this is a long-term theme.
Henrietta, what are treasuries today? Again, we were talking about a move away from U.S. assets. I don't know what this new war, but also geopolitics mean going forward.
It is an interesting discussion, and we have seen some diversification away from the U.S. That being said, it is a huge pool of assets, so it's actually quite hard even for international investors to sort of move away fully from the U.S. So I think it's what investors are doing with incremental allocations that they have. They may think twice before allocating to the U.S. And if you look at what's happening on the Treasury side, you've got a number of dynamics at play. Obviously, you've got what's happening in the Middle East at the moment, and that it's inflationary potential. So we're seeing some of that. We are sort of seeing issues on the budget side as well, right? So that is also playing on the Treasury piece. So a lot of dynamics coming into play.
I mean, which central bank has it hardest? I mean, no one has it easy, okay? So that's our basis. Yeah. That's our starting point. But is it the Bank of England?
I think it probably is the Bank of England, to be honest. Why? Because the UK is such an open economy and is a little more subject, because of its size, to be pushed around by the markets.
And we've seen this huge move in gilts more than others. I mean, when does this really become problematic?
I think it probably already is problematic if you look at where levels are now. The economic growth picture in the UK was starting potentially to improve. It really didn't need the crisis that we have now. So I think it is definitely not helpful.
I mean, I imagine both of you spend quite a lot of time thinking about inflation, right? Even if there is a ceasefire tomorrow, what happens to inflation? Because it takes a longer time to readjust some of the oil flows. We don't exactly know how much damage also there is in some of these infrastructures.
It's going to be quite different across the economies. For places like Egypt and Turkey, they are going to see huge inflation spikes in the short term because of how sensitive they are to commodity prices, to oil prices, and how that sensitivity actually has accelerated over the past 10 years because of their various devaluations. So some countries are much more vulnerable and will see much higher prices. CE region, relatively contained in terms of a short upward pressure on CPI, but broadly going to stay within the forecast range.
So obviously the energy side is the one that's sort of hitting the news the most. One thing we're also keeping an eye out on, and that's also the sort of question of time coming in, is the whole agricultural picture and fertilizers and what that means for the growing season. I think that is something that is sort of maybe a little more under the radar at this point in time, but I do think that the longer this stays, the more it becomes an issue.
And this is an issue across the board, or again, are there countries that are more vulnerable, or how do you look at it from a credit perspective?
So obviously there's some countries that are going to be more vulnerable. I think it also depends, when the sort of growing seasons and the planting seasons happen. So you sort of have to sort of follow that across the globe. But it is something that is likely to start hitting in the next few weeks.
I mean, to both of you, there is a lot of people are overwhelmed by the pace of news. Is there a data point that you look at to give you a good indication of what we should be watching out for? Is it comments from the president of the Philippines or things like that really help you inform where the market is going that is different from previous crises?
Yeah, it's anecdotes about what's actually happening on the demand side and whether we have some kind of demand collapse in response to the supply shock. So I think those indications about what's actually happening with airlines canceling flights, governments announcing that Wednesday is going to be national holidays going forward, kind of thing, to curb energy consumption. Yeah, those things are quite important to see how countries are actually reacting.
Yeah, you, Henrietta?
So I think one of our focuses is really on the sort of portfolio construction and how we create portfolios that are going to be resilient and able to deal with volatility. I think that's one of our big focuses at the moment. So making sure that we've got income, so that we have that income protection, being thoughtful about what we're doing from a duration perspective, and as I mentioned, really sort of thinking about the diversification piece as well.
I mean, we're focusing so much on the war, and inflation. Does the partial government shutdown in the U.S. and the possible alleviation of that change anything?
It's helpful, right? But I think what we're also being careful about is thinking about other themes, right, that we need to have in mind in our portfolios. I'm thinking AI, and these are sort of longer-term effects. You can't forget about those, despite all the noise in the news.
And private credit. Thank you
and
both.
Private credit.
Thank you both for joining us. Henrietta Packman, Fixed Income Chief Operating Officer at Allspring Global Investments, and Phoenix Callan, Global Head of Emerging Market Research at SocGen CIB. Coming up, U.S. Secretary of State Marco Rubio joins his G7 colleagues to discuss reopening the Strait of Hormuz. We'll talk about that next, and this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse, and I'm Francie Lacqua here in London. Now, U.S. Secretary of State Marco Rubio is in talks with G7 foreign ministers in France. Rubio says it's in the G7 nations' interest to reopen the Strait of Hormuz. Well, let's go back to Oliver Crook, Bloomberg's chief Europe correspondent, who's in Vaux-de-Cernay. Hi, Ollie.
Yeah, that's right, Francine. Before G7 foreign ministers who are gathered here, we should say the Saudi foreign minister is also here. The issue of Iran is front and center, and sitting behind me in that room, you have Marco Rubio discussing with the other allies. Standing right next to me is the voice of French foreign policy, is Pascal Confavreux, who is the spokesman for the French foreign ministry, the host of this meeting. Thanks so much for joining us.
Thank you.
In these conversations that we're having now with Marco Rubio, what information do you need to get from the U.S. Secretary of State?
You know, the G7 that was invented 50 years ago, a stone's throw away from here, has two goals: is to create a cohesion between the leaders and to have results. We want here a G7 of results on cross-cutting threats and also the big crisis internationally, namely Iran and Middle East, and second, of course, Ukraine. So that's exactly what they're going to discuss during the whole day behind these doors.
And Emmanuel Macron has been fairly deft in sort of hedging himself on the war in Iran, originally saying that the French will have no involvement, but being very quick to say that there should be a role of the French and others, coalitions, to open up the Straits of Hormuz at the appropriate time. We now understand there's discussions of more than 30 countries. Can you talk to us about how far those discussions have progressed and what this coalition of the willing is willing to do?
So it's the coalition of the willing is more for Ukraine, but you're right. It's also another kind of coalition of the willing. There are consultations taking place at the level of the chief of staff of the armed forces yesterday, including European members, regional members, and also extra-regional members states such as India or South Korea. These consultations are extremely important to see how such a mission could happen, being in mind that it would take place after the end of the bombing first, and not to be to be only in a defensive situation. So we are going on this first step. There is a second step, which are the discussions at the United Nations now.
And you say after the bombing, but of course wars don't necessarily end completely cleanly. What conditions would have to be in place for the French to join in on such a mission?
We are preparing such a mission with all the willing partners, but we have made very clear that this war is not our war, and we don't want to be entangled into it.
And you talk about cross-cutting threats. There's going to be an effort in that room right now as we speak to link the war in Iran to the war in Ukraine, saying that the battle lines are clearly drawn and that Russia is on the other side of that line from the United States. Is that a successful message, you think, to the Americans?
We think that there was an important cooperation between Iran and Russia. Iran has been also condemned and sanctioned at the European Union level for helping the Russian aggression of Ukraine during these last weeks and months. The Minister Jean-Noël Barrot has been part and parcel of this effort, and we have all reasons to think that this cooperation continues to exist between Russia and Iran at present, and that it can indeed hit assets that Iranians are targeting at present.
And I'd like to discuss the path forward for Ukraine, because we're reaching a sort of critical moment for Ukraine. There's a sort of fiscal cliff for the Ukrainians in terms of funding. That 90 billion euros has been blocked at the European level. There's now reporting that American hardware, military assets are being rerouted to the Middle East. How do you see the situation in Ukraine progressing?
So first, it's not what's happening in the Middle East that will make us forget what's happening in Ukraine. Second, if you look at the situation on the field, the Ukrainians are doing actually well. We also that they would be ended up in 4 weeks. It's now 4 years that their bravery is taking place day after day. And third, we stand shoulder to shoulder with them. The European Union has is now by far the first provider of help, both economically or militarily. You said it. We have a 90 billion plans that is not adopted yet, but that will be, and we are totally sure of that, adopted in the days and weeks to come. And we will find solutions for the very short-term short-term needs that you are talking about.
And I also want to get your reaction to some reporting we've seen from the European foreign ministers' meetings, where we've been hearing that the Hungarians have been briefing directly to the Kremlin after those meetings, and there hasn't been really any sort of formal objection to that fact. Do you believe that that is the case? And if so, what should the Europeans be doing? What should France do about that?
Well, we take that very seriously. I don't want to make political comments about it. What we want to state once again is that there have been 19 packages of sanctions. And these packages of sanctions adopted by the European Union, they have been adopted at unanimously. So you show how united also we stand, and united during the long run, because it's been 4 years that we've been into it now.
And I also want to get your perspective on how advanced the talks about nuclear deployment of the French nuclear umbrella. Obviously, there was a very big speech by Emmanuel Macron a couple of weeks ago in front of that very impressive submarine, talking about potentially deploying French nuclear assets to other European nations. How advanced are those conversations?
There has been a very good welcome by our colleagues of the member states of the European Union on that speech. It's called Advanced Deterrence. That was proposed by our president, and so these talks are now ongoing with 7 and 8 countries, and they are going in the right direction.
And you elicit the sort of birth of the G7 format was a stone's throw away from here in Rambouillet, as I recall, about 50 years ago. But since then, now you have the Trump sort of foreign policy that's sort of blowing up that multilateral sort of trade structure. Where do you see the sort of format of the G7 evolving in France as the president of that for the next period of time? What do you hope to achieve during that period of time?
More necessary than ever. To talk, to have these direct talks, even if we don't always have the same ideas. And so these moments like these, they can bring concrete results. One of which was announced yesterday is the collective effort to fund the restoration of the dome of Chernobyl. You know that it has been hit by a Russian drone in 2025. It's a small hole actually, but it cost $500 million to restore. Yeah. So there is a common effort here to restore it, and it shows how dangerous this Russian aggression of Ukraine is.
Well, Pascal Favreau, thank you so much for your time. There is the spokesman for the French Foreign Ministry, who of course are playing as host to this G7 meeting here outside of Paris.
Ollie, thanks so much. Bloomberg's chief Europe correspondent Oliver Crook there speaking to Pascal Confavreau, France's foreign ministry spokesperson. Now, this is a picture for markets across the board. We did have a little bit of a downturn when it comes to European stocks, stocks in general extending their route after China launched these trade probes into the U.S., adding to nervous sentiment driven by fears of a protracted war in the Middle East. I'm looking at global bonds. They're also extending their slump. Treasuries falling alongside them. The dollar actually a little changed. Gold gaining. Traders, again, fearing this broadening impact on energy supplies and oil prices, stoking fears of inflation spiraling that could force some central banks to tighten monetary policy. You can see S&P futures practically flat, as are NASDAQ and Dow Jones futures. Coming up, Iran drafting legislation to unilaterally impose fees on vessels seeking safe passage through the Strait of Hormuz. We have President Trump's reaction to that controversial draft bill. That's next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. President Trump delays U.S. attacks on Iran's energy by 10 days, claiming the two countries are negotiating. Brent crude is on course for a record monthly gain. China retaliates with trade probes against the U.S. ahead of President Trump's visit to Beijing in May. Plus, the U.S. Senate forges a path towards ending the partial government shutdown. Lawmakers under pressure to fund the Department of Homeland Security with record queues at airports across the country. So the Iranian parliament is working on a draft bill to impose a fee on vessels seeking safe passage through the Strait of Hormuz. That's according to the semi-official Fars news agency. Now, the narrow waterway has been all but closed since U.S. and Israeli strikes on Iran began almost a month ago. President Trump was asked about the issue by Bloomberg's Anne-Marie Hordern.
Should Iran be able to charge a toll for the Strait of Hormuz? They're charging some vessels to go through.
Oh, yeah. Well, should they be able to? I mean, they shouldn't be able to, but they're doing it a little bit. I don't know. Look, their capability is a lot less than it was 2 weeks ago. And with every week and every day, frankly, it gets less and less. All I can tell you is they're begging to make a deal. So let's see what happens.
Well, let's get more on the situation in the Middle East. I'm joined now by Jasmine Al-Gamal, Averos Strategies founder and former Pentagon advisor, and Paul Wallace, Bloomberg's managing editor for Middle East and Africa. So thank you both for joining us. Paul, what do we know? Who's negotiating with who? Because it's unclear, actually, and it changes quite often.
It's still pretty unclear, but the best we can say is that Iran and the US are exchanging messages via Pakistan. Pakistan is essentially the main mediator at the moment, and the latest thing is Trump extending his deadline to, blow up Iranian power plants if Tehran doesn't take an off-ramp and accept a deal. He's extended that until April the 6th, so for another 10 days. Iran remains still very consistent in its message that it doesn't seek negotiations, and it's got some pretty sort of tough demands pretty much to even begin those negotiations. They include getting some kind of recognition that it controls the Strait of Hormuz. It wants reparations, and it also wants Israel and the U.S. to say they won't attack the country again once this conflict is over. Those are demands which I don't think the U.S. and Israel are likely to accept. So we're at an impasse at the moment.
Jasmine, I mean, do you think this is, again, because both sides are trying to, save face at home, or is it really that they just start from very different starting points, that the two, this is a fight for survival, and so they just want very different things?
That's right. I mean, what you're seeing right now is basically each side trying to set the stage for future negotiations. They're trying to amass as much leverage as they have so that when they inevitably sit down at the negotiating table, they're not operating from a position of weakness. So you see the U.S. trying to impose a lot of costs on Iran and vice versa. I think it's important to parse through the different objectives that Israel and the U.S. have, because they're not exactly aligned on what they want. Israeli objectives are much more long-term. They want the eventual complete capitulation of the regime. They want an entirely new structure in Iran. And as Prime Minister Netanyahu said, I think just yesterday, they eventually want the Strait of Hormuz to be completely bypassed, and they want new routes going through the Arabian Gulf and Israel. That's the way he described it. The U.S. doesn't think that long-term and doesn't necessarily want those same things. So when we look at just the U.S. and Iran, I think the biggest mistake, I'll just say lastly quickly, is that Trump keeps changing his deadlines, and I think Iran sees that as a sign of weakness on the American side. And in order to compensate for that, Trump may have to do something like military action over the weekend to restore the balance.
Yeah, what do we know the U.S. and Trump administration now want? I mean, I don't know whether the price of oil going up by so much was a shock, and so they just need to find a solution quick.
Yeah, they do. I think Trump, he needs Hormuz the Strait of Hormuz to be reopened. It's as simple as that. You know, Brent today is trading at about $110 a barrel. We have analysts at banks like Macquarie saying, you know, if this strait is not reopened by June, then we're going to $200 a barrel, which would presumably cause chaos with the global economy. We're already seeing big signs that Western economies are being hit hard through PMIs from this month, March, and all that. So Trump needs Hormuz reopened. And just a note on Iran and its stance, you know, that it's still taking a pretty hard line even on negotiations. Attacks continued this morning. It's fired missiles at Israel. It's fired missiles and drones at Saudi Arabia, Bahrain, Kuwait, and Doha in Qatar got its first missile alert today for days. So, you know, the war continues as normal for now.
Yeah. Jasmine, I mean, you were saying that something could happen this weekend. I mean, is this boots on the ground? Like, how would President Trump restore this balance?
Well, I think we have to prepare for all options, right? I mean, there are options all the way going from just continuing to threaten to forcefully open the Strait of Hormuz. Interestingly, you've seen the UAE over the last few days steadily release statements and op-eds and making it clear that the UAE is now firmly in the camp of using force against Iran and trying to neutralize the regime's capabilities. But there are also possibilities for boots on the ground. There are senators that have just listened to classified briefings in the U.S. that came out and said, I am not authorizing boots on the ground, and you should be really worried about this. So I think what's important, we don't necessarily know which way Trump will go, but I think we have to be prepared for a scenario where he does put boots on the ground, even if it's not the most likely scenario.
Do we have a better understanding now of how many weapons and drones Iran has access to, or how fast they can build them? Because this took everyone by surprise.
We do know that they're capable of replenishing at least their drones and some of their ballistic missile program, although it's a timeline, it's competing timelines. How fast can the U.S. and Israel degrade versus how fast Iran can resupply? But it's also important to note that Iran hasn't fully activated all of its options yet. As I think we mentioned before when I was here last time, the Houthis are still fairly quiet. You know, they could come out at any minute. And Iran has not played all its cards yet. Iran playing its cards has less of a cost for them domestically. Obviously, it's not a democracy. They don't answer to their people, than the U.S. playing more and more cards. So I think also time is not on the U.S.'s side if escalation is where we're headed here.
Paul, I don't know what to make of the fact that Iran is drafting this law to introduce tolls for the Hormuz transit. I mean, if you're physically in control of the strait, I mean, do you really need to draft a law?
I think it's hard to tell exactly what Iran means by that, but I think in whatever the case, it's a show of confidence on the part of Iran. I mean, it would be a strategic disaster for the U.S. and the West and the Gulf Arab states if Iran ended up with any kind of control at all over passage of commercial vessels through the strait once this conflict is over. I mean, that would be a nightmare scenario for all sorts of reasons. But Iran, at the moment, you know, probably feels that this is a negotiating tactic to put the U.S. under more pressure. It's hard to tell whether it literally thinks it will be able to treat the Strait of Hormuz like like Egypt does with the Suez Canal, for example, after this war is over. But I think it just shows how confident Iran is, at the very least, that for now it can keep the strait closed.
What's the probability, Jasmine, of a diplomatic solution?
Well, it obviously would be the best way. The best scenario here, best case, is for Trump to just declare victory, negotiate some kind of solution between the U.S. and Iran to keep the straits open, and just call it a day and take down the temperature. The problem is that if he does that, Iran comes out of this declaring complete victory, and the Gulf states remain vulnerable because Iran maintains the capacity to harm them or even just to intimidate them moving forward. That's what makes me think that we're not done just yet before we head into negotiations. I think Trump needs to restore that balance of power between the U.S. and Iran, protect his Gulf allies moving forward into the future, gain some strategic I can't think of the right word, sorry, but make sure that Iran doesn't have the ability to intimidate them moving forward. He has to get that guarantee somehow, and then they can go to negotiation. So that's what makes me think we're not over the hump just yet.
Yeah, and Jasmine, it kind of goes to, to a lot of our reporters are trying to figure out how this new Ayatollah will be different to the previous one and whether he's more of a hardliner.
Exactly. I mean, given his comments in the past and things, there is an argument to be said that yes, Mojtaba Khamenei is more conservative, more hardline than his father Ali Khamenei, who was assassinated on the first day of this war. It's hard to tell his thinking at the moment. He hasn't been seen in public at all since the war began, and even since he became supreme leader. The U.S. says he's injured, perhaps badly. So it's hard to tell. The Speaker of Parliament seems to be calling a lot of the shots at the moment. But I think, going back to what Jasmine said a bit earlier, time is on Iran's side. That's a crucial point. They see this as an existential fight. They are literally fighting for the survival of the Islamic Republic as they see it. And in that case, time doesn't really matter. They can keep going for as long as it takes to survive.
Jasmine, who do they have left in terms of allies? So Russia, we understand maybe there's some intelligence sharing, but unclear to how much more Russia can do given their own situation. North Korea, I mean, could they get involved in this?
I don't think you're going to see countries really getting involved. I think right now every major actor realizes that the temperature needs to be taken down. This is now affecting the entire global economy, every city, every household in the U.S. to China to Europe. This is in no one's interest to continue except for Iran saving its regime. And so I think what you're going to see, the question is not how many allies Iran still has, but whether countries in the region, international allies of the U.S., can get the U.S. to start taking down the temperature and moving towards negotiations. Iran is going to be isolated no matter what diplomatically, but that doesn't really matter in the situation that we're in right now. It's about who can convince the U.S. president that this is not in anyone's interest. He's going to have to end this war in a way that is not necessarily in favor of the U.S., but he's going to have to do it. Who can convince him of that remains the million-dollar question.
Well, price of gasoline of $5, that'll convince the president, right? I mean, we're almost there. If you look at, we had a Macquarie, saying like, look, the price of oil could go to $200, but I think gasoline is above $4. This is problematic for him.
It's very problematic when you're heading into midterms in November, and with the economy such a big part of how Americans will vote. And, I know California has its own issues with taxes and things, but we're above or very close to $7 a gallon there. So, this is not what Trump wants. He is throughout his time in office during term one and even the second term, he has gone on and on about gasoline prices. He said that they were too high under Biden, and he's taken pride in the fact that at least until this war, he kept them much lower, or they were much lower under his presidency than they were under Biden. That's now, that's completely reversed. It's a big issue for him.
Okay, thank you both for joining us. We have a wonderful blog that I know your team are working on, and in the blog just minutes ago saying that actually Iran has also turned back 3 container vessels in Hormuz. Thanks so much for joining us, Jasmine Al-Gamal, Averroes Strategies founder and former Pentagon advisor, and Paul Wallace, Bloomberg's managing editor for the Middle East and Africa. Now, Ukraine risks running out of money to pay for its defense against Russia within 2 months. That follows Hungary's veto of a €90 billion loan and spat over the IMF's latest aid package. The EU foreign policy chief Kaja Kallas urged the U.S. to support Kyiv by capping oil prices, which are boosting Russia's war chest.
Clearly, these two crises, two wars are linked. If you hear about the intelligence that the Russians are providing to Iran so that they could attack Americans. So, the response of the Americans should also be not to help Russia. And there it is important that the oil price is capped and they don't have the funding to actually go on.
And do you think those reports about that intelligence sharing and potentially drone deliveries we're talking about potentially to Iran from the Russians, does that make the the sort of battle lines a lot clearer for the United States, and does that then put the United States on the European side of those lines?
Well, it's very clear for us where the lines are, and clearly, I mean, Russia is not on the side of Americans. That's very clear. So there should also be pressure on the Russians because they are providing drones, but also intelligence.
Kaja Kallas there, the European Union policy chief. Now, NATO's European allies and Canada both raised defense spending by 20% for a second straight year in 2025. The NATO estimate reveals a total increase of $574 billion after yielding to the U.S. president's demands and responding to escalating threats from Russia. Well, Secretary General Mark Rutte says it reflects a shifting balance within the alliance.
For too long, European allies and Canada were over-reliant on U.S. military might. We did not take enough responsibility for our own security. But there has been a real shift in mindset, a collective recognition of our changed security environment.
And President Volodymyr Zelensky says Ukraine and Saudi Arabia has signed a defense cooperation agreement focused on technology sharing and investment. During a surprise visit to the Gulf, Zelensky offered Ukraine's specialized anti-drone expertise to combat Iran's drones. Now, in exchange, he's asking for support in securing supplies of critical U.S.-made missiles. Now, traditional allies are seeing the U.S. under Donald Trump as a less reliable partner. They're looking to hedge their bets by way of China. Here's a preview of this week's Bloomberg Originals documentary.
There's a phrase which China's President Xi Jinping likes to use. The world is undergoing changes which have not been seen in 100 years.
Now these changes have appeared to arrive, but they're delivered unexpectedly by Donald Trump.
Epic fury. I said I like that name.
Amid the noise of war, the stance of another major power is speaking volumes.
中方敦促各方立即停止军事行动。
The US is demonstrating itself to be a force for instability in the world. And that gives President Xi and China a chance to present themselves as the adults in the room.
China is happy to see the United States getting bogged down in the Middle East. China has long viewed the existing order as being too dominated by the U.S., so Trump's challenges to that order actually presents Xi Jinping a very good opportunity, and the question is whether Xi is ready to seize it.
In many ways, he already has.
Trump's first trade war made China realize that dependence on the U.S. is a very dangerous thing. China's exports to the U.S. fell about 20% last year, but in the end, China had a record trade surplus hitting $1.2 trillion US.
China deliberately tried to diversify away from the U.S. as a consumer base.
So, do Trump's actions strengthen China or expose it to more risk it cannot control?
And you can watch the full piece online, including the Video Hub, Bloomberg Video Hub, and YouTube. Now, coming up, we'll talk to Amy Gower, metals and mining commodity strategist at Morgan Stanley, as gold slumps almost 17% since the Iran war began. That's coming up next, and this is Bloomberg. Gold has fallen almost 17% since the Iran war began nearly a month ago, moving in tandem with stocks. Now, spiking energy prices have raised the risk of inflation, raising bets that central banks will leave rates on hold or even hike them. Now, adding to the downward pressure, Turkey's central bank has offloaded more than $8 billion worth of bullion. Well, Amy Gower, metals and mining commodity strategist at Morgan Stanley, joins me. Amy, thank you so much for being with us. I mean, there's a number of factors, right, that could lead to explain the gold trade in recent years. Central banks diversifying reserves away from the dollar, investors seeking alternatives to bonds. But then in the last couple of weeks, it's really tricky also to understand what gold represents.
Mm-hmm.
Yeah, look, I think we've had a shock clearly here with the conflict beginning, and I think it's not unusual to see gold initially pull back when we do get these shocks. We saw that in COVID, we saw that at the beginning of Russia-Ukraine, we saw this in Liberation Day, and this is where gold's liquidity works against it. You know, it is your most liquid asset. It is what you sell to free up cash, whether that's to pay margin calls or reallocate elsewhere. It does also look like we've had a bit of technical selling. You know, we've definitely found support at key moving averages, for example. We bounced off the 200-day, so that suggests that there's perhaps some technicals behind this. But I guess the difference for this shock versus maybe, say, Liberation Day is that what it means for inflation and central bank actions around interest rates. And I think, look, here we have seen the pricing on the Fed change from expecting rate cuts to rate hikes. We know gold is sensitive to that. We've had the dollar creeping higher as well. And if we remember last year, we did have arguably safe haven demand for gold, but with a weakening dollar, and that's highly unusual. So we're getting kind of the reversal of that as well.
So it doesn't fundamentally change your view on what gold could become?
I think, look, gold should still be that real asset. We should still be thinking about, you know, I think that shift in investor demand for real assets that took place last year, as you know, particularly with concerns around fiat currency debasement. I think that narrative is still there, but I guess at the moment we do have to deal with some of the changes. And one thing I would say is, if you say your two big buckets of gold holders or gold buyers have been central banks and exchange traded funds, look, we can come on to Turkey and the sale, but the exchange traded funds they can flip from selling to buying and back again. You know, in 2024 they bought zero. In 2025 they nearly bought as much as the central banks, and so they are quite sensitive to what the Fed is doing. And I'd say if the narrative does start to become that we are at risk of a hike or maybe a longer pause, you might see that liquidation coming through.
I mean, could you see more central bank selling of gold?
Yeah, look, it's always tricky to say. I mean, Turkey, obviously, it's a large amount, 60 tons of gold. You know, central banks collectively bought about 860 last year. I think already we were seeing a slowing pace of buying, so then it doesn't take much selling to start to weigh down. There were some discussions, I think, in Poland around as well, a more active management of their gold reserves. I mean, Poland was the largest buyer last year, so if they started to sell, that would obviously have an impact as well. I don't think anyone else has said it as of this point, but definitely I would expect a slower pace of aggregate buying.
And Amy, I mean, I guess apart from, you know, we focus so much on oil and gold as an asset, is there anything else in that space that you know, worry or that hasn't behaved the way that we thought it would in the mining world?
Yeah, so look, I would say base metals are having a sort of a push and pull factor as well, and maybe aluminium is the one that stands out here. So aluminium is the one where everyone's first attention was drawn to what could be disrupted by the Middle East. So the region is about 9% of aluminium production. A lot of that leaves as exports, and at the moment, obviously, that anything stuck behind the Strait of Hormuz is not really making its way out. The region is also very dependent on imports of alumina and bauxite. So again, are we running close to critical levels on those raw materials? So aluminium initially had a lot of support both to the price and also the regional premiums. That's now come off a little bit because we're starting to worry about growth. And so I think that's where the base metals have this push and pull. At the moment, it feels like aluminium is still outperforming the rest of the complex, which I think makes sense. But we'll have to see, you know, where these growth worries go.
I mean, I get it, because we're starting to think about possible demand destruction, right? If everything goes, what data points do you look at first to have a sense of, is it some of the data coming from China or elsewhere to understand where some of these base metals go?
Yeah, look, I think China's the place where we typically get the most data. I would say actually on copper, that's been looking fairly encouraging with this pullback. So we've seen copper inventories in China pulling back faster than normal. We've seen physical premiums in China jumping. So it does actually suggest maybe that they've been buying the dip a bit here. I guess elsewhere is maybe where we'd see more of a slowdown. But what I would say is this is not 2022, which is where we had a very big demand shock. But part of that was exacerbated by the supply chain was very well stocked. We'd had the COVID supply chain shock. Everyone had started to hold a little bit more, that just in time to just in case. And then as interest rates went up, the cost of financing that went up and everyone destocked. I would not say we're there. I think if anything, this could actually prompt that restocking cycle when, you know, things have settled, because suddenly everyone's realized how vulnerable their supply chains can be.
I mean, how fast could that happen? Is it impossible to say at the moment?
I think it's difficult to say, and again, it's going to depend on interest rates because we have to think about the cost of financing. But I think, particularly as we go into 2027, I would expect, you're going to have to start hearing about stockpiling, and even at the government level, not just at the country level, company level.
Company level. Amy, so interesting. Thank you so much for joining us. Amy Gower, the metals and mining commodity strategist at Morgan Stanley. Now, again, if you look at everything that we've lived through this week, it stocks, we've had a great roundup from Amy on everything that metals have been doing today. Stocks seem to be extending their route after China also launched these probes into the U.S., adding to a nervous sentiment driven by fears of a protracted war in the Middle East. Global bonds extending slump, or their slump, treasuries actually falling alongside them, and the dollar little changed, with gold gaining. If you look at traders, if you look at S&P futures, Dow Jones and NASDAQ, they're pulling lower a little bit more than they were just 15 minutes ago, down 0.2%, and it's really this fear of this inflationary spiral that could force central banks to tighten monetary policy that we're on the lookout for. Up next, it's Bloomberg Surveillance, and this is Bloomberg.
Core PCE, as well as the PPI that we got earlier this week.
Robert Kaplan calling this a medium war in Foreign Affairs magazine. Has the Federal Reserve System ever dealt with a medium war? I don't think so.
What's changed for this committee? The last time they met that morning, crude was 62. Crude this afternoon is $30 higher. Plus, that's a big change for this committee to think about.
Do they say we are going to look through this? Are they going to say that typically oil price shocks are transitory, if you have to use that word, and that they will look through it and focus instead on weakness in the jobs market? Or are they going to say, we are very concerned about inflation, we have remained above our target for too long, and we need to take action?
John, a headline here off of Bloomberg: Patrick Sykes in Istanbul, Dan Williams in Tel Aviv. U.S. aims to curb soaring oil prices. Is this more than we've ever seen the central banker to the world?
What options do they have? We've seen escalation in the Middle East throughout today already. It looks like we have a new front for this war and its energy assets, and Iran is vowing to retaliate. That's where the pressure's coming from this afternoon for this committee, attempting to provide forecasts at 2 p.m. Eastern time. Good luck to them.
Really just get a dartboard, get some darts, and start throwing, because that's essentially as good as they could potentially get. In the meantime, we are seeing an escalation here with a focus not just on storage bins filling up, but actually some of the production facilities are actually being taken offline. Again, is this inflationary or is this deflationary down the line? Ultimately, economists can debate that. The Fed doesn't have that luxury based on the numbers they have right
So let's get the scores going into this one. We'll start with stocks. We'll go to commodities. We'll finish on bonds. The equity market this afternoon shaping up as follows, declining across the board on the S&P 500, down by 0.7%. On the NASDAQ, just off session lows, down by 0.7. Also in the commodity market, very close to 110 a little bit earlier on in the session. 108.40 right now, higher by close to 5%. And that sets the tone for this, the bond market. What a round trip this fixed income market has been on. 10s were down 30 basis points in February. Then all of a sudden, a round trip for the first few weeks of March.
Yeah, and whether we opine on where it's going to go matters less than who we have coming up shortly. JP Morgan's Bob Michael, Kathy Jones of Charles Schwab, and Satyen Subhadrajappa. They will be taking us up to that Fed rate decision at 2 p.m. Eastern. Then we get immediate reaction from former Fed Vice Chair Rich Clarida, Stephanie Roth of Wolfe Research, and Diane Swank of KPMG. And finally, breaking down Chair Powell's news conference, which he hopes to make as boring as possible, but I guarantee it will not be. Apollo's Torsten Slok and BlackRock's Jeff Rosenberg.
Does he do an 8-minute press conference? Is it going to be like when we were at Jackson Hole?
I said earlier on this morning, TK, I was like, look, it's Operation Epic Fury in the Middle East. It's Operation Make It Boring at 2:30 Eastern time.
If he doesn't say something in response to whether he's going to stay on, if he doesn't say something about whether this is inflationary or disinflationary, ultimately it will be news. You can't make non-boring boring.
Chris Condon in Washington says this is a big deal. Is that really a focus here?
I think it's got to be a focus. You have to ask the question directly, the chairman, where are you going to be after May? Is this your penultimate meeting? Is the next meeting your last one?
If you can't tell that, what exactly are you doing with forward guidance? How do you give forward guidance if you don't know the people in the seat, especially if there are dissents and the different people have very different views?
Bob Michael of JP Morgan Asset Management, charged with answering some questions. He joins us now. Bob, good afternoon. Good to see you.
Happy to be here.
Let's get to it. Three-part act, statement, projections, news conference. What are you expecting?
Well, first, I think this is the most mesmerizing FOMC meeting since COVID, and I mean that. The three things we're going to look at, as you laid them out, we're going to look at the post-meeting statement. We're going to see how the Federal Reserve characterizes the impact to risk on both sides of its mandate, full employment and price stability. They should say they're elevated. Secondly, you've got to go to the summary of economic projections and see how they reflect them in there. They can't just say, oh my goodness, we don't know, we can't do anything. They can't keep their head in the sand. Even if it's only decorative, they should raise PCE by a couple tenths, they should raise core by a tenth, and then also they should probably tilt unemployment higher by a tenth to reflect the elevated risk to both sides of their mandate. I think when you look at potential rate cuts, they should leave one rate cut in for this year and one rate cut for next year. The third part of this is the dissents. To us, that's the most critical thing. For sure, you can write in pen that Myron will dissent for a 25 basis point rate cut, but will Waller and or Bowman follow him? If they do, that tips the Fed's hand onto what they should be more worried about, the impact to price stability or the impact to the labor market.
What's the likelihood that with this two-sided risk, they introduce or reintroduce the idea of rate hikes over the next 12 months?
I think pretty much zero. I don't see that probability, and I know there's a tremendous amount of conversation on the ECB, for example, that they're a single mandate policy, price stability, so they should be hiking rates. But let's not forget, even there, Christine Lagarde is the chair of the ECB. She was the finance minister of France back in 2008, and after the ECB hiked rates in 2008, she came out very publicly to criticize it, as did President Sarkozy. So I think central banks have learned from 2008 and also the ECB from 2011 that when you have this sort of geopolitical orthogonal shock to the system, it's going to tighten financial conditions somewhere. You don't pile on by hiking rates unless you see it passing through to core prices and then ultimately to wages. We're a long way away from that. I don't think they'll open that can of worms.
Let's avoid right now the 5-year, 7-year, 10-year certitude of private credit. Let's go the other way to the short-term market. What does JP Morgan see in the plumbing of our financial system into this meeting?
Well, there's the bank lenders and the non-bank lenders. And the bank lenders are heavily regulated. The public markets are heavily regulated. The non-bank lenders, not so much. I think that's where you've seen some of the volatility in the private credit markets. And of course, there is that concern when you see that kind of volatility and when you see a lot of holders try to head for the exit. But the system seems to be working.
Equity indices built on opinions? That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
Are 5% redemption clauses. Those are being exercised. That's fine. I think the big concern to everyone in the markets is private credit hasn't been through a shakeout yet. It's been chugging along for the last 15, 18 years. It's a post-GFC. Recessions create the ultimate shakeout.
John, do we agree that if we didn't have a war, private credit would be the #1 topic
Without
of this
a
show?
doubt. Lisa's been talking about the same thing. I'd say that. I'd say AI disruption. And those two issues are still percolating. It's the accumulation of risk, I think, over the last 2 months, Bob, that gets everybody's attention. Is that a headwind to this market?
Do you know what's so funny is I pulled up financial indicators, financial condition indicators. You pull up Bloomberg's, it's gone nowhere. You look at market pricing, it's gone nowhere. I think that's a question for Jay Powell. How do they interpret financial conditions indicators. Is there a sense of complacency across the market? Yeah, there are all these concerns out there, but perhaps there's so much liquidity in the system, it just overwhelms the concerns for now.
We've certainly repriced energy. You've seen that in the price of crude across the futures curve. We've repriced interest rates. You've seen that at the Federal Reserve and the ECB looking out 12 months. What's curious to me is the extent to which we haven't repriced economic growth for this economy and for elsewhere.
Stagflation is a terrible recipe. It's a terrible recipe for growth. And if you have an increase in oil prices that go beyond this current level that you see, you start to wonder when credit's going to pick up on that, beyond just the disruption. If you add to that some sort of shock that will potentially suppress growth.
We're super lucky that capital markets are still wide open.
Correct.
We've talked about this a million times. Markets can shape the events they anticipate. The fact that we've still got credit spreads that are still pretty tight. The fact that this month alone, we had the biggest single day of US IG supply, and it was met with tremendous demand, is good news. Whether you think it's complacent or not, it could be a whole lot worse if those things weren't happening.
And it raises the specter of how fragile they are. And that's really, I think, what people are gauging. Is there something that Fed Chair Jay Powell could say that could potentially disrupt that complacency or that openness that we're seeing in capital markets?
Do you want to announce a Mag 7 bond offering on the show today?
Do you want some 100-year alphabet?
Yeah,
Can we pitch some 100-year alphabet?
You know what? We work with these companies when the issue. The reality is they see a lot of demand out there, and they've got to build the capacity to get that demand monetized. So it's real for now.
Is this a sales call? I think
it's good to see you, Bob. You're going to be sticking with us, I'm pleased to say. Bob Michael of JP Morgan. Up next on the program, we'll catch up with Kathy Jones of Charles Schwab, Subhadra Japa of SocGen. That conversation just around the corner. Heading into this, a Fed decision just moments away.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
I believe that talent is equally distributed, but opportunity isn't. But education can give everybody the opportunities that they deserve to fulfil their potential. That's why I got involved in politics and why I got involved in the Labour Party.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, Tuesdays only on Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism. This week, the Fed's reaction to the Iran war with Randy Quarles, former Fed vice chair, how Australia's attempt to limit social media for young people is working out, and a different view on AI. What if, after all, it's simply a normal technology and not the revolution some predict?
Let's look at reliability separately from capability. Capability is not enough.
Watch Wall Street Week. More than what you need to know, it's what you need to think about.
We're in the fog of war. I think the Fed's in the fog of war as well.
The pressure's there, right? It could complicate from an inflation picture.
We have the greater risk of a stagflationary scenario, and that is problematic for the Fed.
There's much more concern about the stagflation risk.
That now puts them in a very, very difficult position.
Not just inflation shock.
That this is creating a bit of a growth shock.
The Fed is going to be cautious.
I think the Federal Reserve should just stay on hold here.
On hold here. It is on hold. On hold.
On hold.
Wait and see. We hear wait, careful. We hear a lot of words like that.
It's a wait and see game.
I don't think that the Fed will be as dovish as they have been.
So I wish they just, not be hawkish or dovish,
But be honest.
When oil prices go up, headline inflation goes up.
The big piece of this is how long this energy shock lasts.
The Fed will have to increasingly acknowledge the two-sided risks from this.
This divided Fed is going to look even more divided.
Certainly the politics are swirling around.
Their motto for the March meeting should be one battle after another.
Live from New York City this afternoon. Good afternoon, good afternoon. That Fed decision, 15 minutes away. The scores into it look like this. Equities declining by 0.7% on the S&P 500, down by 0.6 on the Nasdaq, sending a tone for financial markets worldwide. These moves in the commodity market, Brent and WTI, a major rally over the past few weeks, just short of 110 on Brent and up by close to 4% on the session, and a big move at the front and long end of the curve over the past few weeks. Twos around 370, tens still through 420.
Right now, Fed funds futures have priced out a full rate cut for the remainder of 2026 as they see some of the increases in inflation. Does the Fed now lean into that and then confirm that and say, look, we don't plan on making a move?
Let's get to Kathy Jones at Xauusd. Kathy, welcome to the program. We've had the energy shock. Now the Federal Reserve needs to provide some forecasts. What does this mean for inflation, for growth, and ultimately, what does it mean for policy? What are you expecting?
From 50 years ago to today to tomorrow, CIB has always been here. Growth, innovation, and setting the standard for half a century. Progress driven by quiet mastery.
Well, I think there'll be a lot of confusion. I'm not really taking the SEP or the dots very seriously this time around because I have to be like throwing darts right now. Given that we don't know how long this lasts, it's already lasted longer than the consensus, and therefore, when they're making these forecasts, I think it's just really a guess on the part of the various members. If you remember during COVID, they actually suspended the dots because of the uncertainty. I don't think they'll do it this time around, but I think it would be really, really difficult for anybody to pin down a really precise estimate. But I'm going to be interested anyway to see the dispersion of the dots, to see what they do with their estimates. I'm assuming the estimate for inflation goes up and estimate for unemployment goes up just to reflect reality on the ground. But in terms of what the Fed really probably is concerned about right now is inflation expectations. So when I'm looking at those break evens in the TIPS market, they're just continue to move up, and they've really focused on inflation expectations many times in the past. So I think that may be a real concern for them as they look towards setting policy down the road.
Do you agree with Bob Michael, who just said that this is probably the most interesting Fed meeting since the pandemic era, where they had to decide what to do and when they did suspend those dots?
Yeah, I agree with Bob. It's just very difficult situation for any investor and certainly for the Fed. How do you make a forecast when every 12 hours something new happens, right? But I will say, having maybe experienced oil shocks in my past, I think the one thing that probably the Fed that will resonate with the Powell and other members of the Fed is they don't want to make the mistakes that were made in the past. Even if it's a bit different today, right, and there's differences in supply, the 1970s were, a disaster because the Fed was too late to address the inflation coming from the oil price shock. So I think that that's a mistake they really want to avoid.
About with this uncertainty, you're the only one I know who read the 1,100 pages of Fabozzi. Are the dynamics of the full faith and credit bond market working right now? Describe what your pros see, the nuances of the bond market given this new uncertainty.
I think they are. And I know we can sit here and say, over this period of time, rates have risen 30 basis points, but I look at them and I come on, 370 on the 2-year, the Fed funds rate is 3 5/8. That's flat to the Fed funds rates. That's where it's supposed to be, a little steepness out to the 10-year. This is all within sort of the range that it's been in. What we're hearing from clients is they're looking for an opportunity to get into the bond market. They feel underallocated to it. They sense there's a little bit of a backup here. Is this the time to get in, and where do they get in? I also want to remind people that the Fed went into this Iran war concerned about the labor market. It was no hire, no fire, for good reason. Businesses didn't know what the shape of tariffs would look like, and everyone was concerned about AI. You didn't want to hire somebody today. You might have to fire 18 months from now. Now you pile on top of that, businesses and households are facing attacks from higher energy prices. So businesses for sure don't feel like doing any hiring now. I think they're going into this meeting even more concerned about the labor market than the pass-through of this orthogonal oil shock.
How many times have we heard that this week, that all roads lead to buying bonds? That if the shock continues in the Middle East, buy bonds, it's going to hit growth. If it goes away, buy bonds, yields are backed up too much. Just buy bonds seems to be the conclusion.
Well, I know one bank CEO who would take the other side of that. And I heard that yesterday.
Well, I will say the counter argument to that is if the Fed actually is overly dovish, do you start to see a huge sell-off and an increasing possibility of there being a 1970s style shock where wage growth follows some of the increases that we're seeing in commodity prices?
So, Kathy, let's come to you on that. The assessment of second-order effects, the potential for pass-through to core good prices, pass-through to other prices in the economy.
Yeah, I think it's a real risk to the economy that we're going to see some pass-through. You know, consumer demand has been resilient despite all the problems that we're having, say, in the labor market and elsewhere. And if that continues, then the ability to pass through the price increases will be there. I do think that that is, again, a risk that the Fed has to deal with. Even if the labor market weakens from here, how much weight do they put on that if we're seeing core goods prices continue to go up? And they have been above the Fed's target for now, 4 years? And not making any progress towards their target. So it's really a difficult position for them to be in. Yes, if the unemployment rate really starts to ramp up, then that means demand destruction. That means the Fed will ease. But until I think that dynamic starts to happen, the focus is going to be on trying to contain the inflation pressure passing through from oil prices.
Kathy, just a final question for you. The Fed chair, his last scheduled meeting should be April 29th. Do you think he's going to be there June 17th?
It's looking more likely all the time. Can't handicap it real well, but it's looking more likely all the time.
I can tell you, break exclusive, is that what you call it, TK? Break exclusive?
Yes.
Kathy won't be there. Kathy won't be there because Kathy is retiring. Kathy, can I just say on behalf of us all, thank you so much for your contribution to this program over the years and how lucky we've been to catch up with you every single Fed meeting. Kathy, before you go, a word of wisdom on fixed income. What's the biggest lesson in your career? What could you pass on to a new generation?
Oh, I think fixed income is wildly underappreciated and not well understood by most investors. I would say, do your homework. It's a great place to invest.
Is that shade on Liz Ann Saunders?
No, absolutely not.
Every fixed income pro, even when they're exiting, throw some shade at equity strategy.
They do.
Every single time.
Well, it's every single time. So there we are,
Hey.
Swan song.
Kathy's a class act. Wishing you the best in retirement.
Absolutely.
Kathy.
Hear, hear. Thank you. And thank you to all of you at Bloomberg for having me on so many times. It's really been a great honor. You always make everybody feel comfortable and able to speak freely. So I really have appreciated it.
Kathy, we're the lucky ones. Thank you so much. Best of luck. Kathy Jones there of Charles Schwab. Bob, throw me shade at equity guys all the time, right? It's just a fixed income religion.
Well, I'm backing off of them now. I know they're down there
you're kind to them.
They're down there at the bottom of the capital structure, absorbing all of this volatility. You have to have some sympathy for the junior securities guys.
There you go. Nothing changes, right? Nothing changes. Subhadra Jaffer of SocGen joins us now. Subhadra, welcome to the show. Decision about 6 minutes away. What are you expecting to see at 2 p.m. Eastern Time?
In a world of seismic change, will your business shape the future or be shaped by it? How will we capture the imagination of tomorrow's consumers? Overcome operational constraints to focus on future growth and unlock economic and social prosperity through environmental responsibility. With EY Parthenon and EY's full spectrum of services, we're reimagining the enterprise to shape the future with confidence.
I mean, congratulations to Kathy. I think it's fantastic. And I completely agree with her sentiment that people don't pay as much attention to the bond market as they should, because you get a lot of very, very useful signals in the bond market, including what you're seeing right now heading into the Fed meeting. I mean, the front end is starting to push higher. The market's pushing back on the possibility that the Fed will be able to cut this year. In fact, we're pricing in for no cuts for this year. And I also agree with Bob. I think that the market is, with the 10-year yields and 2-year yields, for the most part, within that range that we've had for the last 6 months, bonds are still the place where you want to put your money to work, because of the fact that even if the Fed doesn't hike rates, the front end of the yield curve is going to be pegged somewhat. I think investors are going to flock to the belly of the curve, given the fact that as the Fed stays on hold for longer, your risk is that they might have to cut more in the future, and that might impact growth. So to us, it feels like the belly is going to continue to outperform. As for the Fed meeting, I think I'm expecting this to be more of a placeholder meeting. I'd probably expect more of a bearish bias, or a hawkish bias, I should say, for the Fed. And the changes to the summary of economic projections are going to be quite interesting. I'm expecting them to push up their expectations for headline and core inflation, and perhaps bring down their expectations for growth for this year.
Subhadra, have we seen the peak in the yield curve so far? We've seen now the 2-10 spread now at the tightest going back to November of last year, as people price in the Fed remaining on hold for longer and lower long-term growth projections. Is that trend going to continue?
I think that the 2-10 curve does look very flat. I don't really see the prospects for the Fed switching from an easing bias to a tightening or a hiking bias, just like what we're seeing perhaps with the ECB and other global central banks. I think that the Fed stays on hold for longer at best, and that should keep the 2-year yield somewhat within the current range, or slightly higher perhaps. Unless we shift towards a hike, I don't see 2-year yields really starting to rise. But that said, I think that, like I was saying earlier, I think the growth prospects and the potential for a meaningful slowdown in growth next year would mean that the yield curve is going to have to remain somewhat flat. So the investors are going to continue to buy the belly.
Subhadra, communication is key. And in this news conference, the chairman is bound to be asked about its future. If he commits to staying on, because Kevin Warsh won't have time to be confirmed, in your mind, I'm interested in your individual perspective on this, your judgment as a market participant. Does staying on provide consistency or invite controversy?
I think it definitely provides consistency. What the market's looking for is a steady hand from the Fed and the committee at large. I mean, what we don't want to see is kind of a temporary Fed coming in and not knowing what the direction of policy is going to be. So to me, I think the best way to transition would be from Powell to the next Fed chair in an orderly fashion, as opposed to having somebody interim and then having to switch back to Powell. So that's kind of what I'm hoping for.
Subhadra, good to see you. Thank you. Subhadra Japa there of SocGen. Bob, just to turn to you, same question. Do you agree with that?
I think him staying on creates stability. Personally, I believe he'll stay on past the midterm elections.
Past the midterms?
Past the midterm
Why will he stay on?
Because he'll want to ensure that the market sees the independence of the Fed, that he's already been there for 14 years, he's a stabilizing force, and they can't be politically influenced.
Will he stay on as Fed chair or as governor or both?
I think after the midterms, he will no longer be Fed chair, but I think at the May meeting and perhaps the July meeting, he will be still the Fed chair. It all comes down to what Tom Tillis decides, what the courts decide on Lisa Cook and the suit against Jay Powell. All of that resides with Tom Tillis.
This show used to be simple.
Right? It's got complicated, hasn't it?
It's just unreal.
The Fed's got complicated. Neil Datter of Renmac writing in, Warsh, no matter what, will walk into the Xauusd building as the weakest Fed chair in recent memory. he's limping in. The opinion of Neil Datta just moments ago.
In part because of skepticism by the market, but also in part because this is just a difficult economic time. There isn't a consensus to be had on exactly how you grapple with stagflation.
This is not a small matter on real and also nominal GDP and all the distractions we've got now. And I want to talk to Claire about that when he shows up. But to me, the weaker economy is a really interesting trend.
We're 60 seconds away from a decision, and a lot of people in this market will be looking for dissent. And dissent from some governors, in particular, who are worried about the labour market. And on the same committee, the very same committee at the very same meeting, there's a collection of officials on this committee who are worried about overshooting the inflation target for the past 5 years. That's how divided that committee is right now.
How do you deal with the paradigm shift with an oil shock thrown in, where you have AI creating real questions about productivity at the same time that you do have inflation, but you also have the potential for more efficiency?
Crude has gone from in the 60s when the Fed last met, the morning of the last Fed meeting at the end of January, to in the 90s, off the back of a shock in the Middle East and a major rally over the past 2 weeks plus. The scores heading into this decision look like this. Equity markets this afternoon on the S&P declining by 0.6% in the bond market. We're looking at 2s, 10s and 30s shaping up as follows. Yields on a 2-year at 3.71. With that Fed decision, here's Mike McKee.
Equity indices built on opinions. That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
No change in rates, no change in dots, one dissent, but some big changes in inflation expectations. Fed officials see one cut still in 2006 at some point, even though their statement notes that uncertainty about the economic outlook remains elevated. 3 members who favored no cuts in this year moved their dots down to 1. The statement goes on to say, the implication of developments in the Middle East for the U.S. economy are uncertain, and the committee remains attentive to risks to both sides of their mandate. They still see one more cut in 2027. Stephen Myron, the only dissenter, he wanted a 1/4 point cut this time, and from the dots, we discern that he still wants 100 basis points at some point this year. The language about future moves remains the same. They still talk about the extent and timing of additional adjustments to the target range. It's the summary of economic projections in which we see a lot of changes. PCE inflation this year is forecast at 2.7%, up from 2.4% in December. Core is also seen at 2.7%, up from 2.5%. Both drop to 2.2% next year, up from 2.4% in the December SEP. Core is seen at 2.7% this year. Both drop back, as I mentioned, next year to 2% in 2028. GDP marked up 1/10 in both years, both of the next 2 years, to 2.4% this year and 2.3% next year. The unemployment forecast remains 4.4% in 2026, dropping to 4.3% next year. That's up from 4.2% in December. And the longer run estimate for Fed funds, seen as the proxy for the neutral rate, rises a tick to 3.1%. Guys?
Mike McKee, thank you, sir. We'll catch up with you a little bit later. Let's start with the price action. We'll go equities, then bonds. We'll have a sneak peek of what's happening in the commodity market because we're tracking that throughout the day here at Bloomberg. Equity markets, looking at the S&P 500, off session lows, but still negative by 0.5%. In the bond market, yields slightly higher on a 2-year by 2 basis points, basically as you were at 370 on 2s, on 10s at about 421, which is basically where we were going into this decision. So this is what we're doing. You go into the projections. We'll ignore the statement just for a while. We'll go into the statement and we'll look at the projections and compare what they were projecting back in December and have a look at what they're projecting now. So let's just go through 2026 for GDP, revised slightly higher. That's some good news. 27 as well. Same thing, by the way. So they revised GDP higher, they've revised inflation higher, and they've kept the projection, the implied projection for interest rates, exactly where it was for December. Those kind of moves should be music to the ears of bullish market participants.
This is an incredibly dovish hold, just by virtue of the fact that only one person dissented, and it was Governor Myron. That alone. But these projections highlighting a tolerance for higher inflation and still the belief that it will come down by 2027 to that 2% level without hiking rates and continuing with rate cuts gives you a sense of where this Fed's mind is at. This seems like more of a consensus than I expected, than a lot of people expected, and it is more to looking through any kind of oil price shock.
In honor of Ellen Greenspan's 100th birthday, it was a Greenspan decision. Everybody got on board with the chairman. That's all there is to it.
And the out years, the good news on the inflation front, you decide whether this is good. The Fed is still basically forecasting the same inflation glide path as they were before, even with this lift to 2026.
How do you say transitory without saying transitory?
Right? It's in there in the forecast.
And that's the reason why you're seeing the yield curve steepen. And on the margins, you're seeing 10-year yields higher on this, because ultimately this is a Fed that is willing to stay on hold and look through an oil price shock, look through the fact that even core PCE has been higher than expected and is expected to stay that way. Because ultimately, they do think the labor market is showing signs of cracks, even though they don't necessarily see unemployment rate ticking up. And they do want to err on the side of being more accommodative.
One official I'd like to speak to, just briefly, get him on the phone. Governor Waller.
I was about to say, Chris.
Okay, no dissent. He said it was a coin flip. It would come down to the labour market report, and that labour market report was overwhelmingly soft. So what does he see in the outlook for inflation that's kept him on the sidelines?
Governor Waller, please join us. If you want to call in, we'll take you. I mean, ultimately, that is one of the key players, because he is a pillar of the swing vote, if you will. And a lot of people are looking to him for some sort of guidance about what exactly is driving his decision.
But at Washington State, he was expert on game theory. And when there's a war, there's a different game theory.
This is a major shock we're working through. Bob Michael at JP Morgan Asset Management still with us around the table. Bob, do you have any thoughts off the back of this one?
I do. They're telling us, don't worry about it. There's a little bit of a near-term inflation shock. They added a tenth more than we did, but it's fine. The economy is going to use that to accelerate. So they increased GDP. That I don't get. And they left unemployment where it is. And it also doesn't sync with the dots. I heard Mike McKee say that 3 members who previously voted for no cut changed their view. And went to a cut.
The median dot 3.4, December projection, the median dot 3.4. Joining us now to discuss is the former Fed Vice Chair, Richard Clarida. Now, Rich, I know the word transitory is banned and they can't use it anymore, particularly in the news conference, but does this scream transitory?
10 years ago, Illuma Capital set out with one goal: to help people like you build a legacy for tomorrow. Through personalized strategies and unwavering dedication, we've been instrumental in helping our clients achieve their financial dreams. Whether it's securing retirement, growing wealth, or planning for the unexpected. For a decade, we've been trusted to guide your financial journey. Expertise and care. Visit illuma.co.za today. Illuma Capital is a licensed FSP. T's and C's apply.
Well, it certainly screams we need a synonym for it. Temporary, not long-lived. You know, they could justify it perhaps by looking at the oil futures, which still show this as dissipating over time. But the short answer is nobody, including the Fed, knows. This is very elevated geopolitical risk, and there are risk on both sides. But the baseline, I agree with your panel, is dovish constructive.
Rich, I'm just wondering how much this is just AI written all over it, how much this is a Fed that is basing their entire assumption on a productivity boom tied to artificial intelligence and the deployment of it through the economy, and frankly, disinflation on its heels.
I think there's an element of that, perhaps more so with the incoming chair than some other members. I think it's also a statement, however, that AI is a support to demand in the economy that to some extent along with those big, beautiful bill tax cuts, is probably going to offset some of what the drag would be from the oil price increases. But again, this is a modal or a baseline, and I think certainly internally we'll hear that there was a discussion of the risk cases as well.
Professor Clarida, when you were at Columbia herding cats, Xavier Sala Martin taught the acclaimed principles of economics. Talk to us about the risk of a demand destruction here. To me, it's extraordinary, whether it's war, short-term, or a more permanent demand destruction. Should that be a legitimate concern of the Fed?
Well, the demand destruction comes simply from the fact that not only oil prices, but energy prices and goods that are intensive in oil and energy will go up, and that will tend to reduce the real incomes for millions and tens of millions of households. And on the other side of that, you have the AI boom, but there is no doubt that this is going to squeeze real aggregate demand the longer the oil shock persists.
Check out the price action. Let's go to equities. We're still down by 0.6%, unmoved by what on the surface of things looks like a dovish decision from the central bank. Check out the bond market, similar story, no big moves off the back of this. The only takeaway, this can change, but the only takeaway for me is there is nothing this institution can do to drive this market in the face of the shock elsewhere. Jeff Curry of Carlyle said it really well earlier this morning on Bloomberg TV, when Jeff turned around and said there's nothing the central bank can do about this, you cannot print barrels. This market is still at the mercy of what happens in the commodity market, and the Fed is not the circuit breaker anymore, because this Fed decision, I would sit here and argue, is fairly dovish, with the exception of the absence of a dissent coming from Governor Waller, is fairly dovish. To come out and say the outlook for growth is better, we've revised higher the outlook for inflation, and the median dot is exactly the same, screams dovish, and yet here we are. No big moves in financial markets. I think that's notable.
The Fed is playing dodgeball without the ball. They're not the pitcher in a game. And right now, what they're dealing with is shock after shock without necessarily historic precedent. Yes, there are historic precedents for oil shocks, but not for the AI shock and what that does to the overall economy. So they might remain on hold, and that might be bullish, but not in this moment, because right now, if another oil or natural gas plant gets bombed, people are going to be watching that much more than anything coming out of Jay Powell.
You know, Vice Chairman Clarida, the thing I would point out here, and Damien Sassower at Bloomberg is very cautious on EM suddenly here. In this meeting and in this press conference, more than ever, is this the central banker to the world?
Well, sure it is, and I think that the Fed is aware of that. And I think one thing this episode is reminding folks, we've seen it in the dollar, obviously, is, you know, since the Iran hostilities commenced, you know, the price of gold is down, the price of the dollar is up. So I think there is that element as well. But, you know, broadly, the Fed is reacting to events. I think Lisa said it well. First and foremost, this is a major geopolitical and economic shock. The dodgeball analogy, I think, is a good one. So I think, yes, the Fed is the central banker to the world, but it's not the main attraction right now.
Bob Michael with us with J.P. Morgan as well. What is with the tentacles of J.P. Morgan around the world, how is EM doing? I see Philippine peso almost out to 60. You saw Australia raising rates in
Oh, whoa. We're calling Australia EM.
No, I'm not calling Australia EM.
Get you in trouble, TK.
No, I'm not calling. I'm watching Aussie yen though, which
Sydney,
is a life of its own.
Sydney watching.
Well, yeah.
What is the Swissy
Their
doing?
early morning, deeply unhappy with that.
But I read all the Neville Shute, including Town Like Alice. I want to know, as a central banker to the world, the sensitivities he faces. What does J.P. Morgan see on the reaction in the currency markets, the reaction in fixed income of EM as the chairman speaks?
I think there are a couple of things. One, we felt going through this that the dollar would be the safe haven bid, and we're seeing a lot of that. We also felt for those who wanted to diversify away from dollar, emerging market FX was the place to go. The central banks in those regions seem to be on top of things.
Yeah.
And you had a split between those who are energy importers and those are energy exporters, those that are sitting on rare earth minerals and other minerals, and those who aren't. And I think we're seeing all of that play out. But I will tell you, our client base still feels underallocated to emerging markets, both equity and fixed income. We're seeing those allocations continue to come in. I think there's a good tailwind there.
He just went along Australia.
There you go. Back-to-back hikes at the emerging market central bank over at the RBA. See that? Honestly, there's some offended people down under right now.
I'm not weighing in on this one, but I will say that tomorrow will be really interesting with the BOE and the ECB.
There you go. You tell them, Bramo.
All right.
Rich Crowder's still with us. Rich, I want to come to you on an important topic to wrap things up, a really serious one. The future for Chairman Powell. This is not how usually these things play out. Typically, how this plays out, the chairman knows when his term finishes, he gets a great send-off, he walks away, and he does a $1 million speech in about 12 months' time and has a happy retirement. This feels so different, Rich. Kevin Warsh is ultimately being nominated. We have no idea when the confirmation hearing is going to be. Bob Michaels sat here a little bit earlier and said he thinks the chairman, Jay Powell, is still going to be there by the time you get to the midterms. Rich, how do you think this process is going to play out in the next several months?
Well, you're absolutely correct. This is unprecedented, unusual. That the handoff is usually pretty smooth and very well telegraphed. And the difference, of course, now is several fold. One, of course, is the DOJ investigation of Powell that the Fed is pushing back on. In addition, of course, even Warsh getting a hearing is now up in the air. I certainly do expect Jay Powell will stay on. And perhaps a meeting or two after Warsh finally arrives. Whether or not that's after the midterms, I'm not sure. I think Jay Powell will move on once Warsh is in place to his future life. But his real focus is on maintaining the independence of the institution. And I think he will be in place until Warsh is confirmed, and perhaps a meeting or two thereafter.
Rich, appreciate your insight on the topic. Thank you, sir. Rich Crowder there, the former Fed Vice Chair on this Fed decision and the Chairman's future. If you are just joining us on the programme, welcome to the show. So unchanged, the policy rate of the Federal Reserve about 15 minutes ago. Some dissent, the vote 11-1. That dissent came from an obvious place. Governor Myron voting for an interest rate reduction for the projections. Big focus on what was happening with inflation. They've lifted their outlook for inflation for this year at least, but left the median dot ultimately unchanged, implying one rate cut from this Federal Reserve for 2026.
To me, the most interesting takeaway is what you said, which is this market doesn't seem to care, even though this is very much a dovish hold. This actually is news in Fedland, and yet the market doesn't pay attention because there's another game in town, and it's everything else in the world. And some people might say, oh no, the adults can't control this. They can't step in and save us. And the other people will say, we haven't had a free market in a long time, and this is what it looks like. And guess what? It's a welcome exercise. And so those two sides of the debate are playing out in markets today.
You've got a free market.
Well, I mean, that's the whole thing. Ultimately,
it's too exciting.
Well, I'm kind of excited about this. I mean, that's kind of a nice thing, not to have the thumb on the scale all the time and the same story over and over again.
It's a change.
All right.
It's a change.
I'll get off.
Stephanie Roth of Wolf Research, I can see how excited you are. You're not alone. I've been waiting for that moment for a long, long time. Major moves, 5% away from all-time highs.
Even the Japanese market, it's now exciting. Who knows?
They're actually trading the benchmark in Japan now.
There's actually traders.
Stephanie, I'm sorry. Stephanie Roth of Wolf Research joins us now for more. Stephanie, we need your reaction to the decision and where you expect the emphasis to be in this news conference.
Yeah, I mean, the emphasis is going to be on the reaction function, provided that energy prices end up staying longer. The question is, are they going to end up looking through this, or do they ultimately end up having to be dovish as a result because growth will end up slowing? And our own view is that because the economy is so different today versus 2022, they'll ultimately have to be more dovish as a result of the war in Iran rather than the opposite. Otherwise, it tells you a story of productivity and that growth is actually going to be higher in the future years, but then, nothing else changes. And the one thing that we didn't talk about, or that wasn't talked about yet, was the longer run dot shifting up a little bit.
Well, this to me, Stephanie, that I'm really wondering about is how much does a more dovish Fed enable something that looks more like 1970s or more like 2022 and what we saw with inflation and the read-through? Is that something of a concern for you?
No, because the backdrop is so different today versus, say, 2022. You look at 2022, the unemployment rate was 3.7 heading to 3.5. Today it's 4.4. Payroll gains was growing at 600,000. Today they're somewhere between 0 and 50,000 on average. The inflation backdrop was different. Core inflation was 5.5. Today it's 3. So the idea that we're going to have a repeat of 2022 seems like a very low likelihood event, and therefore that's not something I would expect the Fed to react in that way because the data probably won't support a reflationary type of environment.
Stephanie, given a war, given what oil's doing, John mentions it's 60 to basically 60 to 100 or even higher. We're still slaves to the job market. And the answer is the unemployment rate hasn't broken. With the war, with the distractions, how ex post is this fed into the summer?
Yeah, I mean, I think they're going to be in an environment over the summer where base case is the unemployment rate is probably steady, but they're going to be looking at this most closely. That's going to be the deciding factor between whether they are able to cut, probably not at Warsh's first meeting, maybe in September or December.
Right.
And it's going to all come down to the unemployment rate. Is it notably above 4 or 5, in which case they have a window to be able to ease? And if not, then it's going to be tough for Warsh to get the rest of the members on board.
Bob, synthesize Michael Feroli's work on this then. The fact is the labor market hasn't cracked yet. They have to wait, don't they?
In a world of seismic change, will your business shape the future or be shaped by it? How will we capture the imagination of tomorrow's consumers? Overcome operational constraints to focus on future growth and unlock economic and social prosperity through environmental responsibility. With EY Parthenon and EY's full spectrum of services, we're reimagining the enterprise to shape the future with confidence.
I think that's part of it. I'm still gobsmacked by the Fed's decision. They're basically saying all of this going on in the Middle East is a speed bump. That, yeah, inflation will tick up, you know, 0.3 and 0.2 here and there, but the economy will accelerate, unemployment will stay stable, and it's off to the races. I just don't see that. I think there is a real impact to inflation and then ultimately to the economy and the labor market.
This is the heart of the matter, John. This is the absolute heart of the matter, and everybody has to recalibrate their x-axis to how long is this going to go on, and then you get to demand destruction.
We mentioned this earlier, and I think it's important to keep going over it. We've repriced a lot in this market. We've repriced energy, had a big move from the 60s out to triple digits. We've repriced interest rates. We've taken out a lot of easing for the Federal Reserve, and we've priced in hikes in places like the ECB, 2 of them, I think, for this year now. Yet we haven't repriced growth, and the Fed hasn't either. And I'm not just talking about where spot is trading or the front month on the futures curve. If you go out to December and look at where December is traded right now, we're close to 80. So we've gone from the 60s to close to 80s on the December contract, and the Federal Reserve has lifted the outlook for growth. What's driving that?
I wonder how much momentum they think is in the economy, how much AI and data center spending is going on. Were they surprised by the Delta earnings and that, you know, sales are at a high despite higher energy prices? I think the reality is when you've had close to a 50% hike in energy prices, it's a tax on businesses and households, and they will respond by cutting back some of their consumption.
We have the smartest viewers, and I just want to point that out. Sure. One of the viewers just wrote in. We do. Oh, and pointed out that among the members, the actual dots might say one thing, but the risk to GDP downside included 14 members versus 8 prior at the December meeting. The risk to the upside was 16 members for core PCE, as well as the unemployment rate. That was up from 12 and 13 members respectively. So that stagflationary outcome still in the back minds of so many of these Fed members. They just aren't making this their base case. So I don't understand, Bob, and I guess that this is my question. Is the reaction function essentially they will hold pat even in this scenario? Or do you have a sense of what the reaction function is to true stagflation?
Well, the bottom line is the market is just looking through the Fed right here and saying, doesn't make sense, don't get it, don't know what they were thinking. The projections don't make sense to me, but I know where we are. There's a lot of tension still in the Middle East. It's yet to completely play out. I think where we are now is about fair. It can go either way from here. So it's completely dismissive of the FOMC statement.
Hey, Stephanie, before you go, what's the #1 question for Chairman Powell into this news conference?
Yeah, I mean, the biggest question is going to be, provided energy prices are elevated through much of the summer. How are you going to think about the balance of risk? Is this going to be something that you're going to look through, and do you expect that growth is going to be lower as a result? Or is this something that you're worried about, more similar to 2022? And what are the balance of risks in your mind in terms of how this could play out?
Stephanie, good to see you. As always, thanks for jumping on. Stephanie Roth there of Wolf Research. To build on the conversation, Diane Swonk of KPMG. Diane, I'm going to use a quote of yours to ask you the question. A dual mandate or a dueling mandate? What have we got?
A dueling mandate, and I think that's a real problem. I think the Fed is this dovish sort of numbers don't add up. I think I agree with that completely. A dovish pause is not what I would expect. I would have expected some people to actually put in rate hikes in this meeting, and they didn't. And I think there's a real issue about, we saw rate cuts in late 2024 to shore up the labor market. We didn't get any jobs. We saw rate cuts in late 2025 to shore up the labor market. I don't think we're going to get a lot of jobs from those. That brings up the issue is the problem in the labor market more structural and systemic, something that rate cuts alone cannot cure and spur the demand for workers on? If that's the case, if you cut rates further, you're risking a more persistent bout of inflation, or worse, a stagflationary scenario. And I think the devil in the detail is in that stagflation scenario. Also important is that they raise their non-inflationary rate. That is reflecting, yes, productivity growth and the idea that the economy can grow more robustly without having inflation, but that also means higher non-inflationary rate, which is an important marker to put down before Kevin Warsh takes on as Fed chair, since he has argued that productivity growth should lower that non-inflationary rate. That is not what the Fed is saying. And I think that's very important, but I am very concerned about, we've 5 years in, we've got consumers expecting more inflation than they did in late 2024. And those expectations are going to rise, especially with salient prices like prices at the pump going up. And there's already a long tail due to the problems in the Middle East. Production idled is not easily brought back online. It's weeks to months. And we're rolling supply chains the world over. You create scarcities that go below the destruction in demand. That gives you stagflation.
Diane, is this the Fed meeting where forward guidance just died?
Absolutely. We didn't have a lot of forward guidance to begin with, but absolutely. And I think, what really will be interesting in the chairman's comments is what was the debate in terms of growth, what went into these numbers, how did the debate fall out. I think the devil in the details here is that there is a bit of a stagflationary concern out there, and there should be.
Diane, there's we suffer from 3 zip codes scenario here in New York City. You've got a much greater national perspective. I take real issue with a narrow part of America being affected by $5 a gallon gas. How much of America is going to be flat on their back from some of these shocks?
Equity indices built on opinions? That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
Well, unfortunately or fortunately, we do have fiscal stimulus right now, and that fiscal stimulus will help absorb the shock instead of going into other kinds of spending, and that will help households. Tax refunds are showing up in consumer bank accounts right now, but the combination of fiscal stimulus with, remember, inflation is accelerating right now. We saw PCE accelerate. We saw the PPI numbers today. The translation of the PPI and the CPI for PCE for the month of February hotter, especially on core services. That's aside from what's going on in terms of tariff-based inflation. That is important right now, and I think that's getting lost in translation, but it does show up in the devil in the details of those dots and how the forecasts show up. You could have had one very strong forecast push up the GDP number within the group. There are people who believe within the administration that we'll get 5 to 6% growth this year. That was their forecast going in. If Steve Moran wrote down a number like that, that would have raised the overall growth figure when in fact the rest of the committee is seeing a more stagflationary scenario. I do think it's a dovish pause. That is a bit disappointing right now, given where we're at, even though I'm very worried about the labor market. I just don't think the Fed can cure what ails it.
So Diane, what do you think the emphasis, where do you think the emphasis will be in this news conference with Chairman Powell in about 5 minutes' time?
I think the emphasis is going to be on uncertainty and wait and see, and that will just sort of be where they are right now, and that they don't know where the next rate move is actually going to be. And I think that's the right way to play it.
Diane Swonk. Diane, always good to catch up with you. Thanks for being with us. Diane Swonk there breaking down the Fed decision. If you are just joining us, welcome to the program. The news conference about 4 minutes away with the chairman of the Federal Reserve down in Washington, D.C. In any other time, at any other moment, we'd be talking about the penultimate meeting of the Federal Reserve Chair, but we have not spoken to a single person today who thinks this is the penultimate meeting of the Federal Reserve Chair. And most believe Chairman Powell, including the former Fed Vice Chair, is going to be sticking around for at least a few more months.
Partly because we don't know when the confirmation of the next Fed chair is going to be, and that ultimately lies with the man from North Carolina, Tom Tillis. Ultimately, though, there is this question about credibility for the Fed, continuity. I just wonder, if he gets up there and he says, what we do doesn't matter right now, as long as we don't hike and as long as we don't cut that much, we're not in the driver's seat. I mean, ultimately, this is their pass to say, this is an economy that's moved on from us. We are not in control. We are watching it just like you.
Unspoken, John, will be the idea of the recent election results, including yesterday in Illinois. And I also point out a set of allies saying no to the president on this war, and that Mr. Powell, representing the institution, will stay around more so than the last meeting.
A big piece of this bull case for this economy and for this market has been tax refunds. We hear that phrase get bandied around all the time on this program, tax refunds, tax refunds. How big are these tax refunds actually going to be? And how are attitudes towards the economy changing given the shock of the past few weeks? Where will that money actually go?
Well, we're seeing it now when we look at Chase deposit accounts. We're seeing particularly the bottom couple quintiles of earners see their deposit balances start to go up a bit. But the uncomfortable truth is they're now paying that out again at the pump. And we can't forget that businesses and households were already paying a higher tax because of tariffs on prices. And now energy prices are going to create yet another tax on their disposable income.
Bramwell, the squeeze is real. The energy bills are severe, and they were high already, and now they're getting higher.
You know, Delta and American were perfect examples of how the economy is doing pretty well and people are still spending. The difference is that the costs are getting that much higher. And so the room that people have and that companies have to do okay is getting narrower and narrower, and the Fed's watching this, and they don't have the silver bullet to really make this a better situation.
I did scientific surveillance research today.
Here we go.
EWR to Charles de Gaulle was popping the two of us. You could easily do it for $7,000, and you're enjoying it this morning just under $11,000.
Are you pretending you don't fly business class
Over three.
again?
That's well,
Is that what you're doing?
No, it's not Premier. We're not doing the first class thing, but
Okay.
business class, I'm going to suggest, is up at least 20% instantly. instantly.
Is that Polaris? Is that United Business Class? Is that the front of the plane?
I actually
United?
don't even know. Yes, actually I do. I remember going to something, a demonstration about it, not actually, not exactly experiencing it.
Of course.
I remember seeing
For everybody to know,
we live in different worlds.
For everybody to know, out in the world, John and I are in steerage, and you're on the Gulfstream 450.
That is such a load of.
Nice one, TK. Hey, Bob, before you go, just a final word. About a minute away from this news conference. What are you looking for?
I'm looking for a couple things. I want to understand how they're thinking about the war and the elevated risk to both sides of their mandate. And then secondly, I want to know how they got to their forecast numbers. I think Diane's right. There needs to be some explanation there, and the explanation could be quite simple. It could be, well, one member put in a 6% growth rate. Okay, well, let us know that.
Well, let's get into it in just a moment. The chairman of the Federal Reserve entering the room after leaving interest rates unchanged. Let's take a listen to the chairman of the Federal Reserve.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy has been expanding at a solid pace. While job gains have remained low, the unemployment rate has been little changed in recent months, and inflation remains somewhat elevated. Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. The implications of developments in the Middle East for the U.S. economy are uncertain. We will remain attentive to risks to both sides of our dual mandate. And I'll have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. In our summary of economic projections, the median participant projects that real GDP will rise 2.4% this year and 2.3% next year, somewhat stronger than projected in December. In the labor market, the unemployment rate was 4.4% in February and has changed little since late last summer. Job gains have remained low. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. In our SEP, the median projection of the unemployment rate is 4.4% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.8% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. Near-term measures of inflation expectations have risen in recent weeks, likely reflecting the substantial rise in oil prices caused by the supply disruptions in the Middle East. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 2.7% and 2.2% next year, a bit higher than projected in December. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5 to 3.75%. From last September through December, we lowered our policy rate 0.75 of a percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should continue to help stabilize the labor market while allowing inflation to resume its downward trend toward 2%. But the implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy. We will continue to monitor the risks to both sides of our mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of this year and 3.1% at the end of next year, unchanged from December. As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision. Monetary policy is not on a preset course, and we'll make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people.
Equity indices built on opinions? That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
Thank you, and I look forward to your questions.
Thank you. Colby Smith of the New York Times. There's been some debate about whether the Fed should look through the inflation that will come from higher oil prices stemming from the Middle East conflict. Is that the right approach at this juncture? And to what extent does the fact that inflation has been above target for roughly 5 years now influence the committee's thinking around this?
So, first, let me say we're well aware of the performance of inflation over the last few years and how a series of shocks have interrupted progress that we've made over time. And that happened most recently with tariffs, and now there will be some effects on inflation coming forward. The thing that's really important that we see this year is progress on inflation through a reduction in goods inflation as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise. And we need to be seeing that to sort of understand that we actually are making progress, because on net we didn't make progress. And if you look at total core inflation, it's about 3%, and some big chunk of that, between 1/2 and 3/4, is actually tariffs. So we're looking for progress on that. The question of whether we look through the energy inflation doesn't really arise until we have kind of checked that box. It, of course, is kind of standard learning that you look through energy shocks, but that's always been dependent on inflation expectations remaining well anchored. And I think now it's also dependent on what you mentioned, which is that broader context of 5 years now of inflation above target. We have to keep all of those things in mind, and the question of looking through when it does arise will be one to approach not lightly, but in the context that you mentioned.
And just on the SEP, can you help us make sense of why there is still a bias to cut for most officials this year, despite the upward revision to headline and core inflation and the essentially unchanged forecast for growth and unemployment? Just curious, kind of what's the genesis behind the need? What's the need for the cut?
Yeah, so there are 19 people, and so 19 reasons, 19 individual submissions. And if you notice, the median didn't change, but there was actually some movement toward a meaningful amount of movement toward fewer cuts by people. So 4 or 5 people went from 2 to 1, let's say. 2 cuts to 1 cut. And each person has individual, stories behind what they want to do. But essentially, it is that the forecast is that we will be making progress on inflation. Not as much as we had hoped, but some progress on inflation. It should come as we start to see in the middle of the year progress on tariffs, going through once and then tariff inflation coming down. We should be seeing that. And, the rate forecast is conditional on the performance of the economy. So if we don't see that progress, then you won't see the rate cut.
Thank you. Howard Schneider with Reuters. Just to follow up a little bit and to be clear, is the higher inflation penciled in here for 2026 solely the result of the oil shock or something else?
So that's going to be part of it. But, that wouldn't be most of core, right? So the oil shock for sure shows up here. Some of that will be in core as well. But yes, but no, there's also just the feeling that we haven't seen, the progress that we had hoped for on core goods and on tariffs and on the rest of it. So for whatever reason, people did write up their inflation forecast. That will certainly be tied to events in the Middle East and the price of oil, but it's also, I think, a reflection of the slow progress we've seen on tariffs, which we believe we will see. It's just a question of how long it takes for them to get all the way through the economy, and it just takes some time.
Right. And is the lack of change in the SEPs, again, just to explicate this a little bit, more due to the expectation that the oil portion of this will pass through, or more out of concern that there is a potential blow to consumption and growth coming in the form of wealth effects with the stock market down, in the form of gas prices, diverting spending from other parts of the economy?
So I didn't get the second part of your question.
The consumers are going to be potentially diverting money to gasoline from other parts of the economy. There could be a growth shock or a redistribution of spending there that can hit consumption, wealth effects as well. I guess I'm wondering, is the rate forecast not changing because you think the oil shock is going to be temporary, or because you want to be sure you're positioned in case growth starts to slow?
So the thing I really want to emphasize is that nobody knows. The economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction. To your point, if we have if we have a long period of much higher gas prices, that's going to weigh on consumption. That'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. Something quite different than that. We might have much lower than expected pass-through. So people write down, this is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one, because we just don't know. So I wouldn't say there's a conviction that this is going to go through quickly or not quickly. It's just you got to write something down, and this is something that is that people wrote down. We don't debate how long. How do you do that? We wouldn't be able to debate what the length of or size of these effects would be. We just have to kind of make an individual statement. And also, what you've written down before you'll be reluctant to move too far away from that, just because you don't know. It's so unclear what the direction from this particular end will be. Meanwhile, the growth has been solid. And inflation, the overshoot is mainly from the goods and tariffs. And, the labor market is, the unemployment rate, of course, is little changed since September. You have a very, very low break-even rate, apparently, for new jobs, with little growth in either demand or supply. But the U.S. economy is doing, pretty well. It's just we don't know what the effects of this will be, and really no one does.
Mr. Chair, in the past, the staff has suggested that higher oil prices, they have a hit to consumption, which Howard was talking about, but that's somewhat offset by increase to domestic production. I wonder if you could talk about that dynamic, especially to the extent that how much U.S. production is happening right now.
So the first thing is there is, the original thinking, the long-standing thinking, put it that way, is that you do look through energy shocks. But as I mentioned, that's conditioned on inflation expectations and that kind of thing. So, sorry, your question was?
What the staff is saying about, and has said in the past,
Yeah.
about
So there'll be an offset.
Offsets, yeah.
So that's true. We have we're a net exporter of energy, right? So any effects on employment and economic activity and spending would be offset to some extent by the fact that our oil companies will be more profitable and they may even do more drilling. If you ask oil companies about doing more drilling, though, they're going to want to see, a consistent rise in oil prices from where they were before the buildup for the war, and they're going to want to believe that that's going to be persistent for a fairly long time. So they're not sitting there waiting for oil to go over $70 a barrel, and then they're going to start drilling or whatever. They're going to make a reasoned, careful judgment that we're going to have higher oil prices for an extended period of time, meaningfully higher. So I wouldn't say there's much of that happening. Not much will be happening now, but some of that could happen over time if you see that. But so the net of the oil shock will still be some downward pressure on spending and employment and upward pressure on inflation, of course.
And if I could just follow up on Colby's question, how much do you worry that having looked through tariff inflation and inflation running above target and looking through the oil price shock would undermine the credibility of your commitment to the 2% target?
We have to do our analysis and think these things through carefully, but of course that's on everyone's mind. We're well aware of the history, but you don't want to overreact to that. You want to make the best judgment you can based on the facts. I don't think we're going to let it color our decision making more than is appropriate. It's more the thought that it's been 5 years, and we've actually had we had the tariff shock, we had the pandemic, and now we have an energy shock of some size and duration. We don't know what that's going to be, actually. And, it's one of those things where it's a repeated set of things, and you worry that that's the kind of thing that can cause trouble for inflation expectations. And so we worry a lot about that, and we are very strongly committed to doing what it takes to keep inflation expectations anchored at 2%. And, I think it's important that we do that. Very important.
Nick.
Nick Timmeros, Wall Street Journal. Chair Powell, you've described monetary policy as modestly restrictive. If the unemployment rate is roughly stable, inflation moving sideways in the high twos, with an ongoing overshoot in services and non-housing services, not just goods, and the economy doing fairly well as you just outlined, what gives you confidence that inflation returns to target over the next couple of years?
Okay. So I would say the rate is, you can characterize it as in the high end of neutral, or you can characterize it as perhaps mildly restrictive, even modestly restrictive. No one knows for sure, but it's in that range where it's somewhere around the borderline between restrictive and not. Remember that a big part of the disinflation we're looking for is just the runoff of when tariffs are put into place. Of course, what they do is they raise prices to some extent, to the extent those prices the tariffs are paid by consumers on a one-time basis. And we're waiting for that process. It takes 8, 9, 10, 11 months, a year to go through the system. And we're waiting for the tariffs, which were put in place over the course of the middle part and later last year. We're waiting for that to go through the system so that goods inflation will return closer to what it's always been. I mean, it used to be, for many, many years, it was negative. And then, the year before tariffs came in, it was 0. And it's running at like 2% now. So, so that's kind of, goods inflation is running at 2%. So that's not coming from standard Phillips curve restrictive restrictive policy. It's coming from the runoff of a one-time thing. We also think it's important, though, to keep policy either mildly restrictive or close to that, but not too restrictive because of the weakness in the downside risk in the labor market. We are balancing these two goals in a situation where the risks to the labor market are to the downside, which would call for lower rates, and the risks to inflation are to the upside, which would call for higher rates or not cutting anyway. So we're in a difficult situation, and we feel like our framework calls on us to balance the risks, and we feel like where we are now is just kind of on that borderline, the higher borderline of restrictive versus not restrictive. We feel like that's the right place to be.
Can I ask about core non-housing services, though? Because there are some people who think that it hasn't come down very much, if at all, over the past year. If wage growth has come down, if the labor market has loosened, why has non-housing services inflation maybe been slower to follow?
That's a good question. It's frustrating. Non-housing services they basically moved sideways for a year. They're at the same level. And we do expect that they will come down, but it's a bunch of idiosyncratic things. But at the same time, that is one of the things we should be seeing, because to your point, the labor market is clearly not a source of inflationary pressures, and that should really matter for non-housing services. But we're not seeing progress there. So we do, what we expect for next year is what we want to see for this year, rather, is continued progress on housing services, finally seeing that, the goods inflation come back down because the one-time effects of tariffs are through, and then also get some help from non-housing services. That's what we'd like to see. But it's a good question why we didn't see much of that last year.
Edward.
Thanks, Chair Powell. Edward Lawrence with Fox Business. So in December, we saw employment numbers revised down to negative 17,000. January revised down. February posted a loss of 92,000. Is the employment side a far greater risk than the inflation side? Because we are seeing inflation, CPI is close to 2%. PCE has ticked down overall.
It's really, I wouldn't say that. I wouldn't say that that's clear at all, that one is more at risk than the other. So you can point to the unemployment rate being stable, and in a world where both supply and demand for workers have come down very, very sharply over the course of the past year due to immigration policy largely, a ratio is going to be a better thing to look at than job creation, for example. So, and the ratio is the unemployment rate, and it's been stable since September. So that tells you that. Inflation, you can. We're at 3.0% core inflation, 2.8% headline. So we've been well above the 2%, that amount, whatever it is, 0.7, 0.8, or a full percentage point above 2% for some time. And that's a concern. We need to get back down to 2%. And we need to keep focused on that, even though we do now face some new inflation from energy. So I'd be hard-pressed to say that one of them is obviously more at risk than the other.
And if I may, what happens if there's no Federal Reserve chairman confirmed on May 15th? Would you stay on?
So if my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. That is what the law calls for. That's what we've done on several occasions, including involving me, and it's what we're going to do in this situation. And while I'm at it, on the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. And I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet. And I will make that decision based on what I think is best for the institution and for the people we serve. Figuring you probably were going to set the dominoes off there, Edward. And I'm not going to have any more to say on those issues, by the way.
Thank you very much. Claire Jones from the Financial Times. People have drawn quite a few historical parallels with the current situation. We've seen oil price shocks in the past. Some people have said the first Gulf War and the Fed's response to that, where there was a focus on the growth risks, is the right parallel. To what extent would you agree with that, and to what extent would you think we're in a different place today? Thank you.
It's really hard to say until we see the situation, the actual situation. In some circumstances, that might be the right case. In fact, for example, if we do see the kinds of disinflationary progress that we expect to see due to tariffs that I mentioned, I think it's hard to say, and it will depend to some extent on the size and duration of the effects we're seeing on prices, and it will depend a lot on what we can see in inflation expectations.
And just one follow-up, if I may, just on the BLS report that was mentioned briefly there. It doesn't seem from the projections or from the comments you've made today about the unemployment rate and focusing on that your view on the labour market story, to a large part being a supply side story, has changed despite the quite negative number in February. Would that be the right take, and was there anyone else in the room who thought differently and that the February jobs report was cause for concern?
So I think you have to take the two together. You know, in a way, the January report was a positive surprise, and the February report was a negative surprise. If you put them together, you get something in the middle, and I think you have to really, as you do, I'm sure, realize there was a strike and there was weather, and that's about 80,000 of the negative effect total on the February report. Notwithstanding that, so what do you see if you take a step back overall? There are a number of indicators that suggest a degree of stability, but the thing that I think a good number of people on the committee are concerned about is just the very, very low level of job creation. If you adjust what has been the trend job creation over the past, let's say, 6 months, if you adjust that for what we think, our staff thinks, is the overstatement due to overcounting, effectively there's zero net job creation in the private sector. But actually that looks like that's about what the economy needs in terms of dealing with very, very low, non-existent really, growth in the labor force, which of course we've never had in our history. So you've got a sort of a zero employment growth equilibrium. Now that's balance, okay, but you know, I would say it does have a feel of downside risk, and it's not kind of a really comfortable balance. So you know, we look at that, we see it, we get it, and I mean everybody understands the arithmetic, and that's you can say the break even is zero, but nonetheless it's something we're watching carefully, and so and you know, are concerned about. But ultimately though, you can argue that it's a consequence of deliberate policy, which is really the changes to immigration. That's the biggest factor there, and but nonetheless something we watch carefully.
Andrew.
Thanks, Chair Powell. The economy's experienced a series of supply shocks in the last few years, COVID, tariffs, 2 oil price shocks. Do you think that is bad luck, or has something changed in the world that makes supply shocks more common, and does the central bank need to start taking account of the risk of supply shocks as a more common problem?
You know, we did go through a long period where the shocks were all demand shocks, and you know, so we've had a lot of practice thinking about supply shocks in the last 4 or 5 years for sure. And it's just a very different thing, and a much more difficult thing, because it does immediately raise the question of tension between the two parts of our mandate. But you know, has the world changed? I mean, COVID is a one-time thing, right? This energy supply shock is a one-time thing. It's not because of some broad tendency or anything, I don't think. And you know, the oil shock with Ukraine was also a consequence of military action. So I don't know that the world has changed in a way that there'll be more supply shocks. But you know, there's people have written that paper and that speech a number of times. A number of people have tried to make the case that that is the case. And in fact, we have seen more supply shocks in the last 5 years than we've seen in many years before that. It's a fact.
Okay. You said last year that the Fed was reviewing its communication strategies, including the SEP, as part of its framework review. Whatever happened to that? And I have like 5 follow-ups to that, but you know, I guess, you know, what would you change about Fed communications if you had the time? Thanks.
What happened about that was not much, and I'll tell you why. So, you know, we looked carefully at many aspects of the SEP and of our communications, and there weren't any ideas that had very broad support on the committee. And you don't want to make a change to your communications unless you have the committee behind that. So we didn't really make any changes on that. I had hoped that they had some things that I wanted to do, but they didn't attract broad support, and we'd already made all the changes we made to the framework. That was a critical thing. So we didn't. And, I wish we had been able to do some things, but we didn't. So maybe the next chair will take a look. I'm sure he will.
Michael McKee from Bloomberg Television and Radio. The minutes show in January some members of the committee wanted to include a two-sided guidance on policy. Was that discussed today? And given the rise in the inflation expectations, how much support for a two-sided policy warning would there be?
So it did come up today. The policy that the possibility, rather, that our next move might be an increase did come up at the meeting, as it did at the last meeting. The vast majority of participants don't see that as their base case. And of course, we don't take things off the table. But you correctly characterized, what was in the minutes that several participants indicated, and something very much like that conversation did happen. What was your second question, though?
I was just one question there, but follow-up would be, there are a lot of goods besides oil that are trapped in the Strait right now, and a lot of supply chains getting snarled. How much concern do you have about whether, if this becomes an inflation problem beyond just oil, whether there's anything you can do about it or would do about it, given the efficacies of monetary policy?
You can worry about other commodities. You can worry about all of the ways that oil-related commodities go into manufacturing and that kind of thing. The truth is, it's completely out of our hands, and we just, like everybody else, we have to just wait and see what happens, and it'll come down to how long the current situation lasts, and then what are the effects on prices, and then how do consumers react and that kind of thing. Really, I wouldn't speculate in any way, and there's really not a lot we can do other than kind of watch and see.
Maria Luisa.
Afternoon, Chair Powell. Maria Luisa Capurro with Bloomberg News. I wanted to ask you, you've said longer-term measures of inflation expectations reflect confidence that the Fed will get back to its 2% goal, but there are some colleagues of yours who have pointed to higher dispersion in household service, in business service as well. So, and that they take as a signal that inflation expectations may be less sticky than in the past. I'm wondering if there was a discussion around that at this meeting across the committee, and what were the views of what is the state of inflation expectations and the risks from higher oil and gas prices.
So at this meeting, I mean, a number of people mentioned and staff briefed on short-term expectations having moved up quite a lot for reasons we understand well. But long-term expectations, you can always find one that's troubling or some aspect of one that's troubling, but ultimately, right through this whole period, the overwhelming majority of the things we look to, including markets, including surveys of the public and also of forecasters, they've all been pretty solid on longer-term inflation expectations being right where they need to be, consistent with 2%. So that continues to be the case. We didn't have a lot of conversation about that. I think everyone does agree that we'll be watching those extremely carefully as we see the effects of the price increases come through from the conflict.
And still on how the discussion went across the committee, before coming to this meeting, there were some members who were discussing the risks of a slowdown in growth and at a time of where inflation remains high. It really doesn't seem that most members are penciling in a slowdown in growth.
No.
But has there been any discussion of the risks of stagflation at this point?
So people actually wrote up their growth forecast by a tenth, and I think that's probably to do with just growing confidence in productivity. But sorry, and your second question was just.
If there have been any discussions about the risk of stagflation scenario.
Yeah, so as I mentioned, there is tension between the two goals, right? The upward risk for inflation and downward risk for employment. So, and that puts us in a different situation. When we use the term stagflation, I always have to point out that was a 1970s term at a time when unemployment was in double figures and inflation was really high and the misery index was super high. Add them together, you get the misery index. And that's not the case right now. We actually have unemployment really close to longer run normal, and we have inflation that's 1 percentage point above that. So calling that stagflation, it's not. I would reserve the term stagflation for a much more serious set of circumstances. That is not the situation we're in. What we have is some tension between the goals, and we're trying to manage our way through it. It's a very difficult situation, but it's nothing like what they faced in the 1970s, and I reserve stagflation for that, the word for that period. Maybe that's just me.
Elizabeth.
Thanks so much. Elizabeth Schulze with ABC News. President Trump says that oil prices and overall inflation will go down very rapidly as soon as the war ends. Do you agree with that?
I don't have a forecast on that.
When we're thinking about the impact on American households, as you know, they've been facing these higher prices for years. They've seen an almost $1 increase in gas. How worried are you about households, especially lower income families, being able to afford those price hikes? And should people be bracing for higher costs, including for food now?
We don't know how big these effects are going to be, and I don't want to characterize them in any way. Of course, people are already seeing gas prices. Gas prices are up almost $1 a gallon. We hope that isn't for a long period of time, and of course people will feel that, but I don't want to speculate about what that might mean, because honestly that would sound like I have some idea of what's actually going to happen, and I don't think anybody really does. We're going to see how this works out, and I just would leave it at that.
Victoria.
Hi, Victoria Guido with Politico. I just wanted to ask, for purposes of the next meeting, how the Middle East war develops between now and then, how are you thinking about what might guide action at your next meeting? I mean, if we have oil prices, above $100 a barrel the entire time until the next meeting, is that going to change your wait and see stance? Like, what would lead you all to move, or are you on hold pretty indefinitely?
We'll have to wait and see. I mean, we always say we're going to learn more by the next meeting, and usually we do, but in this case we're going to learn a lot, because we're going to learn 6 weeks to the day till the next meeting, and we're going to see whether what happens is it's going to be very important for the way the economy looks and the way the outlook evolves. With what happens in the Middle East, that's going to be a big factor, and we'll know that then. I don't know how it's going to affect our thinking. I really don't. And we did talk about alternative scenarios a little bit, but it's just, I wouldn't bring that in here. It's very uncertain, and I just want to remember that we don't know, and we shouldn't assume it's going to be one thing or another. We're going to see.
So is it a matter of you don't know how the situation itself is going to evolve, or even if things remain as they are, the economy could still remain relatively durable in face of them?
Yeah, that's true too. No, I mean, the U.S. economy has just, made it's been strong through a whole bunch of challenges. I mean, if you go back to 2023, when we raised rates a lot in 22 and 23. And close to 100% of economists called for a recession, which didn't happen. In fact, 2023 was a really strong year. So the U.S. economy has really been just doing pretty well through a lot of significant challenges over the past few years. It's been amazing to see. And I don't know what's going to happen in the next intermeeting cycle, and I don't know what's going to happen in the Middle East. I wouldn't want to speculate.
Hi, Chair Powell. Thanks for taking our questions. What makes you so certain that tariff-related price increases will be a one-time effect? I don't think we've seen you since the Supreme Court tariff decision, and it's pretty clear that none of us know what the extent of the tariff shock will be as the administration moves to replace some of the tariffs that were overturned. So I suppose I'm curious, what would make you question this certainty that tariffs are going to be a one-time price effect?
Well, I would not at all use the word certain about my views on that. I'm not certain. I'm uncertain. But just if you think about what it is, it's a one-time increase in the price of a good, right? And what inflation is ongoing increases in prices this year, next year, the year after. That's what inflation is. It's not a one-time price increase. There's a very, very big difference. The public doesn't really focus on that, but that's the difference. And tariffs should be in theory, unless they cause people to start expecting still more tariffs the next year and still more tariffs the next year, they should be a classic one-time thing. People say the same thing traditionally about an energy price spike, because traditionally prices go up and they come back down. And by the time monetary policy would react, you would it would be over. So I don't have tons of confidence on that. I mean, I think the theory is probably right, but as usual, the time it takes to get all the way through the economy is just very uncertain. And we found that coming out of COVID, that the inflation did go away, and largely for the reasons we thought it would, but it took 2 years longer than we thought. And so I think we have to be humble about knowing how long it will take for tariffs to go all the way through the economy. And so what we've been doing is our staff's been doing. It's very interesting. They started off with just an estimate because there wasn't a real history, and then they've built, based on the history that they're seeing of tariffs coming through into prices, they can now have an arc, and for all the tariffs they can say, well, so we have, I think, a slightly more confidence that we will see tariff inflation coming down, not prices, but you won't see further increases, and we should start seeing that more and more in the middle parts of the year. We do expect that. Now, you're also right, though, that the level of tariffs came down fairly meaningfully in the wake of the court decision. But the administration said they're going to move they're going to get that rate right back up to where it was. So, and we assume that they'll do that over time. So that's how we think about it.
Thank you.
Hi, thank you. Chris Rugaber at Associated Press. You talked about the shortcomings of the SCP in this environment. I wanted to ask about, or throw in an additional thing, which is the fact that it's happening before transition. Is there still some value, perhaps, in the public knowing what other Fed officials are thinking, the ones who will stay on for the rest of the year and beyond? And does that even handicap your successor in any way? Well, just in terms of having a whole committee expressing its views, is that something that locks them in for the rest of the year?
No. We never. The SEP is never. People are more than happy to change their SEP dots. They're no way bound by them. It's your opinion at a moment in time, which can change based on events. Sometimes very quickly. So it never locks people in. People are more than happy to be proven wrong in either direction, and so I just think we do it. And I mentioned this was a time when it's very hard to do it. During the pandemic, we actually took one meeting off, I think, but we don't like to do that just because it's hard to do. We should just keep doing it. But I just would say for this one, though, I think it's even more than usual good to take the forecast with a grain of salt, because subject to just very high levels of uncertainty.
Brian.
Hi, Chair Powell. Brian Chung with NBC News. So you mentioned at the beginning of this conversation that you're well aware of the history of inflation running above target. It seems like that might be what's underpinning the affordability problem that we're hearing a lot about on Main Street. Are there any signs to you that that's impacting the psychology of the consumer, especially given that they're a big driver of overall economic activity?
I'm not sure what that's all about, but I'll tell you what I think and what we see in surveys, and that is, there were big price increases all around the world, by the way. Everywhere in countries like the United States had basically the same kind of thing. It was a global inflation coming out of the pandemic, and everywhere people are feeling like real wages have been going up in the United States now for 3 years, roughly. But people are not feeling good about it yet, and it will take some years of positive real earning gains for people to feel good again, we think. But you're right. But when you talk to people, they do feel squeezed, and there are areas where prices are still going up, like insurance. Various different kinds of insurance are getting more and more expensive, and that's just catching up really from inflationary pressures that take a while to get to into the price. So we take it very seriously. We don't dismiss it at all. It's a very real thing from the standpoint of what people are experiencing, and what it does for us is makes us even more committed, if that's possible, to getting inflation back to 2% on a sustained basis.
How does the Fed's independence play into the ability to address affordability?
Well, independence is what allows us to do our jobs, and stable prices is half of our mandate. It's one of our two mandates, maximum employment being the other. I mean, look at every advanced economy that looks anything like the United States, anywhere in the world, in a market economy, in a democracy, and you'll see, pretty much central bank independence that looks a lot like, in some cases, stronger than what we have. But it's critical that we have that so that we can do the things when we need to do them to preserve price stability. And it's an accepted standard practice, and I think has a lot of support, certainly in Congress, which is where our oversight is in Congress. And you see that among Democrats and Republicans in the House and the Senate.
Hi, Chair Powell. Richard Escobedo at CBS News. Thanks for doing this. Two questions. One, how high would oil prices and broader inflation have to go, and for how long, for the committee to consider hiking rates? And then secondly, diesel prices are rising faster than gas prices. How concerned are you that the increase in diesel might drive up food and goods prices and lead to broader inflation?
Yeah, I'm not going to give you an example or a specific answer on the first question. We're prepared to do what needs to be done, but I wouldn't want to hypothesize about what that might be. In terms of diesel prices. So your question there is, are we concerned about it? I mean,
how concerned, and whether or not it will drive up, the cost of food and other goods that really rely on it to
So
move
I think
across the country.
it's a more general concern than that. It's diesel prices because that's transportation of food and things like that. There are just lots of ways that oil and derivatives of oil get into the production and transportation of many, many things. So, and those, there are big effects in headline inflation, but things like that leak into core as well. And the effects may not be as big, but they're quite real and they're material. So we are aware of that and we're watching it, but we're right at the beginning of this, and we don't know how big we just don't know how big this will be and how long it lasts. It may or may not be something that really makes a big imprint on the U.S. economy. We're just going to have to wait and see.
Thank you.
Archie, for the last question.
Thanks very much. Just to sort of stare into the future for a little bit, I was looking at the longer run bits of the SEP. I noticed that the growth estimate had been revised up a good chunk from 1.8 to 2, and the kind of long-term Fed funds rate as well. It'd be great just to hear, is that AI productivity or what's going on there exactly?
Yeah, I think it's just productivity. We actually started seeing meaningfully higher productivity some years ago, 4 years ago, 5 years ago. And that's not because of generative AI. We won't know for years what it's really due to, but it could be due to the kind of things that people did during the pandemic to economize and somehow become more productive because there was an incredible labor shortage. But I think economic forecasters are very skeptical of periods of high productivity because they're so rare and they're often revised away. And for many of us, I never thought I'd see this many years of really high productivity, and by the way, expect it to continue. And we haven't really started to see the effects of generative AI, and that should certainly contribute to that. So it's quite unusual, and it's this is the higher productivity is the thing that allows incomes to rise over time. And so it's a great thing. Was that your question?
Yeah, no, I was just curious what lay behind that. And just briefly on that as well to finish up, you hear the argument a lot, this is a sort of disinflationary story, and if you believe that productivity thing, that should also weigh down on inflation over time, maybe then kind of pull down where rates end up. Do you kind of agree with that line of thinking, or do you think that's not how you should think about where the rates
I think you have to be cautious about that, in particular if you're talking about AI, about generative AI. So remember, in the short term, what's happening is we're building data centers everywhere, and that's actually putting pressure on all kinds of goods and services that go into building these things. So that's actually probably pushing inflation up at the margin. In addition, it probably raises the neutral rate So in the near term, you're not looking at something that would immediately call for lower rates or that would be lowering inflation. Over time, though, sure, it can be if it's expanding potential output, which is what higher productivity does, then it actually can be. But I think it's an empirical question because it's really is the demand growing faster or slower than the supply side? And I think we just don't know that answer ex ante going in. We'll just have to wait and see. Thank you very much.
The chairman of the Federal Reserve. If there was a good meeting to scrap the forecast, then this one was probably it. The chairman de-emphasizing the projections, re-emphasizing the uncertainty, focused on the shock in the Middle East. We had one question. How would they respond to it? Would they look through it? The answer, it's not that simple. Equities in response negative. Near session lows right now, down 1% on the S&P 500. Likewise on the Nasdaq. In the bond market, 2s, 10s and 30s. Yields higher, particularly at the front end of the yield curve, up by 7 basis points on a 2-year, 3.75. If you, like me, thought this would be boring, this was not a snooze. The Federal Reserve Chair asked about succession. Take a listen to what he had to say.
If my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet.
3 points from the chairman of the Federal Reserve. Let's go through them individually. Point 1, I will stay on as chair until a successor is confirmed. Point 2, I have no intention of leaving the Fed while the DOJ investigation is ongoing. And point 3, even after that is complete, I haven't made a decision on how long I'll stay on. A big headline in that news conference.
He actually engaged with the question. We all were wondering whether he would give some sort of clarity, and we've got it. He is going to be the Fed chair until Kevin Warsh is in the seat. There's this question of what is well and truly over in terms of the investigation actually mean. A lot of people are going to be wondering that. And the fact that he hasn't made a decision yet. What is going to tip the scales for him to understand when he can make the decision? Either way, this wasn't a boring news conference in any way, shape, or form.
If we can bring up just an intraday chart of the front end of the yield curve, so bring up the 2-year intraday and just have a look where things started to pick up. The Fed chair throughout this news conference was leaning into anchoring inflation expectations. That was notable. But we started to really bounce out to session highs when he started to lean into that question about his future. And I just wonder, Bremo, we can have that conversation with guests over the next 15 minutes or so, whether those two things are connected to some extent.
On the margins, this market seems to be treating a Kevin Warsh Fed as being more dovish simply because we have President Trump tweeting or Truth Socialing every single day saying, too late, Powell needs to lower rates. Right now you see there is no full rate cut getting priced into the Fed funds futures until June of next year. So that's how far we've pushed it on. There was a 1-2 punch. Fed Chair Jay Powell also said it's too soon to know the full economic effects from the Middle East. And then he said he would stay on. And we have known this is a pretty balanced Fed. They're weighing the risks. And clearly the specter of 2022 hangs over his Fed chairmanship.
Okay, you'll go out to the specter of it and the view forward. I like what Liz Ann Saunders does, retweeting Claudia Sahm. Finally, Powell throws the SEP under the bus. Skip it. Thank you, Dr. Sahm, for that. My observation, John, is it's 10:21 p.m. in Doha. And I'm looking at the headlines while the chairman's speaking, and I get the Warsh view forward and the crystal ball gazing out 6 months. I think we got to gaze out 24 hours right now. That's the tension I see in the Iran headlines that we get out of Tel Aviv and we're getting out of Dubai right now from Bloomberg.
And this is why it makes it so difficult to provide forecasts in a moment like this one. And the chairman quite rightly talked about the need for humility, the duration of this shock.
Yes.
Energy assets are in play in the minds of some people now after the strikes we saw on Iranian energy assets just earlier this morning. Crude at the moment at 109 on Brent, WTI around 98. The chairman is well aware that they've missed their inflation target for the previous 5 years, overwhelmed by a series of shocks, and this is another one. Now, you may still believe ultimately this Federal Reserve will look through this shock, but that wasn't a chairman that wanted to make that point in this specific news conference.
He didn't want to say the T word, even though essentially this forecast would suggest transitory. He tried to play the part of an oil expert. He tried to play the part of a generative AI expert, but nonetheless, he said it is too soon to say so many times over again that we lost count. They are facing off with a series of shocks. with the backward view of what happened in the post-pandemic era where you had inflation that creeped up to 9%. He will not want to continue that, especially with core PCE creeping higher in the wrong direction before even getting this oil.
The headline to me, John, I know we got to get to Dr. Sluck, but
sure.
The headline to me was a lack of dissent. I mean, this was very Greenspan-y and everybody on the same page supporting this chairman.
The standout here, TK, and for our listeners and our audience worldwide just tuning in, the decision dropped about an hour and a half ago. The interest rate remained unchanged. The median dot still implied one cut for this year. Lots of noise, though, beneath those headlines. The outlook for growth was better. The outlook for inflation was higher. But that single dissent was Governor Myron. And Governor Waller was expected to dissent. He sat around this table only a week, 2 weeks ago and said it depends on the next jobs report. An hour later, the jobs report came in way weaker than expected. And we all thought, we know what the governor's going to do. He's going to vote for an interest rate reduction. And then he didn't. And that's off the back of the shock in the Middle East, and that's more than notable.
Governor Chris Waller, I think, is arguably the most interesting person on the Fed right now in terms of what his decision actually was driven by. I'm curious if he comes out and says he is getting spooked by the direction of core PCE. He's getting spooked by the component of what oil prices do to that. And we talk about wage inflation. Wage inflation is still running above where it was in the pre-pandemic period.
Hey, John, I was looking at F1 in Japan here, and you said do something serious. So I looked at the price of oil here, as you mentioned earlier. Brent crude up 81% from whatever the bottom was. Saudi light, Persian Gulf,
the physical market,
145%. Same number.
And this is
80%,
the point.
145.
It's the point that Jeff Carey of Carlisle was making a little bit earlier on this morning. There's a big gap right now between the physical market, where spot is trading, and the paper market, and he thinks it needs to close. He thinks the paper market needs to wake up to the real risk emerging in the Middle East. That's one opinion, one view. Other people aren't as concerned, but ultimately, that's his opinion.
Every oil strategist that comes on says, why is everybody else so complacent? What we're seeing is really a different scenario than we've ever seen before. And a lot of people say, yeah, you guys always get it wrong. And so ultimately, this debate will continue to play
What did we say a few weeks ago? If you want to make a fool of someone on Wall Street, ask for a crude forecast. That's always been the way. It's the hardest thing to forecast. Thorsten Slock is not a fool. He joins us from Apollo. Thorsten, good afternoon. Good to see you.
Good to see you.
You've had some time to go through this one. Your big reaction, please.
Well, I think one interesting thing here is that if we begin to describe everything as another shock, there's another shock, there's another shock, and we're looking through that, it almost makes it sound like, well, I don't really have to react to anything because I've identified, well, now there's just another shock coming along on oil prices. There was another shock from trade war. There was another shock from COVID. It makes it sound like that you should never do anything as a central banker. So now we have a shock that is very serious, and it's very, very clear that they decided to just basically completely ignore the Middle Eastern shock that we're facing here. So from that perspective, it is quite interesting, as Lisa is saying, why was it that Waller suddenly changed his mind? Because it must be that he did put more weight on the Middle Eastern and the Iranian shock than what the average committee member did here.
Do you think that you can infer anything from the price action as John was laying out, the idea that 2-year yields and 10-year yields inflected upward, as Fed Chair Jay Powell said that he planned to stay on should there not be another Fed chair nominated and in the seat by the time his term expired?
Absolutely. Let's just talk about it the way it is. At the last meeting, there were 10 people voting for interest rates to stay unchanged. At this meeting, there were now 11 people voting for interest rates to stay unchanged. It's very clear Steve Iran at both meetings voted for rates being lower. But at this instance, when he suddenly now says, I may be staying on until this is well and truly investigated and complete, the risk is beginning to rise that, well, maybe we'll have another hawkish member sitting for a longer period. And assuming, therefore, that Trump will appoint a more dovish member, that does, of course, lean more towards that we will have a more hawkish Fed if he does stay on for a longer period.
But he's not hawkish. Why is he considered hawkish?
Well, he's hawkish relative to the alternative of a more dovish member coming along.
You were weaned at Deutsche Bank under Folkers Landau with Adam Szyminski and Paul Sankey. Their back of the report Excel spreadsheet was absolutely definitive about the supply and demand of hydrocarbons. Take that experience now, and how do you apply that at Apollo when you look at the American economy?
Well, it's very clear when you think about demand and supply in oil that the supply equation just changed quite dramatically now that we suddenly have much less supply because of the Strait of Hormuz being closed and because all the cascade of effects that are likely to come along if this does continue for a longer period. So on the supply side, we will likely continue to have the very important question, namely how long time is it going to last before we get supply up to the levels where demand is. And if that's going to take a longer time, then the risk is that energy prices and oil prices are going to stay more elevated. It's also fuel prices, of course, that are, of course, going to jet fuel. It's also, of course, fuel prices that are marine fuel. All these parts of energy complex are absolutely seeing some upward lift, and the longer the shock lasts, the more we will see energy prices stay more elevated.
When does this get real for you? At the start of this crisis, and we can call it that, people came on Bloomberg surveillance, on Bloomberg TV, and made the point that if it's days, not weeks, it's okay. And here we are more than 2 weeks into this, and now we hear if it's weeks and not months, it's okay. When is it not okay?
Well, the next one will probably people saying if it's months, it's not quarters, then we will also have a change. So you're absolutely right. The fear is, of course, that if it does continue at the Fed level, if you put this into Purpose, the Fed's model of the U.S. economy, it has to last at least 1 quarter, because that's the only way you can get a real serious shock to begin to feed through. If it begins to last, of course, several quarters, then it's a much more serious effect. But it is ultimately about that duration question, and that's what the market is trying to figure out. And the Fed very clearly told you today that they do not think that this is going to last a long time.
Mike McKee in the news conference. He's run back out for us. Mike, welcome back to the programme. Some key headlines in that news conference. What jumped out for you?
Well, I think two things, John. One, there was a sort of more humble aspect to what Jay Powell was saying. When it came to tariff price inflation, he was conceding that it wasn't doing what they thought it would do, lasting longer than they had anticipated. And now layer on top of that inflation that will come into the energy markets and perhaps others because of oil. And so he was less saying the idea that, well, we're prepared to go either way depending on what happens with the economy, as he was saying, we've been fooled. And we're not going to put ourselves in that position. We're going to sit back and wait so that we don't react wrong because we've been wrong. The other thing, of course, was what Powell said about whether he's staying on or not, because he's refused to talk about that so far. He did acknowledge what his lawyers told the Department of Justice in their deposition. But the most interesting thing was he said he's staying as chairman pro tem, and that's the law. Well, there's a presidential counsel's office memorandum that says, no, it's the president who can appoint somebody as the chair pro tem. So we could be looking at another big legal fight down the road if they don't get Kevin Warsh in there by May 15th.
Yeah, Mike, this is where the problems arise with the chairman really engaging in this topic this afternoon. Does it provide consistency or just introduce even more controversy?
Well, he's trying to provide consistency, I suppose, by saying not much is going to change until my successor gets here. But whether or not that's a shot at the president or some sort of way to push back on the pressure he's been getting, we don't really know. But at this point, you have to think the White House is going to disagree with that interpretation of who's chairman pro tem. Now, it's important to realize, too, that the chairman pro tem of the Board of Governors is largely irrelevant for a short period of time until they get Kevin Warsh confirmed. It's staying as chair of the Open Market Committee that would really bother the president, because as Torsten was just saying, leaves somebody who's more hawkish, more likely to vote for a hold on the board.
Mike McKee with the latest. Thank you, sir. Appreciate it. Great job as always. Mike there at the Federal Reserve down in Washington, D.C. Torsten, can you answer that question? We've touched on it briefly with you. Just expand on it. Does it provide consistency or introduce controversy?
Well, it would definitely be a lot cleaner if you have a Fed chair and then that Fed chair walks out and a new Fed chair sits down and then we continue with the new Fed chair.
That's how it usually works.
That's how it normally is. That's how we want a Greenspan, I've got on a Yellen, on the Bernanke. But now that you suddenly have this issue that the existing Fed chair, either he may stay on the committee, which is also a huge issue, or we may not have Kevin Warsh in the seat. And as Mike was just saying, that will raise all these other legal issues around, well, is this something that you can do or not do? And that, of course, begins to just raise a lot more uncertainty about Fed independence and what is the institution making of decisions.
Do you think that it's leading market participants to not take into account some of the forward guidance or some of the discussions on the Fed, that there is less credibility as a result of some of the increasing political rhetoric around this institution?
Well, I think that we are moving towards a Fed where the focus will be at the extreme on dissents. Today we had 11 versus 1. That was very clear. But going forward, we are likely going to have, especially especially over the next several quarters, as other FOMC members might be leaving, we will have much more scrutiny of what are the existing members saying, what's the differences in speeches, what's the differences in footnotes between someone who was dovish, someone who was hawkish. We are entering an era of Fed watching where things are getting much more complicated because it has this political dimension of why is this person saying this? Is this person staying on the committee for political reasons? It just opens up a whole different dimension to Fed watching than what we've been used to for a long time.
Fed parlor game, but you're expert at this. On a global basis, this central banker to the world, to borrow from Bill Rhodes, Jerome Powell has to look at the varying energy intensities with Brent crude at nearly 110 a gallon. We've gone 106 to 109 here right now off headlines on the Bloomberg. When you look at the way EM is crushed by these prices, food, energy, and the rest that you're expert at, Torsten, does the dialogue just shift from the conventional parlor game?
Well, there's been discussion about the swap lines. There's been discussion about, in the broader context of things, what is the Fed's mandate? And is the Fed's mandate to take care of the U.S. economy and the people who live within the U.S., 50 states? Or is this someone who is supposed to take care of the global economy? And it's very clear that the trend of travel here certainly seems to be that we're moving towards that the Fed should really be caring mainly about the U.S. economic outlook.
Is it expressive currency? Is that what we're not seeing in the Q2?
Well, given that foreigners own roughly around 20% of treasuries, 20% of credit, and roughly a third, of course, also of equities, we still have a situation where foreigners do play a very important role in U.S. financial markets. So that key issue of what is the goal of the Fed becomes very, very important.
I'm just struck by how historic this is. The last person to stay on at the Federal Reserve as Fed chair after his term was Mariner Eccles. This was in 1948 when his term was up, and he stayed on because he was concerned about the post-Bretton Woods order and an economy that was torn from the war that we had just seen, and he wanted that consistency. That was the last time this happened, and I just am struck by the historical parallel at a time when we are questioning geopolitical alliances, when we're questioning how exactly some of these monetary policies are going to work in an inflationary world at a time of increased government debt. It is interesting that we're dealing with the same discussions, and I think it can't be forgotten, these sort of echoes that we feel from 1948.
I think it's easy to introduce one's opinion into this situation, so I'll just allow the market to guide us. Clearly, the chairman is concerned about a threat to independence. Is he right to be? Look at inflation expectations right now. Market-based inflation expectations have remained really well anchored throughout all of this. So whether you're concerned about the chairman's attack on the institution or not, let's just focus on the markets. Markets have decided it's not a credible threat. So does the chairman actually have a role here that he needs to play? Is this a card he needs to hold? I don't really understand that. I'm struggling with that. That's something I'm wrestling with. My opinion doesn't really matter. The market's telling me there isn't a concern with central bank independence. The market is telling me there isn't a concern with inflation expectations, and the data is telling me that the rest of the world's not worried either, because when I look at foreign ownership of US assets, they are rock solid, and for treasuries, I think they're at all-time highs at the last data point I saw, Torsten. So is there a problem here that the chairman even needs to address?
Well, that's why the key question becomes, what does confidence mean? Is it confidence by Jay Powell? Is it confidence by foreigners? Is it confidence by markets? It does become a very important debate. That's why this discussion around who will be the next Fed chair, now we know it's Kevin Walsh. There was around that time also a lot of discussion around it could have been someone else who might not have been perceived as credible as Kevin is. So for that reason, I completely agree. Who is the judge ultimately of what Fed credibility is, and where do we look and where does the market look for evidence whether Fed credibility is being threatened?
And look how many establishment figures came out when Kevin Walsh was nominated by the president. How many establishment figures? And forgive me if you're insulted by being establishment. Gita Gopinath, formerly of the IMF, I don't think it gets more establishment than that, endorsing Kevin Walsh and saying he'd make a great Fed chair. Mark Carney of Canada, the former governor of the Bank of England and now Prime Minister, endorsing Kevin Walsh as a future Fed chair. What exactly is the chairman defending here when it is standard protocol to leave once your term is up?
Well, I think that that's a fair question. And ultimately, My personal opinion doesn't matter. And frankly, I don't know what my personal opinion is. I just think that there is a sense right now in markets, to the point that Fed Chair Jay Powell made, that even on Congress's level, they have confidence and they would like to see Fed independence continue. And that's you see in Tom Tillis's move. So what would make him stay on? I guess that's one of the questions. What would change his mind to actually remain on as governor past his term as Fed chair if Kevin Warsh were in the seat that would make him feel like he needed to uphold this Fed independence?
Jeff Rosenberg of BlackRock joins us now for more. Jeff, I imagine you want to avoid this topic altogether. So I'll ask you about the substance of the news conference, the shock from the Middle East, and whether it threatens to upend the outlook for this economy.
Yeah, I mean, look, the conclusion here on the substance really pivoted on that moment. I would argue, though, that the pivot was less about the conversation about whether he was staying on and that part of the conversation, and really his answer to the question that occurred right before that. That was the question about, hey, aren't you more worried about the employment outlook? And he definitively said no to that, and then pivoted to the challenge on inflation. And from my reckoning in the meeting, that was the point at which the meeting turned hawkish, because the majority of the discussion around the meeting is around inflation, whether it was the tariff inflation not coming down as much as expected, the unknown impact of energy prices on future inflation. So you have this kind of backdrop of forces that are pushing up inflation and disappointing the expectations for inflation to decline in the backdrop of stable unemployment rates. And so that really, I think, pivoted the market reaction to, this Fed is much more hawkish, the front end flattening, the equity markets responding. And that was the moment in the meeting where this moved from what had started out as a kind of dovish statement interpretation, holding the Waller dissent to the side for a second, into a definitively hawkish press conference.
Jeff, I'm looking right now, and we've completely priced out a rate cut for 2026. The first rate cut now isn't priced in until July of 2027. Does that matter for risk assets? Does that matter in any way, shape, or form, or has the Fed been totally sidelined by other events?
Well, I think it does matter because that's what you're seeing in the markets, right? Risk assets are going down, and I think they're going down because of a pricing in of a more hawkish Fed. This is a risk asset market that has benefited for a very long time from a highly accommodative Fed, both in terms of price and quantity when you think about the impact of the balance sheet. So as we debate what the future Fed looks like, there's both a price and quantity uncertainty there, but both of those in the past have been highly supportive. When you challenge that immediately reprices, the Fed's near-term expectations, which you're talking about, but also the degree to which that liquidity in price and quantity is supported and will have the outlook continuing to support risky assets.
Jeff, John and I were going back and forth during a press conference about what the flight to Monza is going to be the first week of September. It's already up 60%. It's moved 60% into Milan.
You want an F1
already
as well?
Up as well. Jeff, where are we going to be, to both of you? Let me start with Jeff Rosenberg here. Demand destruction to me is tangible when you see a given fancy plane ticket go up 60% or a gallon of gas. What does BlackRock say about demand destruction?
Well, it's interesting because the last question in the press conference, the premise was, if you remember it, how high do energy prices have to go before you'll consider hiking rates? And that just misses this whole point about demand destruction, because the scenario where this goes on longer and is more disruptive to oil prices is a scenario where you shift the focus from inflation, which is today's and really the last couple of weeks' story, to a growth story. And it's not how high do oil prices go before you hike, but how high and for how long do oil prices get before you cut.
Precisely.
And I think that's the swing there.
Torsten, that's exactly where I am, is that this is a GDP story of constructing GDP under massive price stress.
Absolutely, because now we'll begin to watch on the weekly data, on the monthly data. We have data for how many miles are driven in the U.S. We have data for how much money is spent on gas at the pump. We also have data for airfares and how much people are spending on buying airline tickets. So for that reason, if those things begin to come out, especially even the anecdotal evidence of this slowing down, this should begin to be more worrying.
John, close the loop with you. Utility prices in the United Kingdom, it's the same thing. I think Jerome Powell's aware of this, frankly, but the zeitgeist is not talking about the GDP demand.
You're going to get me in so much trouble with regards to the UK. They've got a problem over there, and his name's Ed Miliband. I'm going to leave it there, and you can sort that out yourselves because I don't live there anymore. I'm going to talk about the shock with COVID and the inverse, the mirror image of what we see now, which is something Jeff Curry of Carlisle was talking about earlier on this morning on Bloomberg TV. In COVID, we had a massive demand shock, and it took negative prices to rebalance the market. The Hormuz crisis is the complete inverse of that. So you've got a massive supply shock that requires much, much higher prices to rebalance the market. So to your point, the question is whether $100 in the paper market and futures right now, and a futures curve going out to December that prices something in the high 70s, is sufficient enough to do that at the moment.
Well, that's why what's interesting about also what Tom is saying, if you look at the SEP, they revised inflation up. Let's just agree, that makes total sense. But they also revised GDP up, telling you that they're not assuming any demand destruction whatsoever. Is that in the textbook? So, well, the textbook would certainly tell you that an oil price shock is stagflation. You get higher prices and lower GDP, and there was no evidence of that in the SEP today.
Jeff, that's a big question. I think it's an important one. Where's the hit to growth from the higher inflation, from the higher outlook for energy prices?
Well, it's certainly not in their forecasts, and that's the clear kind of takeaway is that the forecasts are basically talking about a temporary, transitory, to use that word, impact. So that's not in the forecast. I don't think we want to take too much away from that because if you look at page 16 of the SEP, it talks about the uncertainty in the forecast. The uncertainty in these forecasts is greater than the mean, and so that really tells you there's not a huge amount of forecast accuracy here. So let's kind of put aside that these are actual forecasts of where we're going to go. For what is really important here is it kind of tells us about the tone and the consideration of the committee. And that is basically, and Powell talked about this, a little bit of upgrading. The longer term upgrade to growth, I think, is the message. The little bit of the longer term upgrade to the Fed funds terminal rate going up. And it's a little bit of a productivity story. But that is ignoring any kind of short-term impact becoming bigger issue for 2026 in the economic outlook from the oil price shock.
Hey, Jeff, it's good to see you. It's great to catch up. Jeff Rosenberg there of BlackRock, breaking down some of these moves with Brent crude, TK, getting closer and closer again to 110.
Well, just under 106, and we're popping up 109.38. A set of headlines coming off of our Dubai desk through T-Live, and I'm sorry, there's miselection here. It's 10:43 at night. It starts for another evening in the Persian Gulf.
Would you like the F1 rant now, since you brought up Formula One and Monza in September?
You and I are going back and forth.
Got a few minutes left.
I mean, you know, we've both been medicated, but I'm sorry. It's just, it's not good.
$1 billion Mario Kart. Seriously.
It's
like watching a computer game.
I love the Apple coverage, and it's tragic they have to deal with the truly, as Verstappen would say, the shattering of the sport.
It's not racing if the racing driver is going through the corners, slowing down to harvest battery power.
Can they fix it now, or is this going to take a committee meeting 1 year out?
I hope they can. I have doubts they won't. There's going to be a lot of pressure on them if the fans start to depart. For me, this is for the tourists, not for the purists. And if Max Verstappen steps away from a sport he loves, imagine any other sport where the biggest star in that sport is thinking about a sabbatical. And right now it sounds like he's thinking about a sabbatical.
Again, it's exciting. Now, they canceled the 2 races in in Bahrain, in Saudi.
Because of this crisis.
And, you know, life will go on. But, you know, it's, again, the unexpected, just like we faced here today.
Going to park the F1 now. We done with that? Yeah,
no,
good.
I think it's fine.
Grandma's going to start throwing stuff at us.
Oh, no, I'm enjoying this. I honestly was going down a rabbit hole that no one needs to go down.
I can't afford to fly to Milan now.
Oh, come on. You and the fam?
Goodness. No
Over
way.
to Monza, September 6th?
Absolutely. I'd love to.
Bramo can do the unemployment report.
I'm not going to make that happen
I'll be
anytime
here
soon.
like, the world is falling.
Torsten, it's good to see you. Torsten Slok there of Apollo. I thought that would be a boring news conference. It was not a boring news conference, and this is a story that's going to run for a while now. Succession planning at the most important central bank on the planet, arguably the most important financial institution on the planet, has totally broken down. That's the problem.
That's a problem, but also this is a Fed that's not going to come in and rescue equity markets with this concern of exactly how this is going to settle out. And equity markets are taking notice.
Because they can't. Crude right now, Brent, close to 110. Coming up tomorrow on Bloomberg TV, we'll catch up with Krishna Gua of Evercore and a whole lot more. From New York City this afternoon, good afternoon. This was Bloomberg Surveillance.
I believe that talent is equally distributed, but opportunity isn't. But education can give everybody the opportunities that they deserve to fulfil their potential. That's why I got involved in politics and why I got involved in the Labour Party.
At any point in your tennis career, did you say, I've had enough and I'm just going to retire at the top? You ever worry about that problem, staying too long?
It's a great question, and it's one that I think every athlete finds a different answer to. Mine came a little bit later than when I would have liked. I think stubbornness was a great quality that shaped a lot of my victories, but in the end of my career, I think it became a flaw because I was so stubborn to get healthy, for my shoulder to recover. I was also at an age where just my body didn't recover as quickly. And so for a year or two, that stubbornness got in the way of other great things in my life.
What would you say is the thing you're most proud of having done as a tennis player? Was it winning Wimbledon? What was the highlight of your tennis career?
I'd say consistency. I think consistency is, you can have results and they could, come at various times in your career, but I was consistent for many years, and you have to show up. You don't just show up to play first round of the finals, but you have to show up for press conferences after, before every match, before every tournament, and just the consistency and the mental wear and tear of showing up week in, week out. So I felt like I consistently showed up for my team, for my sponsors. As I look back, I'm proud of that.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, Tuesdays only on Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is the close.
The market's on edge with oil on tilt, the Fed in the freeze as it flies blind amid the fog of war. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostic, counting you down to the closing bell with U.S. equity indices near session lows, oil near session highs, and the sell-off in short-term treasuries resuming after a 3-day reprieve. U.S. policymakers keeping the benchmark federal funds rate exactly where it's been since December, and plotting out the likelihood it will make good on that one rate cut for 2026 that it had earlier telegraphed. An updated summary of economic projections. It did show an increase in inflation expectations, but also an increase in the GDP outlook. But Jay Powell says for now, take those projections with a grain of salt.
The thing I really want to emphasize is that nobody knows. The economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction. To your point, if we have if we have a long period of much higher gas prices, that's going to weigh on consumption. That'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. Something quite different than that. We might have much lower than expected pass-through.
One of the more revealing comments from Jay Powell's press conference was just wrapped up a little while ago, coming off of that 2 p.m. announcement here, keeping rates exactly where they are, but some big questions now about where we go next. Ken Shinoda kicks us off to the close, portfolio manager over at Double Line Capital. And Ken, I really thought that comment kind of encapsulated the bind that the Fed is in right now. They obviously are looking at a labor market that, in their view, at least if you read in between the lines, probably a tad weaker than what it was, but also looking at an inflation picture that is now let's just call it completely uncertain.
Poor Powell, he was in a good spot. He thought he would ride out into the sunset, inflation coming down, and then oil spikes $30. And yeah, the labor market was weakening and they thought they would be able to cut, but with the spike in energy prices, it just doesn't seem like they could cut this year. The probability to cut last night was one cut at the end of the year, and that's dropped below one cut. So it seems like unless we get a resolution in the Middle East, that the Fed's going to be on hold throughout the year.
And it gets to this idea, and Powell seemed to be very cautious about, certainly did not use the word transitory, seemed to dance around even the idea that the Fed was discussing that. But it seemed like for a while the market, Ken, was kind of viewing this energy shock, if you will, if we want to call it that, as transitory. And the idea that they seem to be positioning, if not necessarily an end to the conflict, the idea that this rise that we've seen in energy prices would not have a lasting impact on economic activity. How do you view it?
Yeah, I mean, I think a couple of weeks ago when the conflict first started, definitely the market was trying to look through it, but it seems like this is going to last much longer than anticipated. Equities are pretty volatile here, but surprisingly not down that much. I actually would think they'd be down given the pass through of energy prices into gasoline, how that leads to consumption and spending. So I think markets have been surprisingly resilient. If this keeps going, I would expect more volatility.
Yeah, and to Powell's point, too, he sort of referenced this idea that all the talk of stagflation is probably a little bit overblown, basically saying that this is not the 1970s. In his words, that was a much more serious set of circumstances. I guess my question, though, and particularly for you, as someone who is very active in the rate space here, when you start to see yields go back up, and I think right now, certainly on the two-year yield, we're at the highest level since the war began. What is that telling you right now about the psychology of where traders think this market is going to go?
Yeah, well, the front end is pricing in the lack of cuts. The front end is saying with inflation here, there's just no way that they could drop rates unless energy prices come down meaningfully. And then the longer end, we're kind of in the middle of the trading range. The 10-year got down below 4% over the last couple of years. We've kind of seen 380 a couple times. We're at 420 right now. We've seen 450, so we're kind of in the middle of that trading range. It's hard to get overtly bullish on the long end. I think kind of that 2 to 5 year portion, now that it's repriced, looks interesting. It's hard to see the 2-year rise meaningfully unless we think inflation is going to stay high for many, many years. And for now, at least, if you look at break-even inflation rates, longer-term inflation expectations, call it 5-year inflation expectations, are still sub 3%. So it's kind of hard for the 2-year to break too much higher. I think you'll see more buying there than potentially the long end of the curve.
I thought it was interesting, the relative lack of dissent, particularly given some of the drama that we saw in the previous meetings. But I do want to address the elephant in the room and then with regards to Powell's tenure, because it seemed like part of the case for rate cuts, at least in the minds of the market, wasn't just the economic data itself, but also the idea that you were going to get Kevin Warsh to lead this Fed, and that, in theory, was going to push the Fed in a much more dovish direction. Does the idea, as Powell addressed today, that, well, he might have to delay his vacation plans for a little bit, does that change the calculus for how you think the Fed might actually tilt one way or the other?
Warsh comes in. I know he talks dovish, but he's got to fight the mandates of the Fed. He's got to fight inflation. He's got to keep employment strong. And if inflation's high, I just don't see how he could cut the 100 basis points some people are calling for. Just earlier this morning, you have some market participants saying, yeah, buy stocks because the Fed's going to cut. I mean, the market's not pricing that in, so I don't know where they're getting that information, but they're going to have to do what the data tells them to do. They're going to be very data dependent. And I think you just have to watch that data. And if the energy prices stay high, it's very hard to cut rates.
I do want to get your thoughts on something non-Fed related. And this really has to do with what's been going on, Ken, in the world of artificial intelligence. And, of course, the CapEx spend and now the big borrowing that we've seen in that space to fund that. We've already heard from some other fund managers out there saying that, at least for right now, particularly when it comes to software, they're not really willing to wade into that space right now. Are you comfortable with what you've been seeing with regards to the borrowing overlaid with the idea of what may or may not actually be the return with regards to some of those AI investments?
Yeah, we're in the very early innings of AI CapEx spending, borrowing in the debt markets, and become a larger and larger percentage of many markets. Right now, it's very small. There's a couple kind of off-balance sheet IG transactions that have gotten executed out there. There's some transactions being done in bank loans and private credit. CMBS market is lending to some data center owners. The ABS market's funding some data center infrastructure. But with time, it's only going to grow. I mean, if the market participants are right and we're going to see multiple trillions of dollars of CapEx spending, it's going to become a meaningful part of the debt markets. And in debt markets, you don't have infinite upside like stocks. Like if you're going to own AI, I joke, you might as well own the equities. Right now, the spread pickup for some of these transactions is minimal with a lot of uncertainty. So what we're doing at DoubleLine is we're avoiding as much of this exposure as we can until we get paid more for it. If we see a correction, maybe we'll wade into the waters. But for now, we think it's prudent to kind of limit our exposure in that market.
All right, Ken, have to leave it there. Always a pleasure. Ken Shinoda, portfolio manager over at DoubleLine Capital, counting us down to the closing bells with stocks right now at session lows, oil near session highs, and some big earnings after the bell out of Micron.
The closing bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here to take you through the closing bell. Katie Greifeld is on assignment, but Carol Masser and Tim Stenovic join us as always. Welcome to our audiences across all of our Bloomberg platforms, television, radio, and our partnership with YouTube. A very busy afternoon here as we await some earnings out of Micron. And of course now, just about an hour or so removed from a big Fed decision that actually didn't move rates, but actually said a lot about where the Fed is at.
Yeah, kind of fascinating. And I think the big headline is Fed Chair Jay Powell basically, I'm not going anywhere. We're going to wait until all of this stuff is resolved. We just talked with Greg Peters over at PGIM, and some of that saying, here is a Fed chair that is willing to stay put, not cut rates, do the right thing based on what the economy needs. And so that kind of helps explain what we are seeing in terms of market reaction. Stocks under pressure. And you talked about the yield curve in terms of a flattening, but we did see certainly yields move up.
Yeah, and not to sort of belabor the point about what we learned from the plans for Jay Powell, because I do think that was a big bit of news that we got, Romaine.
Yeah.
I guess the ball kind of moves into the court of Jeanine Pirro, U.S. Attorney for Washington, D.C., Senator Tom Tillis with the nomination process and whether or not, we could see a Fed chair nominating process in the next few months. Because if we don't, then Jay Powell, he's there.
And it's messy. And I'm just going to borrow a phrase that John Farrell used on the Fed special here. The idea of this type of a messy succession plan, if you will, for the most important financial institution in the world, no bueno. No bueno here for the equity markets as well. We started the day in the red, but they were modest losses to start. Those losses accelerated once Jay Powell started speaking, and they accelerated even further when we got closer to the closing bells. The broadest base sell-off that we've seen in the S&P 500 all year long. Down 91 points on the day, or 1.4%. The Dow Jones Industrial Average losing 770 points, or 1.6%. The NASDAQ Composite down about 1.5%, and the Russell 2000 giving up about 41 points, or 1.6%.
All right, back to the S&P 500. No surprise as we see stocks selling off here following the Fed decision. Romaine, we've got most names in the S&P lower today. 422 to the downside, 81 actually gaining ground on this Fed Wednesday. So, yeah, a lot of selling here.
And all 11 sectors in the S&P 500 are in the red. Consumer staples and discretionary stocks, the biggest decliners there. But honestly, nothing was spared. And that even includes energy. That was actually fractionally lower on the day. We should point out that as we speak right now, we are seeing the Brent crude prices climb back to those intraday highs around $109 a barrel, and yields right now on your 2-year, the highest that they've been since August.
All right, everybody, we've got Micron crossing the Bloomberg terminal, so let's go to it as they cross. Bringing up my headlines here on the Bloomberg. Second quarter adjusted revenue. Folks, pretty big beat there. $23.86 billion. Street estimate was $19.74 billion. Check out the second quarter adjusted gross margin. Investors were expecting a lot, and they're getting it. 74.9% on that adjusted gross margin. Estimate was 69.1%. Second quarter cash flow from operations, $11.9 billion. That compares with an estimate of $8.93 billion.
I'm sorry, can I just stop you there? Because I know you're comparing it to the estimates, but I just want to compare that year over year. $11.9 billion in cash flow from operations. A year ago, that was $3.94 billion. And similar story in revenue, 24 billion in revenue. A year ago, that was $8 billion, Carol.
Well, get ready to pop your eyes even more because third quarter adjusted revenue, here's the outlook. Revenue of $32.75 billion, folks, to $34.25 billion. Street estimate was $23.66 billion, stock up about 2% here, Tim.
Look, Sanjay Mehrotra, president and CEO of the company, says this is economics 101. It is all about supply and demand, Romaine. He said Micron set new records across revenue, gross margin, EPS, and free cash flow, driven by a strong demand environment, tight industry supply, and our strong execution. In the AI era, memory has become a strategic asset for our customers, and we are investing in our global manufacturing footprint to support their growing demand.
I don't know if you read the revenue, the projections yet, Carol, so forgive me if I repeat this here, but the
It's
third
worth
quarter
repeating.
adjusted revenue numbers, that 32.75 to 34.25, and that's above estimates. But you mentioned the stock move here. I just want to put this into perspective. You have a more than doubling in revenue in the most recent quarter, guidance that's going to even grow, 50, 60+% more for the next quarter. And the stock is only up 0.9%.
Yeah, it is kind of bouncing around here. So what are they looking for, right? I think one of the things that investors, analysts wanted to know, it had to do with pricing and whether or not what we're seeing and whether that continues. And this certainly plays into margins. That's probably why their margins are kind of off the chart. But we've got to get a little bit more clarity on that because that is certainly something that investors want to know.
All this, I guess, so what I'm getting at was all this pricing. I mean, this is a stock that was up, coming in today, like 390% over the last 12 months. I think 65% just to start the year alone. And the question is sort of what's the bar? We saw this similar with NVIDIA when it started, giving those forecasts the other day. And, investors are kind of like, okay, $1 trillion in revenue. That's nice. But, what else you got?
Yeah. And look, I think to your point, I mean, given that NVIDIA is 17% of Micron's revenue, according to the supply chain function on the Bloomberg terminal, then maybe some of this was priced in because you get visibility through other companies and what other companies are selling.
Absolutely, and we talk about this idea of just this shift now away from the building of these large language models to this inference phase that Jensen Huang talked a lot about. And of course, it's these memory chips, particularly these dynamic random access memory chips that Micron specializes in, and it could be a big beneficiary of that. But also, I'm curious to see what they have to say on the call, because remember, last quarter, the issue they had was the demand's there, but they don't have the capacity to actually build this stuff yet. And there's a lot of questions as to how you meet that demand and whether they can do it in a fast enough time.
They said that, remember, they said they're investing in our global manufacturing footprint to support their growth demand, reflecting confidence in the sustained growth of our business. This is another headline that's crossing. Our board has approved a 30% increase in our quarterly dividend. But I think a lot of analysts, to your point, Romaine, on the call will be asking, okay, how long does that manufacturing, global manufacturing expansion, how long does that take? How long until you can actually build enough to get demand or to satisfy the demand? But then also, where will we be in the cycle at that point? That's the challenging part.
Well, that's a good question. I think BI was that thing that they're apparently trying to build out there in New York State. The idea is that maybe 2028 would be that. And we're talking about a business that historically has been highly cyclical. And I know we're kind of not in a cyclical phase now. It's more of a structural phase. But to your point, what is the market going to be like in late 2027, 2028, if they do start to bring additional manufacturing on?
All right, I just want to go to Dina Bass, actually posting a story on the Bloomberg. So she says, Micron offering a positive forecast for the current quarter after surging prices for computer memory chips bolstered its prospects. She got to that fiscal third quarter revenue being approximately $33.5 billion. Profit will be $19.15 a share, compared with analyst projections of $23.7 billion in terms of revenue for the third quarter and $11.29 a share for profit for the third quarter. But again, she goes to memory prices. She says they're soaring because of shortages fueled by AI computing demand, and the global shortage is likely to persist another 4 to 5 years due to constraints in semiconductor production. Folks, this is basically supply and demand. When there's not enough supply out there and there's a lot of demand persisting there, prices go up, margins go up. It makes these companies much more profitable.
At some point, though, doesn't that begin to work against them, Carol? Isn't that kind of the problem? Is at some point people are going to be like, we can't afford this. And let's face it, I mean, to kind of circle this back to the Fed as well, and of course what's been going on in the Middle East, there's been a lot of discussions about how we could actually see more upward pressure on prices because of the disruption of a lot of the key chemicals and supplies you need to make this stuff.
I think you bring up a good point about potential disruptions, but if we play this through and talk about, again, NVIDIA being its biggest customer, NVIDIA has a lot of pricing power right now, because there really is nobody else that can produce a lot of what NVIDIA produces and sells. So as long as NVIDIA continues to have that moat, and can control prices and say, okay, well, this is what look at Nvidia's margins.
Yeah.
Until those take a hit, then maybe Micron can keep increasing prices because Nvidia passes those along.
I would just say,
because Nvidia passes those along to customers.
I mean, their biggest customers: Nvidia, Lenovo, Microsoft, Dell, Apple, Amazon. I'm guessing these guys have the money to do it. Like they keep tapping, we know the debt markets and so on and so forth. I have not seen any of them say we can't afford to actually spend on this. I don't disagree with you, Romain. At some point, you do wonder, when does this start to slow down? But at this point, everybody seems to indicate that the demand is still there.
Yeah, look, I mean, the money's there. The question is, when does it stop being a wise use of the money? I'm really curious to see what they say on the conference call, which is I think it's going to be at 5:30 p.m. East Coast time today, and whether they can kind of articulate a little bit more about the build out, potential manufacturing build out, but also how long they think this cycle could potentially be.
And on that, Dina Bass just saying in the AI market, Micron is working to ramp up production of new high bandwidth memory, or HBM4. And she says and writes and reports, a big question is how much NVIDIA will rely on Micron for that component. And that's where it kind of also gets a little tricky. All right, guys, we're going to continue certainly watching this one in the app.
Did you change studios?
Well, I was going to say, Romain, maybe you and I should go into memory selling.
I'm so glad you noticed so quickly.
There's so much demand.
You know,
we should.
nothing gets past you, Romain.
Going through my storage unit, finding
exactly
laptops from 20 years ago.
Micron's down about 1% now, guys, in the aftermarket.
Like a scrap dealer.
Down. Yeah. Talk about moving up and down here. All right, guys, that's a wrap. Nice to kind of just chat with you, Romain.
It was nice.
I mean, I love all your.
You were smart today. I like it.
All right, that is a wrap. Across platform, radio, TV, YouTube, and Bloomberg Originals. Romain, just there solo over on the TV side, continuing, of course, on the close. And Tim and I continuing on Bloomberg Business Week Daily right here on radio. Folks, we will see you again, same time, same place tomorrow.
Another blockbuster quarter for Micron, though the share is under pressure here in the after-hours trade. We're going to talk about this structural cycle that we're in right now when it comes to chips and memory chips specifically. Matt Bryson over at Wedbush. He joins us in just a second, right here on The Close on Bloomberg.
names at the Fed are on Bloomberg.
I have projections for unemployment. I have projections for inflation. So do my colleagues. And thus far, the evidence from events over the weekend haven't led me to change any of my forecasts.
With the geopolitical events that we talked about, it's just too soon to know what imprint this has on inflation and for how long.
We've seen the economy overall. It's been pretty healthy. It's been brightening. The outlook has been positive.
I'm just watching prices at the pump. They've jumped up over the last week. You can see that when you drive around. But of course, no one knows whether this is going to be short-term or long-term, and so we'll just see where it goes.
Inflation's hot. It's going to look even worse now with the oil prices, at least on headline. And then if you get a solid job number, it does say you can sit there and wait.
It can lead you in a stagflationary direction. The inflation side of the mandate getting worse at the same time the employment side of the mandate is getting worse. And that's always the worst case scenario.
Nobody covers the Fed like Bloomberg. Context changes everything.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism. This week, the Fed's reaction to the Iran war with Randy Quarles, former Fed vice chair. How Australia's attempt to limit social media for young people is working out. And a different view on AI. What if, after all, it's simply a normal technology and not the revolution some predict?
Let's look at reliability separately from capability. Capability is not enough.
Watch Wall Street Week. More than what you need to know, it's what you need to think about.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Romaine Bostic. We take a look at how U.S. equity markets closed out the day, and it was a down day. Accelerated selling into those closing bells, down about 1.4% on the S&P 500 for the broadest based sell-off that we've seen for the benchmark index all year long. That, of course, was tied to a lot of concerns about the uptick in inflation amid the war in Iran and a Federal Reserve that, at least for right now, seems a little bit paralyzed with what to do next. Your two-year yield, that is, of course, the yield that is most sensitive to Fed changes, that is up 9 basis points and now at its highest levels going back to the summer of last year. Brent crude prices that are in the new session, they're actually trading above where they were in the previous session, $110 a barrel. Spot gold down about 3.4% here on the day. As for the individual movers, you got no help today from the big tech stocks. Microsoft was down, as was most of the Mag 7. You did have a few bright spots there, including Cloudflare on the back of some of reporting here about a potential stable coin. And you had a newcomer to the market, Swarmer, that is the AI drone company, which rallied 500% on Tuesday, up another 77% today. And SanDisk, during the regular session, was up about 5% on the day. But SanDisk, of course, now under pressure here in the after-hours trade on the back of those earnings out of Micron. And that does bring us to our top story to kick off the hour. It is a focus on the economy, but the main pillar that has kept it and the stock market afloat, the unrelenting spending on AI. One of the biggest beneficiaries has been Micron, the biggest U.S.-based maker of memory chips. It's been riding high. Revenue in its most recent quarter, the fiscal second quarter, came in at $24 billion. That's 3 times what it was a year ago and almost 4 to 5 times what it was a couple of years prior. Quarterly net income surpassing $14 billion. That's almost 8 times what it was just 4 quarters ago. Micron stock, the best performer in the Philadelphia Semiconductor Index over the past 12 months, and third best performer in the NASDAQ 100, almost quintupling in price over that time. But of course, those high numbers bring high expectations and a lot of questions now about where we are in this memory chip cycle, how long it can go, and just how much Micron will benefit. Matt Bryson joins us right now, Managing Director of Equity Research at Wedbush Securities. And Matt, I mean, look, let's just start off. This was a phenomenal quarter, a blockbuster quarter in terms of the aggregate numbers, in terms of the growth, in terms of the margins. I don't think there's a number in here that you can really quibble with. However, I am curious as to where we are in this super cycle, or whatever we want to call it right now, and whether investors should still be riding it or maybe be a little bit more cautious.
Yeah, Romain. So I think we still have some room to go. Memory is very much a supply-driven business. So it's not how much demand there's out there. It's can the vendors bring on enough supply to meet that demand? And because you have these long lead times for fabs, we don't really begin to see new supply coming on until next year. And it may even be 28 before Samsung, Micron, Hynix can catch up with all the demand from AI.
But is there a sense here, though, that there's any sort of negative to this? And by that, I mean, the idea is that if the demand's there, will it be there? We were talking a little bit earlier on the program, the idea that once you start to get manufacturing capacity up and running, will that cycle still be there to support that expanded capacity?
Yeah, at least from what I'm seeing, companies have already set their purchase orders for things like HBM for 2027. So I think if those large customers are certain enough that their demand is there to place orders, then Micron and the memory makers don't have a demand problem yet.
We are getting additional headlines now. They are addressing some of these issues right now, talking about that they still see a tight DRAM as well as a NAND market beyond 2026. I think they've kind of said that before. It gets to the question too, Matt, that where are we right now with regards to just the AI build out? And I bring that up in the context of what we heard from Jensen Huang earlier, who talked a lot about how we're kind of shifting now to this inference phase, which of course brings a whole different set of power demands and chip style demands as well as memory demands as well.
Yeah, so Jensen told you he's got $1 trillion in business between Blackwell and Rubin. And by my math, that shows some slowing in 27, but you're still looking at something like 40% annualized growth off of really, really big numbers. And so if you believe him, and he's got better visibility probably than anyone else out there, then there's still a fair amount of growth left with AI.
All right, Matt, really appreciate you giving us your snap opinion here as we await that conference call in just about an hour or so's time. Matt Bryson, Managing Director of Equity Research over at Wedbush Securities, a blowout quarter for Micron Technology and guidance for the current fiscal quarter of revenue of roughly about $33.5 billion. When we come back, we are going to turn back to the Fed, and we're going to turn to Jay Powell and his future. Apparently, he might be staying put for a while. Former Vice Chair Lael Brainerd joins us in just a second to talk about what comes next. This is The Close on Bloomberg.
I'm Francine Lacroix, an award-winning journalist. I've interviewed everyone from world leaders to fashion icons about the news of the moment. But I've always been curious, who are these people as leaders? Start your week with me exploring what drives the world's most influential people and what we can learn from them. So tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And
I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream.
Breaking news on this Saturday morning.
There's really only one story, and that is Iran.
Balance of power has all the angles covered.
Trust Bloomberg for on-the-ground coverage.
An entire region pulled into this conflict.
Talking to you from the bomb shelters.
Up-to-the-minute reporting.
Iran remains a viable threat.
And the analysis you need.
There was no imminent threat.
There's never a good time, but there are better times.
Netanyahu is my opponent. However, on this issue, we stand together.
Nobody covers geopolitics like Bloomberg.
I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality, and I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet, and I will make that decision based on what I think is best for the institution and for the people we serve.
Fed Chair Jay Powell addressing, well, I guess the succession planning going on right now at the FOMC and the Federal Reserve Board, particularly given what is still an open investigation by the DOJ. Joining us right now is Lael Brainerd, former Fed Vice Chair and former Director of the National Economic Council. And Lael, before we get to the actual Fed decision and some of the economic projections, I do just want to ask you about kind of what actually transpires over these next few months with the possibility that we could actually see a sort of a chair pro tem situation with Jay Powell. We could see him stay on as governor, particularly as this DOJ subpoena case, whatever we want to call it, remains unresolved and could actually hold up Kevin Warsh's confirmation.
So clearly, he wanted to put that statement out there today to be very clear that his leaving the board would be contingent on that criminal investigation being terminated. And of course, that lines up with Senator Thom Tillis, who has said that he will not move forward on the vote for incoming nominee Kevin Warsh until that criminal inquiry is dropped. And the administration has a very clear path to do so. The statement on the part of the district court judge, very clear. They did not see a case here. And so by simply not moving forward with an appeal, it would clear that path, at least to get Kevin Warsh a vote and to get him onto the board. What happens after that, Jay Powell wouldn't say.
He would not say. He also wouldn't say a whole lot about the inflation situation. He was asked. He answered it, I think, the best that he could. But he also seemed to make clear that right now, no one really seems to know anything. I thought his comment about the summary of economic projections, which was basically, hey, we had to write something, so we wrote it down. But that didn't sound like there was a whole lot of conviction that that forecast, whether it's on the GDP side or the inflation side, is something the market should put a whole lot of stock in. How did you view it?
Yeah, I found it surprising. We did not learn really anything about how the committee is thinking about the effects on inflation and the economy from the oil price shock, neither in the statement nor in the summary of economic projections. Yes, they marked up core inflation a few tenths, but that could simply be reflecting the reality that core PCE has actually moved up a bit in the last few months and is expected to be a bit stickier than before. But what was interesting is that he wouldn't use the word transitory, but essentially they look like they are treating the oil price shock as transitory.
Well, yeah, and he was very careful not to use the T word, but I am curious about this idea of just the compounding effects of everything, because I think one reason why I think the market talks about it being transitory, because we've kind of been here before, whether it was obviously the supply chain issues with regards to COVID, and then obviously whatever happened with the start of the Russia-Ukraine war here. Is there a reason not to view this as potentially transitory?
Well, I think that we have to at least consider two reasons this time may in fact be different. One is that the size of this oil shock is unprecedented. The Straits of Hormuz have not been closed before. 20% of oil production. That is very material, and nobody knows how long this is going to go on. The second reason that I think we have to be a little bit cautious before we dismiss this as transitory is this oil price shock comes on